team. All right, let's turn now specifically to the U.S., where Treasury Secretary Janet Yellen reiterated her confidence in a soft landing scenario, saying that she feels very good about the economy avoiding recession while taming price gains. She also said, quote, "We're on a path that looks exactly like that." Let's bring in now Valerie Teitel from our markets team for more. Valerie, look, Janet Yellen, of course, is going to be more optimistic than most about the American economy. But how widespread and how backed by data is the soft landing view as it stands?
Well, look, she did make some very good points. She mentioned in that interview on her way back from the G20 that the recent rise in an unemployment rate is, in a matter of fact, almost a good thing. It wasn't driven by layoffs. It was driven by more workers returning to the U.S. workforce. She also commented on inflation, saying that nearly every measure of inflation is on the road down. But, Danny, I want to talk about the near-term risks to that call. We have U.S. inflation on Wednesday, and risks are to the upside, especially when it comes to this core number. Remember, we've gotten core month-on-month at 0.2% for the last 2 months running. The consensus estimate for Wednesday is that we do get another 0.2, but the risks are to the upside that this core print does come in hot. That could rattle, perhaps, maybe not Janet Yellen's, but many others, a call for the fact that the soft landing is upon us if we do see this summer reacceleration, and not just headline, but also core.
Let's turn to the consumer, because after staving off a recession for so much longer than many investors thought were possible, there are now many investors that believe the consumer is about to crack, according to the Bloomberg latest Markets Live Pulse survey. Valerie, what are the forces at play behind this?
It seems a lot of bearishness recently on the U.S. consumer, a lot of that driven by the fact that excess savings in the U.S. are running out, and compound that with the fact that we have student loan forgiveness also running off. In that survey, near 20% thought that U.S. consumption will turn negative in the fourth quarter. Another 56% thought it would turn negative on the early 2024. But I want to talk a bit about those student loan payments. In the month of August alone, nearly $9 billion went out of consumers' pockets to pay those student loans. Remember that forgiveness ran off at the end of August, and many are seeing that as a big headwind for the consumer. It's not a matter of if, it's a matter of when this begins to impact consumption. And remember, consumption is a big one for U.S. growth. It makes up nearly 70% of GDP. Now, alongside all of this bearishness on the U.S. consumer, you'd expect to have bond bulls waving their flag even louder. But in fact, we've not exactly seen that. We've seen people scrapping their long Treasury calls. We heard from J.P. Morgan over the weekend that they're now dumping their view on being long 5-year Treasuries. We also heard a very similar thing from Bank of America, scrapping their call on a long 10-year Treasury view. So very odd to see this bearishness of the U.S. consumer, not necessarily paired with the fact of seeing the street being out there for more bond bull calls.
Right. Well, that is the thing, right? Everyone hangs their hat on a strong consumer to say that growth is going to be okay and maybe inflation won't come down as much as needed. Valerie, thank you so much. Valerie Teitel there. To tech, SoftBank's chip design unit ARM is said to be considering raising the price range of its IPO. It comes after meeting with investors for what would be the world's largest listing this year. Let's bring in Bloomberg's Alex Webb on this. Alex, it's that build up to the IPO hype that I think often people want to have before they release the IPO to the wolves. But how much more optimistic is the pricing seem to be at this point?
Well, if it's true they raise the price, then clearly they're optimistic. It is interesting, though. It's almost like a sort of 800-meter race, right? They sort of pace it very, very carefully. Don't go too hard at the beginning, and then gradually try to kick in the kind of final straight, right? And this seems to be what's happening. They price it maybe a little bit more conservatively. Now they put the word out that it's oversubscribed. Being oversubscribed isn't necessarily all that useful. People might express interest, doesn't mean they're actually gonna commit. And so like when it gets to, they're trying to create that momentum, essentially. Create that momentum heading into Wednesday in the hope that then you get more people piling in and inevitably get a bit of a pop. But not too much of a pop. Enough of a pop.
Sustainable pop.
Exactly, yeah.
But is it enough of a pop to give it that $64 billion valuation that SoftBank had acquired back its stake at just about a month ago?
Well, look, they acquired a stake valuing the company at double what they acquired it for, 6-7 years ago. And lots of people looked at that number and said, well, it's kind of, it's funny money in a sense, because it was almost an internal deal, although there are some outside investors, of course, in the Vision Fund from whom they bought it. The more important thing, I think, for SoftBank is that they are going to retain something like 90% of the stock. They therefore want to see that stock, as Danny said, sustainably increase over the coming months, presumably, or years, so they can then try to gradually divest themselves of the rest of it. Having a relatively small float now presumably is intended to drive a little bit more demand through the scarcity of it. You do have a few strategic anchor shareholders. They're not taking massive stakes. They're more than sort of 120 million each. But that scarcity is clearly a strategic play.
All right, we'll see what happens Wednesday. Alex, thank you very much. That is Alex Webb. Now, coming up on this show, Tesla having a great start to the week. Morgan Stanley's street high price target boosting that. We're going to have more on the company ahead. And also going to be catching up with Ann Katrin-Peterson, Senior Investment Strategist at BlackRock Investment Institute, later this hour. Plus, we're going to have more on that G20 summit later with Lou Lukens of Signum Global Advisors. This is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
They sell when prices go down?
Yes. Or yes. Not keeping. People have conviction, or they invest if they invest for the right reasons, just to keep at it.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
During this difficult time, the entire world community is with Morocco, and we are ready to provide them all possible assistance.
That was India's Prime Minister Modi speaking about Morocco's earthquake at the G20 summit. Joining us now is Bloomberg Middle East economy reporter Abir Abu Ammar. Abir, thank you so much for joining us. Look, this was an extremely concerning event over the weekend. Where do we stand now in terms of the damage done and the rebuilding efforts?
Hi, Danny. So yes, I mean, the 6.8 on Richter scale earthquake that hit areas that are close to Marrakesh, the UNESCO heritage site, A lot of the city was affected. So far, more than 2,000 people have died, and there have been more than 1,400 injuries. So far, what we've reported, and from our people on ground, the rescue efforts have been complicated, and that's mainly because the epicenter of the earthquake was in a mountain area, but we know that the government has deployed military logistics teams, engineers, and field hospitals as well. Now, Morocco has yet to, say explicitly who it has accepted foreign aid from, but we know that the World Health Organization said that more than 300,000 people have been affected, and a Red Crescent official told our reporter on the ground that response to this earthquake will take months, if not years. Now, one thing to note here is that the IMF and World Bank annual meetings are supposed to happen mid-October, so less than a month away. We don't know if those are going to still happen. Now, those have been delayed already for 2 years because of the pandemic. The IMF came out with a statement, and so has the World Bank, saying that the sole focus right now is on helping mobilize technical and financial tools to assist the Moroccan people. We're on track. We're keeping track of the situation and statements coming out from the IMF saying whether those meetings are in fact going to happen or not. So that's the latest we have, Danny.
Our thank you to Bloomberg's Abir Amar. Now, this weekend, world leaders met in India for the G20 summit, where President Biden spoke about the tensions between China and Taiwan.
I don't think it's going to cause China to invade Taiwan. In fact, the opposite, probably that have the same capacity that it had before. But as I said, we're not looking to hurt China. Sincerely, we're all better off if China does what.
Now, joining us now is Bloomberg's Menaka Doshi. Menaka, you've been covering this throughout the weekend. When you look at the relationship being forged between India and the United States, where does this leave China?
Well, let me address the first part of your question first. The relationship between India and the United States was definitely strengthened on account of this G20 summit. You did see Prime Minister Modi in the White House earlier this year, President Joe Biden in New Delhi, a great amount of camaraderie between them. But besides that, the weaker language that we saw in the communique this time around the Russian war in Ukraine could have only been possible with the U.S.'s consent. And in a sense, the U.S. made that happen for India with a lot of diplomatic effort from India, but made that happen because they need a counterbalance in the region to China. Equally, India needs to want to add jobs and manufacturing, and is looking to take the place of China in the supply chain diversification of many Western corporations. So this mutual benefit just got a leg up in this G20 summit. A quick word on China, a little bit sidelined because of the absence of the Chinese President Xi Jinping, but I know you want to ask something else, so let me stop here.
Menaka, no, unfortunately, we're out of time. Thank you so much, though, for joining us, giving us that quick wrap. Bloomberg's Menaka Doshi reporting from a very bustling New Delhi. All right, we turn our attention now to Europe. The European Commission cutting its outlook for the euro area economy, predicting it will be dragged down by a contraction in Germany. Joining us now is Bloomberg's Maria Tadeo from Brussels. Maria, I know you're going to be speaking with Paolo Gentiloni in just moments, in an hour or so. Can you just break down these numbers to start with from the Commission?
Yes, Danny. And look, we have a revision down to growth, both for this year and next. And all of this, Danny, should not be a shocker or a surprise to anyone if you track the data that we've had over the past 6 weeks. And you see that this economy was pointing to a downturn. Now, they expect the euro area now to grow 0.8%. The previous estimate was 1.1%. For next year, they see growth at 1.3%. And they continue to point to the challenges, the risks, and the uncertainty for this economy. I should also note, when it comes to just the growth picture, Germany would be back in contraction, and is this weight of this economy the biggest in the euro area, pulling down the entire group, that then sees, particular, as I say, this downwards revision in growth. When it comes to inflation, again, this number really mattered in the context of this ECB decision they were expecting on the Thursday. They see inflation of 5.6% this year, which is lower than they expected in the previous set of estimates. But it's interesting that next year they see it at 2.9%. That is a slight uptick from the expected prior. Of course, that that would be in the range of what the European Central Bank would target, but not in the area of the below 2%, which ideally they want to get into. That is a number for next year. Of course, we should note that these are projections put out by the European Commission. The ECB will put out their own set of projections on Thursday, and that will be key. Beyond the hold or hike monetary policy, those projections will be key, as I say, in framing the narrative of where this European Central Bank will go, no matter what decision they take on the Thursday.
Yeah, will be interesting to see, again, as you say, if they have any sort of similar revisions. Maria, thank you so much. That's Bloomberg's Maria Tadeo. And as I mentioned, she will be speaking with the EU Commissioner, Paolo Gentiloni. That will be at 6:15 a.m. Eastern, 11:15 a.m. if you're in London. This is Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly with just a couple people. Our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Shonali Bassick in New York with Danny Berger in London. Now let's take a look at some of the stocks we're watching in pre-market trading in the United States. Tesla gaining as Morgan Stanley upgrades the stock to overweight with a street high price target of $400, up from $250. Analysts say the EV maker's Dojo supercomputer may add as much as $500 billion to the company's market value. Remember, Tesla has already surged by more than double this year, up more than 5% in pre-market trading. We are also looking at Apple, set to unveil its latest lines of iPhones on Tuesday, as well as updated watches and AirPods. This comes as the firm contends with a growing ban on the use of iPhones among Chinese government workers. Now, turning to Europe, UBS is said to be cutting hundreds of wealth jobs in Asia amid slower client activity. Bloomberg learns that further cuts are expected through November. This comes just months after the bank's takeover of Credit Suisse.
All right, coming up, we're going to be speaking with BlackRock Investment Institute's Ann Katrin-Peterson. They've upped their short-term sovereign bond call on attractive yields. More on the next. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
This is Bloomberg Surveillance Early Edition, and here is what you need to know. The dollar's record hot streak comes under threat as Asia's biggest central banks took aim in different ways at the recent rally in the greenback. Meanwhile, Treasury Secretary Janet Yellen says she's increasingly confident the U.S. will be able to avoid a recession and contain inflation. And President Biden says he has no intention of trying to isolate China. We'll discuss the winners and losers as India claims a diplomatic victory from the G20 summit despite Xi Jinping's absence. I'm Shonali Bassick in New York with Danny Berger in London. Danny, tell us about the European markets today.
It's kind of a U.S. story. I feel like that's so bad to start a European market check like that, but it's the dollar story which seems to be dominating European assets. I have sterling in front of me. It's gaining by about 0.4%, 125 on cable, and it's not necessarily a UK story. okay, maybe it's not even a U.S. story. Maybe it's an Asia story in terms of what's happening with the yen and the yuan. I know, Chanel, you're going to get into that, but it's making us all question, is this finally the turning point in the greenback? Is this the time to go long higher beta currencies like the UK sterling in terms of versus the dollar? I know we talked with Mark Dowding last week of Blue Bay, who said he himself was starting to trim dollar longs. It's a position that is starting to gain momentum. When it comes to treasuries, those are also putting in some losses, and we're seeing that reflected in the German session too. German 10-year yields, those are moving higher by just 1 basis point. One of the big stories in Europe today is also banks. Sure, higher yields helping with banks, but European banks are one of the best performing sectors so far this morning, up by 0.8%. Twofold here. One, a local paper reporting that windfall tax put in place by Maloney, they're starting to reconsider it, considering some of the reaction they had was not great. Second, ECB also giving an interview, officials there to Bloomberg, saying that some banks have gone a ways to fix their leveraged loan books, fix some of those issues that they had been looking at, meaning that some of the capital add-ons that the ECB had been planning for, some of those can be removed. Shanali, all of that resulting in a rally in European banks. How about the U.S. pre-market session? How's that looking?
We're looking at a little bit of green on the screen. We're looking at S&P futures gaining some steam here, up almost 0.4%. We're also looking at a 2-year yield roughly stable here. This has been above 5% at certain points of last week, now sitting at about 4.98. Danny, we are looking at Brent crude still above 90, but also taking off some steam here. We are looking at a 0.3% decline here in Brent crude, again still above 90. That dollar, as you've been saying, is the biggest story. We are looking at some cooling of that Bloomberg US dollar index by about 0.5%. If we flip up the board, it is worth looking at the Asian currencies here because, again, Japan, China coming up to protect their own currencies. You're looking at the yen here now, about $1 worth of 1% worth of strengthening against the US dollar. You're looking at it about 146.42. Let's see how that continues to play out, because when we look at what's happening over at the yuan, we're looking at the onshore yuan was strengthening more significantly earlier in the session. We were looking at about 1% rise when you look at the onshore yuan, still about 729. But remember that 1% was the strongest level since we've seen since March when we took a look at the rise in the Chinese yuan. The onshore yuan also in synchrony about 0.8% stronger on the day, Danny.
Yeah, and look, part of this call of the dollar reaching its peak, allowing other currencies to rally versus it, is one of have yields topped out? Have we seen the most of the bond market selling? Now, we sell off. Now, we did see strategists call for that, but it sounds like some expectations are changing. Take JP Morgan. They're tempering down their expectations of a bond market rally, raising their U.S. 10-year yield target to 4.2% for year end. That's up from 3.85%. They're basing that on stronger growth and hawkish risks. Now, Bank of America has done something similar, yet on the other side of things, there's Morgan Stanley pushing back against the bears and telling investors buy Treasury. Matt Hornbach and team write, quote, market extrapolation of strong growth into the long term via higher long-term real rates may not pan out, leaving the rise in long end yields vulnerable to a correction. Different views, and that's what makes a market. Let's get the take now of Anne-Katrin Peterson, Senior Investment Strategist at BlackRock Investment Institute. And Katrin, of course, this is in large part a call about the American economy. Where do you stand? Is now a time to be buying treasuries or not?
Yeah, good morning, Danny. I think that's one of the key questions, really, and to answer your question. On US Treasuries, we have to differentiate very much between the long end and the short end here. Short-dated US Treasuries remain appealing, and the case for them is bolstered by central banks holding policy tight. In this case, of course, the US Fed holding policy tight well into next year. Now, when we look at the long end continues to be vulnerable in our view for 3 major reasons, and we think that both term premium and long end expectations might still go further up. The first one is that inflation might settle well above the 2% policy targets by developed market central banks. The second one is that we think that investors will demand a higher term premium given inflation volatility and also given elevated/rising government debt in an environment of QT, of central banks, not just holding policy tight, but also continuing to shrink their balance sheet. And the third reason really is that the foreign demand for US Treasuries may wane over time. For example, Japanese investors may buy more into domestic bonds as the Bank of Japan continues to adjust its monetary policy back home.
So, Anne-Catherine, am I hearing you right then? Back up the truck, load up on curve steepeners?
So we would continue and tactically be positioned and also strategically at the shorter end and not yet call for duration at the long end. So some further bear steepening could be in the cards, yes. So what would us make more constructive on the long end? Two reasons, basically. The one, we need to see a higher, much more higher term premium from here. The other reason would be if we were to expect that the market is foreseeing a too hawkish policy path for the Fed and other central banks, and we are not there yet.
Speaking of being there yet, we are looking forward to that CPI print here over in the United States, as well as an ECB decision that is coming a day later. When you look at the cross currents here between what is happening in the United States versus abroad, what are the shocks that investors perhaps may not be anticipating for now, especially that it's a relative story today?
Absolutely. And speaking of shocks, we have to closely monitor what's happening in the United States, because the United States has embraced two large unprecedented shocks. The first one is mismatches related to the pandemic. For example, the strong, sharp shift in consumer spending between goods and services in the US. This is now unwinding, and one of the reasons why we have witnessed disinflation in the US, which is taken by itself a really good story. The other shock, however, which might be binding heading into next year, is that baby boomers in the US age into retirement, meaning that there will be a continuous shortage of labor. And this may mean that US inflation is put on a roller coaster ride and could be rising again heading into 2020 for amid a tight labor market structurally and higher wage inflation as well. Now, when we look at the ECB is somewhat at a different stage here, because the euro area economy, at least to date, is facing labor market tightness, but not yet as strong of a demographic challenge as the US. What really is key when we look at Thursday's meeting is that the ECB's communication may shift, whether it goes for a hawkish pause, which is my base case, or a dovish hike, that the communication will shift from how high policy rates get to how long they will stay there.
That's BlackRock's Anne-Catherine Peterson. We thank you for your time. Now, coming up next, we'll speak to Lou Lukens. He's Signum Global Advisors Senior Partner. Up next, we'll talk about that G20 meeting. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
He has his hands full right now. He has overwhelming unemployment with his youth. One of the major economic tenets of his plan isn't working at all right now. I'm not happy for that, but it's not working. So he's trying to figure out, I suspect, I don't know, just like I would, trying to figure out what to do about the particular crisis we're having now.
That was President Biden speaking about President Xi at the G20 summit. Xi's decision not to attend the G20 may have been intended to deny India its moment, but instead, Prime Minister Narendra Modi, along with the U.S. and Europe, figured out how to more effectively counter China on the world stage. Now, joining us now is Lou Lukin, senior partner at Signum Global Advisors. When you look at the events of the G20, how do you think it really sets up India to compete on a global scale, especially given the trajectory of its growing economy?
So look, I think President Modi and Prime Minister Modi did a very, very effective job of placing India at the center of this very important summit. The negotiating team that he had that brought all the parties together, all the countries together on a joint declaration, I think was very impressive. And I think you're right. I mean, China, through his absence, or through President Xi's absence, missed an opportunity to sort of weigh in on these important issues and help to sort of create this dynamic of the United States now even more closely aligned than it was before with India as basically a counterweight to China.
When you saw President Biden speak about China and the threats that it posed to Taiwan in particular, he basically said that President Xi has more to think about with its own economy. You are getting a lot of conflicting data coming out of China. What did you make of President Biden's remarks?
Well, I think the economic situation in China plays two ways, right? I mean, maybe President Biden is right, and that President Xi has too much on his plate, and he will be less aggressive in the South China Sea, and particularly in regards to Taiwan. The flip argument, though, is that invading Taiwan or taking action against Taiwan is an effective way for him to rally the country behind him. And if he starts to feel that the people of China are slipping away from his grasp of power because the economic situation is difficult, he could easily use an outside distraction to try to rally the country behind him.
That is such an interesting point, and it's one we've seen happen. I mean, recently, too, in terms of taking that sort of action. But does that make you concerned about America and the West's readiness to deal with a more aggressive China then, if that's sort of the attitude that Biden has at this moment?
Well, I think part of the reason that Biden goes to these summits and travels around the world is to start laying the groundwork for how we and our allies would work together to counter an aggressive China in the South China Sea, and particularly in regards to Taiwan. So, you know, I think we're not there yet, and I think certainly there will be differences if that happens in how the Europeans react, how the Americans react, how the global South reacts. But I think part of Biden's purpose in these diplomatic trips is to start building the framework for a comprehensive way to combat China's aggression.
And would you say that coming out of this, like, okay, Washington has definitely learned the language of the global South? Are you confident in that?
I think we're getting there. I mean, certainly, I think the Biden administration is taking a different approach to the global South than previous administrations have. It remains to be seen if it's effective. I mean, remember a year ago at the G7, they pledged $600 billion to help infrastructure in the global South. And yesterday or this weekend, another big pledge at the G20. You know, a lot of times these pledges are made and then sort of fizzle out. So we'll have to see what actually happens and if there's follow-up.
I would love for you to comment on the approach to Ukraine, because on one hand, they did reach a consensus. On the other hand, it wasn't as strong of a language as Ukraine would have hoped for. What what does this mean moving forward?
Well, I think there would have been, I think, a very serious debate within the Biden administration and his national security team over, do we sort of boycott this language because we think it's not strong enough, and I'm sure they did not feel it was strong enough, or do we sort of lower our expectations a little bit and join with the rest of this global community, the G20, to put out a solid, unified statement? And I think the decision would have been made at the end of the day to meet these diplomatic needs going forward that we were just talking about, that it's more effective to be on side with all these other countries than to create a rift over the language of this declaration.
What do you think it also means for the United States' approach to the Ukrainian defense moving forward, especially because if you look at what's happening in the U.S., there's their own potential for a government shutdown just really weeks from now?
Well, exactly. I mean, the United States Congress is basically, has to deal with government funding. I think we probably are looking at a shutdown in the coming weeks. But there's also this move that you allude to in Congress of reduced levels of support for the U.S. assistance to Ukraine. I think that level of assistance is still pretty solid, certainly in the Senate and certainly from the White House. But there's a growing group of representatives in the House of Representatives, probably about 100, who think that we have done enough for Ukraine and will push hard during these budget negotiations to cut off aid or to reduce aid to Ukraine.
Our very big thanks to Lou Lucan of Signum Global Advisors. Remember, Lou is the former Deputy Chief of Mission at the U.S. Embassy in London. Now, coming up, some of the biggest multi-strategy hedge funds are faltering. We'll have more on that with Bloomberg's Hema Parmar up next. This is Bloomberg.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
These CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. JetBlue has traveled a long way from its startup days, but CFO Ursula Hurley says growth won't change the airline's quirky attitude.
At the end of the day, we view ourselves as a disruptor and a maverick in the aviation industry, and I'm really excited to play a meaningful role in that growth journey.
Watch Chief Future Officer, Wednesday on Bloomberg.
This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Shonali Bastick in New York. Let's get you now set up for the day. A quick look at what's ahead. Apple's latest launch event will be coming up on Tuesday. The new iPhone 15 and next-gen smartwatches will be unveiled. Fed officials in a blackout period, but we are going to get the U.S. CPI on Wednesday. PPI and retail sales will hit on Thursday. Plus, it's the main event. ECB rate decision and President Lagarde's press conference will happen on Thursday. Also, if that's not enough for you, we're also going to get the ARM IPO. It's expected to begin trading then as well. Then finally, rounding out the week with a China rate decision and a data dump. Shonali.
We're looking at some of the largest multi-strategy hedge funds that are struggling to keep up this year. They're trailing their own performance, their past performance, as well as other types of funds. And joining us now to discuss this is Bloomberg's Hema Parmar. What kind of performance are we talking about here? Because some of these funds are still up close to double digits. Some of them have reversed their losses, but it's looking pretty meager.
Right. So if you look at one of the multi-strat indices, since 2019, they were up about 7%, but this year alone, they're up less than 4%. So the numbers aren't super impressive. Citadel, for example, up 11% so far this year, not bad. Last year, they were up 38%. Balyasny and Schonfeld, they're on the other side of the spectrum. They together have returned less than about 3% to investors so far this year. Exodus Point up just 4% this year. These are not terribly impressive numbers, especially if you consider the fact that we are so far into the year. So there's only a few more months left to impress their investors.
Hey, Hema, why? Why is this strategy underperforming? Why has this year been so dismal?
Yeah, so there's a few reasons why. It's with this rising interest rate environment, it's been a little tricky for them to make money with the risk-free rate at about 0. A 7% return is pretty good, but when it's at 5, that number is less impressive. And then when you look at the stock market, well, a lot of the S&P's rally has been driven by just a few stocks, and so that environment doesn't really bode well for these multi-strategy firms that are often market neutral. These are strategies that perform well in environments that have more volatility, that have market dispersion, and this hasn't been quite that environment for them.
There's a lot of money that flooded into the strategy, but even more than money, there has been a lot of leverage that has been offered to help these strategies win these returns. What are the risks that investors are now pointing to as the returns are starting to come down?
Yeah, so there's a few things that people are really thinking about, investors especially in these returns. One is the risk of crowded trades. A lot of these funds, they've become very big. They may invest in the same sorts of assets, and so the risk of crowded trades seems to be one that people are talking about. Also keep in mind, these are very expensive funds. And so hedge funds were charging pass-through fees of as much as 7% last year for these multi-strategy funds. That really eats into returns, especially when the numbers so far haven't been that impressive. And then keep in mind the fact that these funds have lockups. So investors are stuck in these funds for many years more than they were before.
Now, when you look at their returns largely year to date, the performance is much more significant than you saw them muting down to October. And September has already started off kind of choppy.
Yes.
How anxious, when you think about the tone that people are taking when they speak to you, are they getting more anxious as the year goes through?
I think there is some anxiety because the macro funds haven't performed well. The multi-strat funds haven't performed well. The equity funds, some of them are doing okay, but when you compare them to the NASDAQ or to the S&P, the indices are doing a lot better. So I think there is some wariness. Whether it's so much so where some of these investors will actually redeem from these managers, I think they're looking at a few years. How has that manager been doing for a couple years in a row, or since inception? But there's a little bit more concern than there has been before.
Yeah, Hema, I was going to say on that point, I mean, last year was so strong for a lot of the macro funds. How fickle do you expect flows to be? Is this year enough to undo some of the stellar returns that they were able to squeeze out for their investors in 2022?
Right. So the macro funds, they've had an up and down year for some time, and they fall in investor favor, they fall out of investor favor, sort of depending on how things go. A lot of funds had been waiting for them to perform really well, and they had a couple years when they were doing so. A lot of these funds have significant lockups as well too. So the hedge funds these days, especially the big ones, they try to structure themselves so that they are not as susceptible to the investor whims. So if the strategy falls out of favor, if they're locked up for a few years, then I think the funds would think, well, okay, if we're better in a couple years, the investors can't leave, and then we can impress them again. So you're seeing a broader shift in the industry to locking up capital for as long as a fund possibly can, to be honest.
Our thanks thanks to Bloomberg's Hema Parmar. The amazing thing here, Danny, is that you are also looking at an S&P 500 that is down for the month as well. So even those long-only funds have some trouble ahead for them.
Yeah, exactly. And I can't help but think about so many of the non-long only funds, but got so married to positions last year where you basically just shorted everything. Or even forget that, Shonali, so many of the themes we thought would be present this year, whether it would be a strong China, whether it would be the year of the bonds, all of those calls have been wrong. We've had to rethink a lot of consensus this year in 2023.
We'll do a lot of rethinking this week, Danny. That does it for us today, though, for Early Edition. Surveillance is up next. We'll hear from European Economy Commissioner Paolo Gentiloni, among others. This is Bloomberg.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know. It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
We think there's more downside risk here as we go through the next few months.
When the yields move, they're going to move down and a lot.
The question is not whether things are declining, it's whether they're declining fast enough.
I think positioning has really changed, and you've seen that inflection in sentiment in the options market.
The bottom line is the fit. Once those goes down, don't fight the fit.
This is Bloomberg Surveillance with Tom Farrow and Lisa Abramowitz.
Good morning, Vietnam. Live from New York City this morning. I've been dying to do that since yesterday. This is Bloomberg Surveillance on TV and radio.
Sleep last night practicing.
Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market positive this morning by 0.4% on the S&P 500. That was quite a news conference, TK, over at the G20 from the President of the United States.
Those of us vested in the debate, and I did not serve in the military, I want to make that clear, but those of us vested in it,
there was a conflation of events there that I would suggest spiraled out of control, perhaps. I don't want to overplay it, but I believe there were reports they shut down the press conference early. This is the president in Hanoi. That's always fraught with emotion. And clumsy is the operative Monday
word. Yeah, maybe
word.
Clumsy is the right word. AMH is going to join us here in New York City, actually, a little bit later this morning. So looking forward to that conversation, Tom. Pushing ahead, we've got CPI on Wednesday, retail sales on Thursday. The Federal Reserve entered a quiet period over the weekend into their decision next Wednesday. Tom, we've said this a few times over the last week or so. Rate hikes on ice. Can that data Wednesday, Thursday change their story?
This can be well to change the story, but I think you got to stagger to ECB. I'm sure we'll cover that under surveillance and through the program today. And the answer with the ECB is, and I'm going to state this boldly, never for Americans has a Lagarde press conference been more important. I think I can go out on a limb on that.
ECB. Thursday, Tom.
Yeah.
On Thursday, a little bit later this morning, actually, about 10 minutes from now, we'll catch up with the European Commissioner on their new forecast. And their forecast, Bramo, seemingly heading in the wrong direction.
Stagflation, basically confirming that this is led by Germany going into recession this year, and that's going to slow growth at the same time that inflation is sticky. So that leaves a question for the ECB. How do you pair your singular mandate of inflation with a subtle dual mandate of trying to support a region that's not quite flat on its back generally, but not in a great position?
We're going to have Gianelloni of Italy with us here in a moment to talk about Northern Macedonia 1.
Okay. Okay.
The former prime minister scheduled to be with us, and he was one of my most important conversations of the year. Lisa, I didn't know this. Let's bring it up here. COVID nominal GDP. This is from the beginning of the pandemic. United States, with all that stimulus, up 24% in total. U.S. up 24%. In euro, as you mentioned, Lisa, really stagflation, up only 8%, one-third as much.
There's a long-term question around whether the U.S. will actually retroactively be seen as doing the right thing with pumping a lot of money. Perhaps the scale and at the end a little too much, but still a better basis to come back from than Europe. But then does it leave the ECB in the same place that the Fed is in right now, which is changing their tone? I mean, this is a shift toward flexibility because right now it's unclear what the bigger risk is. The downside risk to the economy or the upside risk of inflation not going down.
And that is the EM dilemma, and it's always a tough one for any central banker to have to face. The BOJ, Tom, bit of pushback there. Perhaps we're having a real conversation about a credible policy threat, which is to shift away from negative interest rates by the end of this year.
Yen in stronger yen, 147 to a 146 handle. These are not big moves, but yet there was that whisper, and it wraps around. I believe this weekend there were 47 articles in the zeitgeist on China. I lost count at about 40. I think The Economist alone had 6 articles, and Bloomberg, of course, was some wonderful work out of Hong Kong. But the bottom line is, it's just there. It's over there. It's distant, but the pros tell me pay attention.
You could have taken your pick over the weekend. You could have done a Giants Cowboys. You could have talked about the US Open. You wanted to talk about Italy, North Macedonia.
No, I was riveted.
3 minutes into the show.
Well, not 3 minutes into the show, but what are they playing for? What is EF? Is it EFL?
To qualify for the Euros next summer. That's what they're playing
for.
In the
Tots,
no,
this is a national team.
The Tots aren't in this. Okay.
Okay, this is a national team.
Let's save this for the commercial break.
Is this for the World Cup?
Equity futures on the S&P. No.
Okay.
Positive by a third of 1%. We're elevated here after a week of losses.
How about those Giants?
Into the bond market. Yields up by a couple of basis points. 428.80. 40-0. New York sports right now. Giants, Yankees. Lisa, I know you're a Jets-Mets fan.
No, actually. It's Mets-Giants.
Oh, that's an odd mix.
Yeah, it's
that's
very
odd. Aren't the glory supporters usually just sort of Yankees, Giants?
Yeah.
The long-suffering fans of Jets, Mets, that's how it works?
That's typically how it works.
So you barbell?
Yeah, barbell.
Oh, good.
It's basically,
Smart.
treasuries and tech stocks. Anyway, just to give you a sense of what we're looking at this week, we talked about how it's a big week of data. We also are looking at Apple setting to unveil the iPhone 15 and the next generation smartwatches at Wonderlust, which I'm sure you're going to be citing frequently in terms of the name. Wednesday is U.S. CPI, a real focus here on core CPI. Headline CPI is expected to actually remain sticky or tick up on the heels of that 9% increase in crude prices during August. But do we see that core continuing to come down, which will give the Fed reprieve to pause and maybe just stop hiking? And Thursday, ECB meeting, as well as PPI and retail sales in the U.S. and the deadline for the UAW to potentially strike against the big three in Detroit. More on that later. The ECB very much front and center, though, I would say. And Tom and John, was what you were talking about earlier. These new projections from the European Commission setting up the dilemma that the ECB is going to have to face off with in just a couple days.
And they've got to address that in the news conference a little bit later this week, led by ECB President Christine Lagarde. Joining us now is Marvin Lowe, Senior Global Macro Strategist over at State Street. Marvin, good morning to you, sir. It's wonderful to have you with us on the program to kick off the trading week. CPI a little bit later this week. We get retail sales as well. Marvin, once we get to Friday, what do you expect that data to look like?
Yeah, I mean, I think we're going to get a continuation of the positive trends with the core data. Certainly PCE raises the risk that it might be a little bit of an upside surprise. But kind of having said that, given where we were in the summer, I think we're moving in the right direction. The consumer remains strong, so there kind of continues the challenge that the Fed has in terms of a strong consumer and it making it harder to get towards those inflation goals.
I look, Marvin, at the idea of taking strategy or economics and having a conviction and belief. I love your phrase, painfully neutral. I mean, there we are, treading water here. Do you have conviction where you can be in the market? Are you convicted to a correction, or do you got a gloom bear market out front?
Yeah, I mean, we need a conviction when we approach our portfolio selection process ultimately. In terms of playing the market with regard to the choppiness around that conviction, I think it makes it to a certain degree harder because certainly we're going to have volatility in the markets, but it's going to create opportunities if we believe in ultimately that conviction. I do think that the recession risks remain out there, and the higher for longer conversation becomes a harder landing, particularly when we look at kind of some of the spending headwinds that begin to come into the market next year. And then, again, opportunities around that.
First study I did this morning, Marvin, was a Bloomberg Financial Conditions Index. I went way back, 06, 05. 11 ratios folded in there, I believe. It's a toxic brew. Yep. And the answer is we are accommodative. Are we painfully accommodative for central banks like you're painfully neutral?
Well, I think we've got the policy divergence that's starting to emerge globally, and it's making these conversations interesting for us in the macro space, but it's really showing the challenges that all the different central banks have. It's hard to say that the U.S. is incredibly restrictive, just given where the economy is performing, whereas you see that transmission mechanism making its way much more readily into the European economies and certainly the economies around the Antipodean. So, you do have kind of these divergences, which is really the challenge that we have going into the end of the year and thinking about policy going into next year.
And then understanding also the interrelationship between some of these divergences. I think of the Bank of Japan over the weekend raising the possibility of understanding the need to abandon negative yields and even move away from yield curve control as soon as later this year. This is a new kind of time frame. Does that shift your understanding of where U.S. yields should be, given that, yeah, there is this divergence, but there's an interrelationship between these global markets?
Yeah, I mean, that's significant. The view that Japan is finally in a position to make a longer-term decision, reversing something that has been, a decades-long policy, is significant within the global landscape, particularly when you look at it from the U.S. perspective and their participation in the Treasury market. That's a conversation that we started to have in early August, which now comes to the forefront again if they're not as accommodative, for sure.
Morgan Stanley came out and said that they actually have conviction that yields are going to come down and to remain bullish on U.S. bonds. How much do you push back against that? How much do you feel like the stickiness that we're seeing in yields is going to be really the new normal?
Yeah, I mean, I wouldn't be playing a significant decrease in yields at this point in time. I do think, again, a recession is going to drive that type of conversation. But, again, that painfully neutral type of view. Kind of having said that, where valuations are, I don't mind the income, quite frankly. And I still think that you could think about curve steepeners, but you need to do it more tactically than just looking at a 2s10s perspective. You got to look at how long this thing might take and whether or not a 530s view makes more sense. But just simply owning treasuries in an environment where inflation is below that yield is a decent return.
Are you saying pick up the front end, Marvin, or are you saying go out the long end?
I like the belly more. I like the belly more.
Okay, so the 5 to 7 year portion of the curve.
Yeah.
Does the same apply to credit? Because we had a lot of credit issuance last week, and the bulk of that was quite short-term stuff, Marvin. I just wonder what kind of signal you take away from that issuance.
Yeah, I mean, it's opportunistic for sure. The fact that the liquidity is in the market is ultimately a concern. Corporations are taking advantage of that. I still think that credit is a challenge. If the short end becomes a risk, certainly high yield has a greater risk associated with that. Really kind of getting past the choppiness that might evolve over the next 2 to 3 years is something to be cognizant of.
Marvin, thank you, sir, for the update from State Street. Marvin Lowe, thank you very much. The latest data from Bank of America, and thank you to the team here at Bloomberg for sharing this. The share of the high-grade corporate bond issuance with maturity of 10-plus years was just 10% in the last month to September 6th. Tom, the lowest since at least 2010. So the companies coming to market are issuing really short-term stuff. The belief is that perhaps this is a signal that even the corporations themselves see rates coming in a little bit lower, perhaps in the future.
I got a huge opinion on this, which is I'm not qualified. Bramo, weigh in here on the wheelhouse, the Bramo wheelhouse.
Well, there are two ways to look at this. Number one, that this is where the demand is because people have more visibility in 5 years than they do in 10 years. But the second thing is these are companies that are not planning on paying the rates that we're seeing right now for a longer term. They are looking at short-term financing that they can then refinance into much lower rates down the line. And that's sort of how
move. Are the big companies like Apple precluded from gazillion-dollar offerings?
Apple's not prohibited from anything, but why would they want to do a gazillion-dollar offering? If you think about it, they've got gazillion dollars of cash just sitting there. So if they've got to issue it up at that kind of yield, I don't know if they can. Why would they want to?
Busiest start to September issuance on record. And pushing back potentially, as Lisa mentioned, and I did as well, Tom, against this high for longer story at the Federal Reserve.
I read the strategist John Steinbeck this weekend, and it's about an August of our discontent. I'm sorry. It is a gloom out there. Can we get over the gloom right now? You've mentioned this,
We're doing
John.
August again.
Yeah, we're in August, and we're into September on this historic September 11th. We'll talk about that through the show.
Right, okay.
And, John, the bottom line is we've got a market drawdown of 3%. It's terrible.
I've said no drama a few times, yeah. It was ugly at one point in the middle of August. It felt worse than that, Tom, but yeah, it's got better since then. For sure.
Drawdown, 3%.
Drawdown. Just engage the mic a little bit more. It always helps. There you go. It's on.
Got it.
Good stuff. Coming up next, Paolo Gentiloni, EU Economy Commissioner, is going to join us on the latest forecasts out of the Eurozone. And the latest forecasts out of the Eurozone, not fantastic. They've had to cut those all over again. Is stagflation the risk or the reality for Eurozone policymakers? We'll have that conversation in just a moment. If you are just tuning in, equities are positive here by 0.3% on the S&P 500. Yield shaping up as follows by 2 basis points higher on a 10-year, just short of 430 at 429. Live from New York City this morning. Good morning.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
A multi-trillion-dollar industry. There's a lot of ground to cover.
A record year of growth, hand over fist all year.
We're just getting started.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
If you're worried about stagflation, it's Europe and it's the UK where the threat is highest. And it's a really tough situation for the ECB. If the ECB wasn't a single mandate central bank, they probably wouldn't hike. I've put a 55% probability that they end up by hiking, but it's that close, John, as to whether they should hike again.
It's a tough one, a tight call. We're right down the middle. That's the split in our survey here at Bloomberg. Ahead of the ECB on Thursday, that was Mohammed Al-Erin of Bloomberg Opinion, and of course Queen's College, Cambridge as well. Looking over to Europe, not just for the ECB on Thursday, but also the latest forecast from the Commission. This is the outlook for growth in the 20-nation economy, the currency bloc. The outlook looks like this: 0.8% growth for 2023 compared with an earlier forecast for 1.1% growth. If you're looking out to next year, similar cut, 1.3% is the forecast for next year. The question, Tom, for me at least, given what's happening with China at the moment and the slowdown they're experiencing, are they vulnerable to downside surprises, even with that resetting of the bar, Tom, lower in the Eurozone?
This is the global feel that we got from the IMF. And at that meeting in April, John, the three of us sat there stunned when Georgieva and her economists looked out at a 5-year combined global slowdown, not just about China. And we've seen some of that follow on in Germany and now in these EU markdowns today.
Even back then, though, Tom, I don't think we fully understood, realised, appreciated the gravity of the slowdown in China off the back of the reopening.
I agree. Oh, yeah.
What was that, spring of this year? That wasn't really a feature, Lisa, of the overall conversation.
Especially given the fact that Germany is going into contraction and they're arguably the most exposed to China and the reopening that was supposed to be incredible that we didn't really get. There are a couple of questions here. Number one, what does the ECB do with this? But number two, what does the European Commission do at a time where it's more expensive to borrow, more expensive to spend? And there has to be some sort of policy shift in terms of where the mix of business is, where the generation of income for this block really is going to come from.
Rock and a hard place, which is why we saw 106 on the euro against the dollar just last week. Right now, 107.28. Let's go through the price action and have a sneak peek of the rest of this week. We've got CPI on Wednesday. On Thursday, we've got retail sales. No Fed speak going into the decision next week. We're in the quiet period off the back of all the Fed speak you've got last week. So if you're not sure where the Fed stands after last week,
go read those.
I can't help you. I really can't help you. In the bond market, yields are higher by a couple of basis points, 428.80 on a 10-year. Equities are higher by a third of 1%. I want to finish on foreign exchange. I've already mentioned the euro. I want to talk about the yen. Dollar yen, it's a move of about Euro looks like this. It's not the time to think about a stagflation framework, according to the EU Commissioner, Paolo Gentiloni, just moments ago on this programme. The euro positive, just slightly stronger against the dollar, 107.30.
You really pushed against it.
Big time.
Yeah.
Yeah.
We're not stagging.
We're not stagging.
Okay.
Sort of what he said.
Under surveillance this morning, the dollar weakening against the yuan and the yen. China's economy showing signs of stability as credit and CPI improve. While in Japan, the BOJ, according to an interview with Governor Ueda to local media, Tom, considering ending its negative rate policy, there is a basic hurdle, which is wage growth. If wage growth remains sticky into year end, then maybe we can do something about negative rates.
They're getting used to inflation over there. It's 3% inflation roughly, and that's a new feeling for the people of Japan. And I would suggest a lot of this is away from waving at mountains at Jackson Hole and much more about the millions of people in Japan going, wait, prices are going up.
Yeah, this is a change.
Whole new feeling to it.
For multiple generations. Treasury Secretary Janet Yellen saying she's, quote, very confident the US can achieve a soft landing. Yellen making those comments on her way back from the G20 summit in New Delhi, India. The question I've got, Bramo, is this Janet Yellen the economist or Janet Yellen the politician going into 2024?
Increasingly difficult to say, especially because she has been really discussing the soft landing, and she is political. She's been acting politically. I would say this fact that she's saying this doesn't necessarily give a lot of people that much comfort. I think there is more unease with the soft landing narrative that was sort of the de facto understanding a couple of weeks ago, and suddenly more people are starting to push back. So her coming out and saying that probably will make all the many more people skeptical.
The prospect of re-acceleration and all that bad stuff, apparently. Let's finish on sport. The US Open coming to a close. Coco Gauff earning her first major title. Novak Djokovic winning his 24th. Djokovic, 36, the oldest man to win the US Open. 19-year-old Coco Gauff, Tom, the youngest American to win the title since Serena Williams did it back in 1999. Age 17.
With all the distractions, it was a glorious ending. I could hear the applause all through, the walk up and
from Queens, over to Manhattan.
No, the windows, people watching it, and there was cable TV issues in New York, but people watching it, and for hours and on end yesterday, Medvedev, put up a big fight, and
there was a moment when Novak wavered in the second set, but he quickly re-engaged and managed to find some energy from somewhere. Tom, you mentioned maybe the blackout on cable and Spectrum with ESPN. Yeah. Has that been sorted for tonight?
I don't.
Bills Jets?
No, Bills Jets. This is in New York. This is Charter, which has Spectrum, and a lot of people like me don't have it.
Did you get the message basically saying, we know that there are some changes, so you get Fubo? Did you get that?
That's from Spectrum, right?
That's from Spectrum, where basically they're trying to...
So you've still got cable?
I got the same email.
Have you still got cable?
That's from the pandemic when we had to.
I got the Zenith with the rabbit ears. It's great.
You're still using
the
aerial. I used to have one of those in my bedroom.
There's a skyscraper next door, and I've got to get the rabbit ears straightened out.
I had the same thing as a kid, yeah.
Yeah, good same thing.
Try and watch the Champions League football on a Wednesday night.
Bills Jets tonight?
Play around. Yeah.
Yeah, Larion's at the 50-yard line. He's on a 50-yard line.
I'm not sure if he's at the Jets game tonight.
He's got to be.
He's feeling better about this season, though. He was questioning the choice to go to Aaron Rodgers as quarterback, but he's committed to the success of the team. It's good to hear. Congratulations, Mohammed.
We welcome all of you
for engaging
around the
team.
world, and particularly across this nation. Now, a discussion on the American economy and the reset into autumn. We do this with Greg Dacko, who's been very good, to say the least, in forecasting, chief economist at EY. Greg, I look at the summary of your note, and to me, the arch question not being asked right now is, with China challenges, do they put a disinflationary or outright deflationary impulse on global inflation? They're so interconnected with so many economies. Can we see a China that will they or can they impart disinflation on the rest of us?
Well, I think the important element at this stage is that we are facing a U.S. economy that is showing signs of a slowdown, and we're seeing the same in Europe. We just had the EU Commission downgrade their forecast. And I think if you look at what's happening in China, the ongoing slowdown in economic activity that's being broad-based across the manufacturing sector, the construction sector, is going to have a negative effect on the region in Asia, but also on the rest of the world. Now, the effect may not be as large as some people make it to be. We know that the exposure, for instance, of the U.S. to China is relatively limited, but that will represent an additional drag in terms of economic activity. Whether it leads to greater disinflationary pressures, I'm not quite sure yet. The U.S. still imports a lot of its imports in U.S. dollars. So the effects are generally limited.
There are three issues here. There's China and its domestic effect. There's China and its influence on Europe, which we were just talking about is flirting with stagflation, but don't call it stagflation. And then its effect on the U.S. I want to question its effect on Europe and whether we've overpriced the risk of some sort of declining Chinese growth, given sort of peak pessimism that we keep hearing about, and how it feeds into the European economy.
No, I think we have to be conscious of the fact that it's not just a cyclical slowdown that matters. It's the structural slowdown in China that matters, because the longer we have an environment where China is no longer growing at 8, 9, 10%, but instead growing at 4, maybe even 3%, that becomes a greater drag on the global landscape. It affects, of course, the Asian economies that are heavily dependent on imports into China, but it also affects the rest of the global spectrum in terms of weaker economic activity. And we have an environment, again, where global growth is slowing. It's not retrenching. We're not seeing any massive pullback in terms of private sector activity, but we are seeing slower growth across the major economies around the world. And China, that is not growing as fast, where authorities are being much more careful in terms of the amount of credit impulse they put into the economy, becomes a greater drag over the rest of the world.
How does that assessment stack up with what's developing in the commodity market, with crude, with iron ore?
Well, we are seeing this paradox where we have an environment where we're seeing oil prices on the rise, but we are seeing, again, this global growth environment that is slowing. And I think that brings us back to this issue of supply. We're in a world where we continue to see that supply is a key driver of economic activity. In this case, we're seeing both Saudi and Russia talking about further cuts in terms of production, prolonging those cuts, which drags the potential supply and therefore puts upward pressure on oil prices, on commodities. We're seeing that in other sectors as well. Housing in the U.S. is a key example.
I'm struggling with this one because U.S. output is close to all-time highs, and it's not just crude. If it was just crude, I think I'd hear your argument and say, yep, let's move on. But it's iron ore as well. Vale talked about iron ore demand, saying that the outlook for the year is pretty decent. My words, I'm paraphrasing. When you look at iron ore, can you get the same assessment that you've just mentioned to us on, say, crude?
Well, it depends a lot on the demand for steel, the final demand for steel. So if you see the effects of stronger construction around the world that are still going strong, where you also have a supply shortfall, and you're seeing that pull because there is insufficient supply, that feeds into the demand and perhaps puts the upward pressure on the final demand, which feeds into the commodities prices. So this type of economy is a very difficult type of global economy to analyze. I think you have to be very careful with using the old playbook of it's just a demand story. You have to look at all the components from demand to supply.
I want to go to October 6th and the jobs report in America. Nick Timmerose features a wonderful chart showing the decline in 3-month annualized to take 90 days, 3 data points of jobs report, and then annualize that out. Jason Furman at Harvard talks us up, as well as Dr. Alarian in an essay this morning. Is there a validity right now to 90-day annualized math showing this abrupt decline in job growth in America?
Well, I think that's really the key feature. I think that's the key element that we have to be focused on in this business cycle. The key reason why we haven't seen a retrenchment in U.S. economic activity is because the labor market has remained robust so far, but it is cooling. We are seeing that job growth has moderated, 150,000 jobs per month over the last 3 months. We're seeing lower hours worked. We're seeing lower diffusion of job growth. The labor market is cooling.
Okay, but the vector of 3-month annualized clearly shows we're going to get to what David Kelly at J.P. Morgan calls a negative jobs growth.
I think
is that sooner rather than later?
At one point, we will see that. We have seen a pullback in hiring. We've seen a pullback in job openings. I think eventually we will see some job losses in the coming months. It probably won't be as strong as in prior recession environments because employers are keen to retain the talent they spent so much time hiring, training, and retaining. But it's not going to be just steady as she goes, only positive job growth numbers.
Basically soft landing, which is what you're describing. And how much is that predicated on the idea that the Fed will start to cut rates by mid-year next year?
Yeah, I think a lot of the conversation will have to pivot towards recalibration of monetary policy in the coming months. It's not going to be a discussion that the Fed's going to be having right now. Right now, the Fed is focused on whether this is the terminal rate in terms of the federal funds rate. We do see the Fed being on pause over the rest of the year, and rate cuts not coming before the end of the first quarter.
There's a lot of noise between now and then, including some strikes, including the UAW strike. How much does that count into your projections? If there are strikes, if there is the labor market fighting back for a bigger proportion of the wages?
I think that's key. I mean, we are in this environment where I was talking about supply issues. It's not just on the goods side, on the capital side, but it's also on the labor market side. We have seen some positive developments in terms of supply. We've seen the labor force participation rate rise to all-time high when you look at the prime age participation rate. We are seeing that the labor market is gradually easing. We're seeing that tightness ease, which is a very encouraging sign. But if we have greater strikes, we know those can have a negative effect on employment. We saw it in the August jobs report, where the strikes of the Screen Actor Guilds, as well as some hotel strikes down in South California, had a negative effect on jobs. This could, again, be a weight on the economy and on the labor market.
It could be a shocking one. Greg Dacker, thank you, sir, of EY.
Thank you.
TK, more disputes between unions. It's ongoing. UPS, we escaped that. American Airlines, we escaped that. Will we escape the potential strikes at Detroit's Big Three?
Yeah, Vallier this morning, Greg Vallier makes a nice partition of it. The tradition is to strike against one company to husband the strike fund so you can go longer. He has a math that if they have 150,000 people go out, I believe they go 3 months.
Well, yeah, the concern here is twofold, right? On one hand, there's the economic impact. It's, I believe, a $5 billion hit to the economy and to these three automakers for a 10-day strike. That's the estimation. There's the hit to President Biden and what it does politically to him if they actually do strike and there is some sort of hit to the economic trajectory. And then there's this question of, are their wages fair? I mean, if you started at some, $30,000, $39,000 annually, that's sort of where it annualizes out to $67,000 in the upper end. Is that a fair wage, given the inflation, given some of the fixed costs?
Can the union get rid of the name Stellantis? Can they work on that?
I still can't get my head around it.
I'm like, it's formed by committee. It's like Primerica.
Sounds like a beer.
10 days that Bramo mentioned, pushing Michigan into recession. That's from the Anderson Economic Group, an economic consultancy based in Lansing, Michigan. Some stunning numbers from them over the weekend. Thank you to David Welch for putting that story out. Coming out, Tina Fordham of Fordham Global Foresight on the G20. And Tina's going to explain, Tom, what on earth a lying dog-faced pony soldier is. The president took some time.
She's not going to show up. She's listening to us right now.
The president took some time to explain that. From New York, this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
has his hands full right now. He has overwhelming unemployment with his youth. One of the major economic tenets of this plan isn't working at all right now. I'm not happy for that, but it's not working. So he's trying to figure out, I suspect, I don't know, just like I would, trying to figure out what to do about the particular crisis we're having now.
A rambling news conference from the President of the United States in Vietnam addressing the challenges facing President Xi Jinping and China. Tom, I think we covered just about everything. Ended in the most bizarre way, mid-sentence. Some kind of aide off to the side, Tom, just seemed to cut in and end the news conference. And then the President was asked another question, tried to re-engage with the microphones, and the microphone had been killed.
For those that have not gone through this, the Good Morning Vietnam part was painful. This is Barry Levinson.
That's how it started.
Yeah, this is Barry Levinson, who made that movie for Robin Williams. And Levinson, who wrote for Carol Burnett, among other things, and did a whole bunch of very highly regarded movies, captured the 60s. And part of that was the profound tension in the movie of a war. And I was sort of shocked to see the president in Hanoi
making jokes about it?
Making a joke or just stumbling over it. I thought, maybe I'm a little too close to it, but,
No, it was odd. It was odd, Tom. Yeah. I think for most people they agreed it was an odd moment over the weekend, Sunday morning. In the evening, of course, in Vietnam.
Yeah, I mean, there's no question about it. And there we are with the president on his way home, I believe, through Alaska, and will arrive here at some point here on September 11th. Joining us right now is Tina Fordham for a brief, geopolitical strategist, Fordham Global Foresight. Tina, we could do a 3-hour conversation with you right now. The world is so topsy-turvy, it is of shock. Are we at a point of instability, or can diplomacy and dialogue lead us to a stable outcome?
Thanks, Tom. Well, it might surprise you to hear me say it, but I actually think that the G20 meeting, for all of its kind of interesting quirks and shifts, highlights how in a topsy-turvy world, most leaders, with the notable exception of Chinese President Xi, who declined to attend, need these gatherings, and they are important. On the one hand, they're an opportunity for what I'm calling geopolitical hedging, a chance to, kind of opportunistically take sides or take part in certain aspects of agreements, like the India-Middle East transport corridor, very interesting development, and extending a seat to the African Union, which was a big India initiative. So, we used to not look at these kinds of international talking shop type of gatherings at all for their impact on global markets. And now they're a little bit of a crystal ball, I think, or maybe something more substantive.
I look, Tina, at the more substantive and where we are right now. What should be the approach of America with 1, 2, 3, 4, 5 balls in the air? How do we prosecute a foreign policy, particularly with China?
Well, there's the old saying about, watching your enemy and waiting till he makes a mistake. Now, China and the United States are not enemies. We used to be frenemies, and now we're something in between. But I do believe that President Xi's kind of snub to India, as it really seems, in not attending the G20 was a strategic own goal for China, coinciding, as it happens, and I was in Asia last week talking to investors in Hong Kong, with this flurry of sort of peak China stories and a real decline in investor sentiment around China. Now, the markets always run faster than global policy, and I think the non-appearance at the G20 by President Xi is a perfect illustration of that. He really should have been there, kind of bolstering China's commitment to international negotiations.
Well, in his absence, President Biden said that the China economic crisis, and that was the word that he used, made an invasion of Taiwan less likely. Do you think that that was helpful, that that was something in the playbook of his strategists, or whether that was something more off the cuff?
Well, I think without seeing into the president's mind and knowing something about his form, Biden tends to call it as And so if that's off the cuff, then, that is how it sees it. China economic crisis, peak China, as we more likely to hear in investor parlance. Part of that sentiment, though, right? And Biden is taking a pretty conventional wisdom view, I think, in saying if they're having economic difficulties with Country Garden and with the property bubble and other considerations, the kind of failure to launch of the post-COVID boom that was expected, they're less likely to invade. Actually, history, tells us that sometimes a decline can lead to more willingness for opportunism abroad. I think we should take Biden's comments like this, though, with a grain of salt, to be honest. I mean, more important in terms of U.S. signaling are visits from people like Gina Raimondo and Janet Yellen.
Yeah, there was also the other side of this, where China was protesting the U.S. hosting the 2026 G20. What did you make of all of the meetings, the focus on Vietnam, the focus on India? How much of that is geared toward, yes, trying to shore up allies, but also trying to shore up new manufacturing sites in a material way?
That's exactly what it was about. And in this sense, the U.S. is pushing on an open door in terms of the regional appetite in Asia for stronger partnerships, bearing in mind that President Trump withdrew the U.S. from the Trans-Pacific Partnership Agreement. You could interpret these kinds of deals and the elevation of Vietnam to a stronger status as a trading partner as, kind of making up for that. So, public opinion data has always made very clear that China's neighbors fear both China and Japan. Now they fear China a bit more. And so the U.S. is in a strong position to develop these kinds of relationships. And India, I think, gets a lot of points for the way it handled the summit. And things like the communique, which analysts were concerned, or the journalists highlighted, would there be a communique? That was all about making sure that President Modi of India, Prime Minister Modi rather, didn't end up being the first leader of a G20 summit who didn't, end up producing a communique. So very interesting signaling going on as we rebalance the global system.
Tina, the president will go to Alaska today. He will not be here in New York City. He won't be in Virginia. He won't be at the events in Pennsylvania to mark the 22nd anniversary of the attacks on 9/11. Tina, I wonder what your thoughts are on the appropriate way for a president to mark an event like this one.
I think it won't be lost on people. And, like a lot of you in the audience and in the studio, I was in New York on 9/11. It's a solemn and a somber occasion, a milestone in American history that really did change the course of U.S. policy in a number of ways. Frankly, it's surprising, I think, that the president isn't there. Maybe it reflects a desire to move on, but you guys will. What do you think? I think it's a little too early to move on.
Tina Fordham, thank you for those comments. Tina Fordham today on this September 11th. John, do the math, 22 years. And I believe the two events of my life where time stood still was the assassination of President Kennedy and 9/11. 1941 plus 22 gets you to 1963. And I dovetail that from Pearl Harbor to JFK, and now we're 22 years on from 2001. And Tina, I thought, was really elegant.
I wonder how you think about that then, Tom. How to transition to marking this occasion in a different way, the absence of the president on a day like today from the traditional places, locations we'd expect him to be.
There's some nice notes out this morning on this, and this is not the first time a president has not attended one of the three sites in Pennsylvania, here in Manhattan, or at the Pentagon. Dr. Biden will be at the Pentagon today, I believe. But it's not the first time. There's been time where presidents were on the lawn. There was some other events as well. I believe Bush and Obama I would put there. But nevertheless, he's on a business trip, and he's on the way back, and he will meet with first responders at Elmendorf in Anchorage, Alaska.
There will be a series of moments of silence through this morning. We will take all of them right here at Bloomberg on TV and radio on the 26th anniversary of the September 11 attacks.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Are you renewing or taking out a new car insurance policy this year? Then expect to have to pay a lot more. The reason? Car insurance claims costs are rising rapidly, and the US's largest car insurance company, State Farm, recorded a $13 billion underwriting loss in 2022. Blame high used car prices. Vehicles are a lot more expensive to replace than the insurance company calculated when they wrote the policy. Repair costs are rising, replacement car parts are more expensive, and modern cars come stuffed full of electronics, which means they're more expensive to fix. The thing is, car insurance actually fell in the early parts of the pandemic because we were all driving less. The problem is, as we returned to the roads, people began driving more recklessly and therefore getting into very serious accidents. Cars are also being stolen more frequently. So if you drive a vehicle that's very popular with thieves, like a Range Rover, Hyundai, or Kia, then you can expect your premiums to rise even more. Car insurance prices are rising faster in the UK than in the US, where insurers have to ask states for permission to grant increases. Places like California have been reluctant to grant them, but increasingly insurers are winning the argument that their losses are unsustainable. So expect your car insurance premiums to rise, maybe a lot.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Think there's more downside risk here as we go through the next few months.
When the yields move, they're going to move down and a lot.
The question is not whether things are declining, it's whether they're declining fast enough.
I think positioning has really changed, and you've seen that inflection in sentiment in the options market.
The bottom line is the Fed wants to slow things down. Don't fight the Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P 500 nicely positive here by 0.4% following a week of losses and pushing ahead to retail sales on Thursday, CPI on Wednesday, and the main event, Tom, going into the Federal Reserve a week away.
I take your point. I think this has not been said enough. There's a Fed meeting after the ECB meeting. It maybe has a little bit of import. Nothing's going to happen at it. It's a dead meeting.
It's a forecast as well,
It's a live meeting. But, I take your point. You got to get to the Fed meeting. There's some data in front of it as well. But are all eyes on November? I think so. I think we've just leapt forward to a November analysis.
The hawks on the committee aren't screaming hike in September. if you listen to the economists on Wall Street, those that think we get another hike, I'm thinking Andrew Hollenhorst of Citi, perhaps Mike Gapin of Bank of America, thinking that risk still exists. They're looking to November, Tom, not September. The Fed wants to be patient now, wait to see if there is further evidence of a re-acceleration of this economy, which leads to an acceleration again in inflation. At the same time, they've got subtle signs that we're seeing a labour market slow down. There's so many contradictions at the moment, Tom. Way more contradictions in the data now than there were 12 months ago, where it was just clean. Bright green light, hike.
Well,
things are a little bit different 12 months later, that's for sure.
Talks about the last mile. He talks about, we've got to go to the last mile. We've been talking about this for 2 years, that you're going to go from Stanley Fisher's ultra accommodative, super accommodative, through neutral, some form of restrictive. Dominic Constant has used the phrase super restrictive, and now we got to go the last mile. And there's like 3 narratives, 4, 5 narratives.
It's the toughest mile. Sarah House of Wells Fargo came on the show months and months ago and talked about how hard that last mile would be. Torsten Slock of Apollo over the weekend put out a great deck, loads of charts, showed delinquencies climbing, bank lending, I'm sure he did, you just didn't read it, bank lending down. And Lisa, if you just let that continue, this economy will slow down. That's the view of some people on the committee.
There is conflicting data, and you mentioned that. And I was speaking to one economist who said when you get conflicting data, this is actually typical of turning points. And when there is an economic shift, often things get messy. So what do? You wait and you average. The data still matters. It's not wrong. It's not that suddenly there's sort of this inaccuracy. It's just that it's not going to reflect things in a smooth line. So it makes sense for them to wait. The question is, where are the balance of risks for them? And that we just don't understand.
Well, we know how they've shifted, that's for sure. The balance of risks have shifted in a massive way. 12 months ago, the biggest risk for them was doing too little versus doing too much. And now, Tom, if you ask them that question, I'm not sure what the answer is anymore. Clearly, it's far more balanced now than it was back then.
And he's central banker to the world, and this is the world. To have the former Italian prime minister on this morning was a great honor. Mr. Gentiloni, he didn't mince any words. I mean, it is a slowdown in Europe. He wouldn't go very staggy to your brutal and rude question.
Can I just say that you've nailed it, though? Never mind my rude question. Yeah. I think you've been on top of this, Tom, for the best part of 12 months. Is Europe just returning to what basically it was plagued with for much of the last decade, which is just low trend growth?
Well, it goes back to the
not get away
60s
from
and
it?
70s. A German economist who came up with the phrase Eurosclerosis. And, I think on this August day where Mark Gurman's going to launch Apple products, basically monetary theory, there's directly linked to the fact that Europe's dictating what cord Tim Cook can use to plug in to the new iPhone. I mean, that's part of it. Regulation. Eurosclerosis is more about regulation and a business environment within Europe. Maybe it's there, maybe it's not.
This is what Europe's wanted for ages, Tom. They want to set the rules. They want to make the rules. Everyone else is looking to build a business.
Yeah,
they want to make the rules.
It's the American divide, the transatlantic divide.
That's the bureaucracy of the European Commission. Let's turn to the equity market. S&P 500 futures here up by 0.4%. Elevated yields higher as well, TK, by 3 basis points, 429.20. Tons to talk about in foreign exchange.
In foreign exchange, it's there. Also, the 10-year real yield published moments ago on the Bloomberg terminal, 1.95, migrates up 2-3 basis points back towards a 2 level, and it's that vacillation you do see in foreign exchange. Yen stronger. We covered that in the last hour.
Lisa, dollar yen 146.87.
Big question here about what's going to happen with the Bank of Japan. Ahead of that, we've been talking about the big week ahead, and you mentioned the Apple launch of the iPhone 15, which does come tomorrow. Very curious to see how much this offsets some of the negativity that we've heard recently, in particular having to do around with China and growth there, whether they can offset that with wanderlust. We will discuss. Tom will not watch. Wednesday, U.S. CPI coming out. People will not be talking about the headline figure, which is going to be buoyed by the oil and gas prices, but the core CPI, when you strip out energy, when you strip out food, what do you get in terms of how quickly it's disinflating?
Lisa, killer chart. For those of you on radio, it shows the quiescence there pre-pandemic, and then boom, up we go. What are we back, Lisa, about a third?
Yeah, well, we're back about a third, but as you were talking about, it's the last mile. And we're talking about some other components that are turning around, like housing and some of these other areas. Healthcare costs very much factoring into PPI coming out on Thursday, and retail sales we also get on Thursday. Some people expecting consumers to actually stop spending because maybe the savings is actually starting to run out. I'm sure we'll hear all about that. The ECB meeting, though, very much in the forefront of everybody's minds, just given the dilemma that was really laid out by the European Commission today. And John, I think that what we're seeing right now is an increasing ability to pause and an increasing ability to say, we can have patience and take a look at the data, and we're not going to hurt things and encourage inflation further. How that's different with Christine Lagarde and Jerome Powell, it's a different kind of conversation. It's a little less comfortable for Christine Lagarde.
Much less comfortable for President Lagarde for the ECB this Thursday. Joining us around the table, Christina Hooper, Chief Global Market Strategist at Invesco. Christina, good morning to you.
Good morning.
We also need to talk about union disputes, UAW, the Detroit Big Three. Can you tell me from your perspective, is that just a headline risk we're reading in the papers right now? Or is that a symptom of a broader, stronger, hot labor market in America that's going to lead to higher costs for some of these companies?
Well, I would argue that it's more likely the latter. And that's because we saw Walmart's announcement last week about lower wages for new employees. I think actually because the labor market has eased a bit, it's tight, but it's not as tight, that what we're seeing with the UAW is probably more of a rear view mirror issue than what we have ahead of us in terms of what I expect to be moderating wage growth.
You have a shingle from Cornell, which is, some would argue, the #1 labor economics program in the country. Good morning, everyone from Northwestern as well. This is not Walter Reuther's UAW, is it? Explain to us right now your view, Christine, with all your study at Cornell on the atomization of the American labor economy. Is it legit, or can there be a reunionization?
Well, there certainly can be areas, and we've seen moves in different industries towards more unionization. But the reality is that that is a function of the tightness of the labor market, and directionally, the labor market is getting less tight. And so I would anticipate we see less of this activity in the future. This was a very unique environment that we've lived in the last few years, and it really has opened the door to the potential for unionization. But I think going forward, it will be very specific industries where we see this happening.
Rear view mirror. To me, that's fascinating. The idea that you're saying that this is not going to be what we're going to see going forward. And so from your vantage point, what does that mean in terms of the last mile of inflation that we were talking about, and how quickly we can get back to the 2%, how much conviction you can have to go back into longer term bonds?
Well, the last mile is going to be hard, but I do believe that we are very much on that disinflationary trend. Not every data point is going to support that narrative, but that will be the case. And actually, I'll point to something that came out last week. The Chicago Fed economists put out a note utilizing their model. They anticipate we'll get close to the Fed's target by the middle of 2024 without a recession. Now, my opinion is it'll be a bumpy landing, but it won't be an actual recession.
So there are two schools of thought with this, and it's really highlighted by the Morgan Stanley view of things, and then the sort of Jim Bianco view of things, increasingly the JP Morgan view of things as they ratchet up some of their yield forecasts, that when we go back to something more normal, bonds will maybe have lower yields than they have now, but not significantly. Morgan Stanley is the lone bull, right? They're going out there. Matt Hornbach, who is a friend of the show, has said, no, he still has conviction. Buy now. This is the time to do it. Are you in agreement with that?
Well, I would argue it is so hard to market time, so that it makes sense to at least start to increase exposure now, even if one is not sure that we've actually hit the peak. I think this is a time to be starting to increase allocations.
The vector, we brought this up a couple times today. I'm not going to let it up. I think it's so important and timely to October 6th. And that is the vector of 3-month annualized non-farm payrolls. Wow, is that moving in a strident direction south? Can you frame a negative non-farm payroll statistic?
Well, I don't have a lot of negative things to say right now about the state of the labor market. What we have is labor force participation increasing.
Saw it, yes.
And we have wage growth moderating. That's what I need to see. Those are the two most important data points within the jobs report, in my opinion. Also, if we look at JOLTS and we see the number of job openings, they've gone down significantly, all pointing in the right direction to maybe not a soft landing, maybe a bumpy landing, but one in which we see a moderation in wage growth, one in which we see a moderation in inflation going forward.
Doug Cass writes in, raises an important question about the Detroit Three. Let me throw it at you, Christina, if I can. Deglobalization, doesn't it just give these workers in Detroit more power, more leverage over their employers?
Well, one could argue that deglobalization has an impact and serves to boost inflation in a variety of different ways, including potentially this way. But the counterbalance, of course, is technological innovation. So could we get to an environment in which we're a bit above the Fed's target in terms of inflation for the medium term? Yes. But I think the Fed's willing to tolerate that because we also saw inflation below target for some time.
Christina Hooper of Invesco. Heard that a few times, haven't we, Tom? A tolerance for a higher inflation story from the Federal Reserve. That was not the conversation in 2022. It was 2% is 2, and now it sounds a little bit more like what the former Fed Vice Chair Rich Clarida discussed, which is 2 point something.
Christina's colleague, Christina Katmany, stopped me cold before Mike Bloomberg introduced John Williams and Mike McKee the other day in a brilliant conversation. She modeled out 4%. 4% is a new level.
If you're just tuning in, well, welcome to the program. Sorry, Tom, I thought you were done. Equity futures on the S&P, positive here by 0.4%. Neil Dutta of Renmac writes in, finds it curious.
Never writes to me.
The consensus appears to be talking about a US growth slowdown as a foregone conclusion, despite having been dead wrong about growth for the last 3 quarters.
The humility, and I think you heard that with Christina Hooper, the humility that's in order right now with the 14 narratives. I mean, how many porridges is Goldilocks testing right now? Not 3, like 6.
Not
8.
Too hot, not too cold.
Yeah, I mean, this is it's a cliche. It's original territory. Can I tell you who the Detroit 3 are?
Go on.
They're not the auto companies. They're Gordie Howe, Al Kaline, and Bernie Sanders. Barry Sanders. Barry Sanders. That's the Detroit 3.
Okay.
Cass knows this.
All right.
Al Kaline chewed up Sandy Koufax.
We're talking about baseball.
Baseball. Al Kaline.
Dodgers.
Right field.
Versus Detroit.
I had his glove. I actually had an Al Kaline glove.
Koufax was Dodgers, right?
Very good.
Yeah.
Nailing that.
Okay, thank you.
Thank you.
Appreciate it. Keith Lerner of Truist Advisory Services is coming up at about 8 a.m., so about 45 minutes from now. We're going to be talking about a range of things, including the economic data this week, with CPI coming out in a couple of days' time, and it's on to retail sales on Thursday. I mentioned this a few times already this morning, but it's the quiet period for the Federal Reserve, so no Fed speak whatsoever going into that decision about a week from now, a week on Wednesday. Lisa, in the middle of all of that, big event this week, never mind UAW, we'll be focused on that later on. But the situation with Apple, after the week that they had last week, the pressure to get some traction with this iPhone 15.
Especially because people think it's actually going to change the needle, that actually John Farrow, who doesn't want to upgrade his phone, is going to actually want to upgrade his phone as a result of some of the changes. This is actually part of the discourse.
The fanboys wrote in over the weekend, very upset about the slowdown, conspiracy theories. Yes.
Oh.
Very upset about it. Very upset.
Do you have anything to say?
Not really.
Okay.
Futures positive. This is Bloomberg.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation
is going to cause China to invade Taiwan, and in fact, the opposite, probably that have the same capacity that it had before. But as I said, we're not looking to hurt China. Sincerely, we're all better off if China does what?
The President of the United States speaking in Vietnam, addressing the tensions between China and Taiwan. Live from New York this morning. Good morning. Equities right now on the S&P 500 positive by 0.4%. A lift in the equity market. Yields drifting higher by 3 basis points. Your 10-year 429.60. In foreign exchange, Tom, the euro just a bit stronger here, 107.24. Positive on that currency pair by 0.2%.
It's going to be interesting to see. And John, today we have a president traveling back from the Pacific Rim at about 4 o'clock our time this afternoon, maybe nearer to 5. He will honor and remember September 11th in Alaska on his way home. But before that is a modest note, John, and this is going to be early this morning. This happened maybe an hour ago. The president visiting the John Sidney McCain III Memorial in Hanoi. And this, of course, is part of our youth and part of our childhood of these prisoners of war in Hanoi, which makes even odder the clumsiness that we saw yesterday.
What did you make of that news conference yesterday?
I got to be careful here. You know, I'm like Anne-Marie Horton. I have the surveillance cork where Anne-Marie can go on about this with some authority. But I just think it's been a president who for months and months and months has been managed in his press conferences and his appearances, and he clearly showed up in Vietnam as anyone would, I would, tired from a strenuous G20 meeting.
Not controversial to point out how managed he was, because he talked about that himself in the news conference.
Yeah.
It's the way it was cut off, Tom. The way it was cut off was pretty strange.
Yeah.
To cut into the President of the United States is something that we wouldn't even do as journalists. So to see his aide do that was kind of bizarre, mid-sentence towards the end there, to cut in and kill the mics.
On the other side of the world, in Hanoi, and the president again traveling to Alaska and then home. Anne-Marie Horton now with perspective, with balance of power, and this is something she and Joe Matthew look at 24/7. I'm just going to cut to the chase. How's the president doing?
Well, I think if you look at that press conference, there are concerns because he was rambling. And to John's point of being cut off, it almost felt like the Oscars. If you were watching at home, the White House feed, you actually heard music over the president. So that's usually the cue to stop talking, even though reporters were asking questions and he wanted to answer. His press conferences are managed in the sense that you know if you're going to get a question, they choose 5 people, but no one's asking you to give your question up, what are you going to say? But of course, they have a list of people they're going to give questions to because they want to make sure there's a variety of journalists in the room that have different perspectives. What was interesting about that press conference, though, was the rambling. Weren't really sure where the president was going in some of his answers. He brought up at one point a John Wayne film, and he wanted to get to a quote in the film. I have not seen it. Maybe you have, where he talked about
John memorized it. I mean,
a lying
dog-faced pony soldier.
Yes, and he was saying that there are many individuals in the world who are that way, lying dog-faced pony soldiers when it comes to global warming. And it was just confusing for people to follow.
Did you get anything of substance out of that news conference yesterday?
What I got out of that news conference was that he is at least sticking to the tone when it comes to China, which is that he wants what he wants it squared away. He wants China to follow the rules. He wants it to be an up-and-up relationship. They're not trying to contain China. He said we're not trying to decouple. They're de-risking. Or that was Kamala Harris who actually said that in an interview. But this is the point of the administration this week. A lot of questions about China, and he said, I'm not trying to contain them. They just need to follow international rules of the road.
The former VP, or rather the current VP, says she's ready to go. That's new, isn't it, over the last week, to actually say that on a record?
Yeah, she said this to Associated Press and also to Margaret Brennan, Face the Nation. She was at the ASEAN summit. She was asked, do you feel like you are prepared for the job? In the AP interview, she just said yes. And then the interviewer said, well, explain to me how you feel like you're prepared. And then she caveated that with, there's really nothing at this moment to prepare for. Joe Biden's not going anywhere. But it did take some people by surprise, but how quickly she just said yes and stopped.
Well, at this point, though, the reason why people are grasping to that is because of the polls, is because of the concern about some of these rambles or some of these issues, not to mention what we're seeing on both sides of the aisle and other people who have been in service for a very long time and are being raised some questions about their health. At what point Do you start to hear with your ear to the ground a sense of who could potentially run instead of President Biden if this starts to get enough critical mass?
Well, at the moment, the Democrats are all rallying behind Biden, even though behind closed doors or there's whispers, everyone is concerned about his age. This is an individual, he'll be 83 next November. There are concerns about his age. No one is doubting, though, that he is going to run at this moment. I mean, and you see the push from the campaign. They're releasing millions of dollars in advertisements about this president. If he was going to step aside and there would be potentially a new candidate, I think you have to look to the governors, the executives almost of these states. You have Gavin Newsom of California, which I know impressed a lot of people recently. He sat for a very long-range interview with Sean Hannity on Fox News and really seemed to control that narrative, came very well prepared, and he's doing a little bit of a national tour in that sense. Then there's someone like J.B. Pritzker, the governor of Illinois, who could write the checks. You know, he is the heir of the Hyatt. So these are kind of the individuals you'd be looking for. And then, of course, there is the vice president. But at this moment, it doesn't seem like there's a lot of rallying support within the Democratic Party for her to take over to be the standard bearer.
As he heads to Alaska, does President Biden leave a G20 emboldened or weakened, really, given that some of the focus is less around the substance and or some people would say the pomp of some of these events and more on some of these other issues like the speech?
Well, I think optics will be about the speech. Optics will also be about the communique. I mean, the communique regarding the war in Ukraine has really irked the Ukrainians this morning. They don't even mention Russia's invasion of Ukraine. They talk about making sure that there's no countries that are going after another country's territorial integrity. That is a big walk back from the communique we saw at the G20 in Bali. But what you'll hear from behind the scenes from U.S. officials that these are just words. What's actually happening is that China actually left a huge hole by not attending this G20. India was able to have a successful G20, and the United States and other countries were able to coalesce around the global south. India, South Africa, Brazil. They want to make sure these countries are on board.
I want to bring it back domestic. And I'm going to do this. And folks, I should point out that Michael Bloomberg, the principal of the shop and his TV and radio network as well, wrote an essay on immigration this weekend. 1976, Ford on a different topic to New York City. New York City dropped dead. There it was. I can remember it clear as a bell at the time. Where is the dynamic in your Washington about any of the given cities, including New York City and the migrant crisis that we have? What is the administration going to do?
Well, what's fascinating about this is that what you see is a Democratic mayor, a Democratic governor come out and really put the feet to the fire of a Democratic administration for more help when it comes to the migrants in these cities. This is going to be a huge fight starting this week as we potentially have a government shutdown September 30th. What you see is the administration asking for more Ukraine aid. Speaker McCarthy is going to have a rough time getting that through on a continuing resolution to keep the government open. So potentially he wants to cipher that off and put that with more funding towards the border. But with that would also come controversial asylum provisions. So this is going to be a huge debate this week when it comes to federal funding on the border, but also potentially.
Do we have time for debate, or do we have time for?
You have.
I don't mean now. No, I don't mean
about 60
us.
seconds if you
no,
want
I don't
debate
mean
time.
us. No, but John, I just the whole debate here, like the urgency here, the leaves are changing. It's getting colder, and I wonder.
We're talking about immigration in New York.
Migrants in New York or Chicago. The Guardian had a wonderful essay this weekend on Chicago, compare and contrast with New York. It's not just New York.
So first and foremost, we should all be deeply uncomfortable using people to make political points. But the point that Greg Abbott, the governor of Texas, has made, regardless, is an incredibly effective one. It is proven to a certain degree that this has always been a not-in-my-backyard phenomenon, which that New York has not had to experience in quite the same way. And now it does. Anne-Marie, they've got a different view on it.
They do. They're trying to set up places where they can put these individuals, and they're also don't have the infrastructure, the funding they feel need to adequately provide, because then it becomes a big humanitarian crisis.
MH, it's good to see you here in New York. More from Anne-Marie through the morning, right here in New York City. Equity futures on the S&P 500 just about positive by 0.4%. From New York, this is Bloomberg.
used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. JetBlue has traveled a long way from its startup days, but CFO Ursula Hurley says growth won't change the airline's quirky attitude.
At the end of the day, we view ourselves as a disruptor and a maverick in the aviation industry, and I'm really excited to play a meaningful role in that growth journey.
Watch Chief Future Officer Wednesday on Bloomberg.
Stocks near session highs in the equity market on the S&P 500. There is a lift here across the board on the S&P, on the NASDAQ as well. Equities on the S&P positive by 0.4%. On the NASDAQ 100 up by 0.6%. On a Russell, the small caps elevated by 0.56%, following a week of losses on the S&P 500 for the first full week of trading for September. In the bond market, 2-year, 10-year, 30-year. Your curve looks like this morning. A 2-year moving away from 5% at 498.84. A 10-year yield pushing higher by 3 basis points and getting closer to 430 at 429.40 on a 10-year. Yields higher by, let's call it 4 basis points on a 30-year to 437.82. Going into CPI on Wednesday and going into retail sales on Thursday. And to finish in foreign exchange, the euro just a bit stronger through the last couple of hours. Positive by 0.2% against the dollar. Had a look at 106 last week, back to 107, 107.26. Our conversation with the Commissioner on the economy, Paolo Gentiloni, about an hour ago, Tom, on the growth forecast, lack thereof, should we call it that? Cuts to growth forecast out of Europe earlier this morning.
We played this banner for radio. I'll explain this carefully. A lot of people in earnings and economics are going back to, okay, where were we in 2019? Which I think seems to be a valid idea. Top line GDP, including inflation, the United States, John, from the end of 2019, up 24%, all that stimulus, life is great. In Europe, I was thunderstruck running a 2% rate, up 8% over the same period. That is the Euro-US difference.
And are we going back to all of that? Low trend growth in Europe based on a forecast we've seen this morning. Throw in Germany too. This is something we didn't have time to talk about with the Commissioner, Tom. The fact we've had recession there, basically, stagnating growth, and we still have an inflation problem. And there are hopes here that if you get softer growth, inflation goes back to target. It's not the experience of Europe over the last year.
Are they having the 3-month annualized thing? Nick Timmerus in the Journal today, Mike McKee mentions that he's been doing it for 3 weeks, 4 weeks, hell on his Western tour. The basic idea is disinflation is in place in America. Can Lagarde say on, I believe it's Thursday, that disinflation is in place in Europe? I'm not so sure when I look at Brent, $90.34.
Certainly not with the same confidence,
yeah.
That's for sure. Under surveillance this morning, the President of the United States, President Biden, confirming his meeting with China's Premier Li Qiang at the G20 summit over the weekend. This marks the highest level meeting between the US and China in 10 months. Also at the summit, leaders backing a new plan to link trade between Europe, the Middle East and India. Leaders also acknowledging the war in Ukraine, but failing to jointly condemn Russia's invasion of it. AMH talked about that, TK, a few minutes ago.
Yeah, well, I guess it's there. It was a G18. Some people were saying, and just, you know what? Part of diplomacy 101 is you got to show up. The president showed up. I mean, it's just that simple with a bunch of other people, given all the different challenges that are out there. I sort of think it was off our radar. Tina Fordham was saying it was a bigger deal maybe than I thought, but, you know, I could be wrong.
We won't be talking about it tomorrow. It's
I don't
basically
think so.
what you're saying. President Xi, of course, did not show up. SoftBank's ARM looking to raise the price range of its initial public offering, according to our reporting here at Bloomberg. ARM filing for its IPO at $47 to $51 per share, which would value the company at nearly $55 billion, below the 60 to 70 range saw earlier this year. There is another IPO in the mix for this week. Instacart, Lisa, setting its price range this morning at 26 to 28 per share and looking for a NASDAQ listing with the ticker CART.
Well, here's the issue. And it's sort of similar to ARM in the sense that the valuation that's being talked about out there is substantially lower than where it was valued just months ago. In the case of Instacart, though, it's a significant decline. It's being valued at about a quarter of what it was valued, $39 billion 2 years ago. So you take a look at this and you say, are these specific to the names, or is there something broader here about a revaluation of a lot of private companies that has yet to percolate into the system in terms of solidifying some of those losses and solidifying some of that new valuation?
Wegmans, Costco, Food Bazaar, Fairway, which is an iconic New York shop. Have any of you ever done Instacart?
Yes. It used to have to deal with Whole Foods back in the day before Amazon bought it. So if you did your online shopping through Whole Foods, pre-Amazon acquisition, you did it through Instacart. Here in New York, anyway.
I mean,
it was fairly decent. It was the same as all the rest, Tom. They send out couriers, they go pick up the shopping, they deliver it.
Do you like
basically the model?
Do you like other people picking out your fruits and vegetables for you? I have a thing about that.
I'm on a warpath right now.
Just fruits and veg?
Yeah.
Meat as well?
Yeah, well, meat is actually, to me, they can pick the meat better than the fruits and the vegetables. I always get, soggy.
They make bad choices.
Yeah, like it's not the same kinds of fruit choices and fruit knowledge that I would like deployed with my selections.
Should they be going? Why are they going
paying
public?
for high-level fruit knowledge? Would be
well, I go personally for high-level fruit knowledge.
Can I ask a dumb question? Are they big enough to go public? I mean, why are they? I mean, they're going public so somebody can cash out. Right?
TK precisely for them. Yeah, I was looking at the numbers and it looks like that.
And ARM, you're more knowledgeable in ARM than we are. It's a British thing, and SoftBank's coming in. Am I right that they're coming in with big companies helping out because they're sort of protecting each other
essentially
strategically?
I think ARM is super unique, Tom. We used to talk to ARM and leadership at ARM every quarter in London, going back 8, 9, 10 years ago. Tom, this company's been around for a long, long time. It was absorbed by SoftBank. They're spitting it back out and sending it public again. It's just not the same. I don't think you can compare that to, say, an Instacart or a startup that's been doing loads of private rounds and is going public. It's just not the same thing.
Yeah. Okay. You got your 8,000 shares?
Yeah, I'm ready.
Okay.
Nicely allocated. Can't wait. Not at all.
This is
final story, Tom.
Yeah.
I want to finish on this one.
Yeah, it's tough.
Important.
Tough.
A tragedy strike in Morocco after the deadliest earthquake the country has suffered in 6 decades. The race is on to find survivors with more than 2,000 people. It's just dreadful. 2,000 people potentially believed to be dead. The 6.8 magnitude quake struck late Friday, devastating a region dotted by small towns and villages with homes made of mud brick. And Tom, I just don't see how the IMF gets together in a couple of months' time and heads over here.
Received an email this morning, this through Bloomberg Security, and it's under debate. I don't have anything to say about what the IMF would or should or can do, other than I know that Christina Georgieva and her team will be riveted to this as a humanitarian emergency.
Absolutely.
This is down the coast, away from Casablanca. This is not all the images we have of Morocco, which are mostly wrong. And this is agrarian, mountainous, cold at night, and very poor. This is 50, 60 miles southwest of Marrakesh.
And you'd have to imagine, Tom, that's where the IMF would like the focus to be, on the rebuilding, on the humanitarian effort, and not on the economic get-together and having a look at the rest of the world and throwing out some forecasts and all of that happy talk. Not the time or place.
I was immediately in contact with their people. They got back to me right away on the potential here, and it's, as you can well understand, under discussion of how they can assist with the World Bank, with the Red Cross. This ongoing tragedy. 2,000 to me seems like a low number.
That's the latest, Tom, this morning.
Right now, we will go to the markets here, and as John mentioned, we do it with a buoyant stock market. Futures up 20. Subhadra Rajampa joins us now, head of U.S. rate strategy at SocGen here on the 47 narratives that were out there. You had to pick a narrative this weekend to go with on Monday, Subhadra. Which is the SocGen narrative right now on what rates will do?
I think for the most part, it's going to be wait and see, at least for this week ahead of FOMC next week. Broadly speaking, if you look at the price action that we've seen in the bond market, the front end seems to be very anchored to Fed expectations. The Fed's going to pause at the September meeting. Whether they hike again in November is yet to be seen. But the data that we get this week will kind of guide the dots for next week, as well as set the trend for what potentially the Fed could be doing in November and beyond. So in that sort of context, range bound markets for the next week or so, we did get a ton of corporate supply that's been pushing 10-year yields higher. We could probably see a little bit more of that momentum, but really you're going to need more data to direct the markets from here on.
What's your take, Subhadra, on the implication from the latest missive over in Japan about potentially ending yield curve control, as well as negative yielding policy sometime in the near future, and having a better sense of when that would be appropriate by the end of this year? Does that change your outlook for U.S. yields, given the incredible buyer base that we've seen coming from Japan?
Absolutely. I think that we've seen a pretty decent change in the trend and momentum in yields in August. Granted, it's a quiet month, but we had the Fitch downgrades. You had the change in the YCC policy. That's definitely putting some pressure on yields, not just in the U.S., but also globally. But we'll have to kind of see how things play out, because at the same time, while they're adjusting policy, you're also looking at a broader slowdown. Europe, you're starting to see a slowdown in growth there. In the fourth quarter of this year, we'll probably see that the U.S. economy will also start to come under pressure as the consumers start to pull back a little bit. We've seen a summer splurge. Consumers have been extraordinarily resilient. But with student loan moratoriums expiring, savings rates starting to decline, delinquency starting to go up, I think that you're going to see a lot more pressure on the consumer in the fourth quarter of this year. And that, again, is something that could probably keep a lid on the rise in yields in the U.S.
Does that give you more conviction to buy in the government bond space and less conviction to buy on the credit side of things that might be more affected by the weakness?
That seems to be where you would want to put your money in if you think that there's going to be a meaningful slowdown in growth in 2024. We've always had a recession in 2024. We're moving perhaps away from a recession in the early part to more the mid part of the year. But, if the recession is still very much in the cards, and if that were to play out, I think you should start seeing a moderation in yields, or the sell-off in yields we've seen in the back end.
Subhadra, I've got to buy a bullet piece on the curve. Which maturity, full faith and credit right now, is most attractive for price up, yield down?
The front end is definitely very attractive. The market, in my view, is fully priced in for high for longer from the Fed. So we're basically pricing for the Fed on hold until perhaps the second half of next year, and only modest cuts after that point on. So in this sort of context, it probably feels that the place you want to be is the very front end, because if the economy does start to slow down and the Fed starts to pivot towards easing or easier policy, then you're going to see the front end start to rally.
Hey, Subhadra, it's good to catch up and get the view from SocGen. Subhadra Japa there. On the bond market, the 2-year still very close to 5% at about 4.98. Your 10-year close to 4.30 at 4.29. Your 30-year very close to 4.40 at 4.38. Yields higher across the curve from the 10-year out, Tom. The longer end just a little bit higher, shifting higher by 4 basis points on a 30-year this morning.
Yeah, I would watch the 2s10s, 70 basis points. It's going to be interesting if that narrows and comes in.
If you are just tuning in, welcome to the program. The S&P positive here by 0.4%. Up a little bit later, about an hour from now, Tom, Claudia Sahm, former Fed economist and founder of Sahm Consulting, is going to join us at 8:30 Eastern Time. 8:30 here in New York.
Like a genius back 8 months. Everybody quoting the Sahm rule and recessions state by state and all this. And basically her message was, would everyone calm down? Right now, I mean, she'll be wrong. Claudia will be wrong in 2025. We've got that on the calendar. But for right now, she's been, would everybody calm down is, on the edge of data.
I wanted to squeeze this story in, Tom. Apple this morning extending an agreement to get modem semiconductors from Qualcomm for 3 more years. TK, this is something I know you're focused on. Apple at the moment, of course, In focus for the iPhone 15, this is a story elsewhere. Qualcomm's surging off the back of this news. Tom, we'll catch up with Mandeep Singh of Bloomberg Intelligence a little bit later in about 5 minutes' time.
We got to get the photo of me talking to Matt Miller on the sidewalk at the Apple store umpteen years ago. I think it was raining. I had an umbrella on. Apple was going to die. It was going to go out of business. It was over. It's done. Finished. I can't remember why. Doesn't matter.
We've done that enough times, right?
Yeah. And are we doing it again right now? I mean, the gloom, it was not China gloom, but it was gloomy this weekend.
The significance of this particular story is that there was discussion around Apple creating their own chips and what that would do to Qualcomm. And it seems like that chip isn't quite ready yet, giving Qualcomm something of a lifeline after not seeing the business really expand as much as people expected in China.
The stock taking that lifeline and running with it. Qualcomm up by 8.5% in early trading. Mandeep Singh of Bloomberg Intelligence on all of that news up next from New York. Good morning.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball, and the reason why Warren and I got to know each other is he insured my contract, the 252, and I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall? That's a great question.
I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
There's more downside risk here as we go through the next few months. We're underweight technology as per your conversation for a number of reasons, not least because the US tech sector is trading above a 60% PE relative to global equities. The tables look stacked against global equities, US in particular, and tech at this point.
Jonathan Stubbs, equity strategist over at Berenberg. 2 names to look at this morning, Apple, Qualcomm. This story just dropped moments ago. Apple extending an agreement to get modem semiconductors from Qualcomm for 3 more years. This from Qualcomm. The new pact will cover smartphone launches in 24, 25, and 26. There was the potential, Tom, that the iPhone coming out this week would be one of the last to rely on Qualcomm's modem chip. That stock is up in a pre-market by 8%. That's Qualcomm higher by 8%. Apple nudging a little bit higher after a tough week last week.
Yeah.
Going into that launch, Tom, for the iPhone
Tom
15.
Keene, modem technician. What do I know about
more than
modems?
More than me.
All I know is the EU says you got to put a different code in to get to the modem, and I don't.
You're so much more up to speed than that. Give me a break.
I'm looking at the chips. I always go to the chips as well. Joining us right now, Mandeep Singh. We've got to go right to this. It's so important. Senior Apple analyst for Bloomberg Intelligence as well. And also surveillance tennis expert. Let's digress here. Rip up the script right now. I could hear people in buildings cheering. That was one hell of a final men's tournament, wasn't it?
It was, especially the second set was epic. I mean, you don't see those kind of rallies.
36 years old?
It felt like he was faltering at one point, and I've seen this a million times with Novak. It looks like he's lost his legs.
He's faking?
Second set looked like he was aging. I was ready to say Novak's got old, and then Novak got young again. Mandeep, that was kind of the way it went in the second set.
The fatigue, and the response. Long, right? And look, I mean, the guy is clearly, a lot will argue about it, but he's the GOAT when it comes to the slams, and probably no one can beat his record.
When he comes off the court, he doesn't go, "I'm going to Disneyland." He goes, "I'm going to Cupertino to buy whatever the new toy is." How is this week going to go for Apple? I mean, away from the modem news, do you got a thumb up on all this soiree for Mr. Cook and all?
I think with Apple, you have to think about the features they're going to introduce in the phone, and it's not a guarantee that we'll have a big upgrade cycle. That's why these events are so important, because time and again we have seen the big upgrades come when they introduce new features, whether it's a camera or something else in the phone, and there has to be that element that's going to rush people to, upgrade their iPhones, and it's not a guarantee.
Well, this is a problem because they've been able to dress up poor unit growth with higher average selling prices. So if there isn't a big upgrade, where are they going to get the higher ASP from?
And that's never a good strategy to, extract more in terms of making people pay more because you reduce your install base. I mean, look, right now, Apple's install base isn't growing. Now, for them to take market share, they really need that new phone that everyone is excited about. And they are one company that hasn't talked about generative AI or large language models. You would argue a lot of the inferencing for those generative AI has to be done on Apple phones. They haven't even mentioned a word about large language models or generative AI on any of their calls.
So what's at stake in terms of the new creations in this new iPhone, right? What could they really move the needle with? Is it that much better of a camera? We've done that before. Is it just a faster kind of charging device? Okay. What could it be?
Well, so they have shown their Vision Pro demo, and clearly spatial computing is where the next leg of computing is going to grow. I mean, I'm not betting on metaverse, but clearly there's an argument to be made that similar to wearables, you could get a big pop in terms of, the Vision Pro devices and how it really expands the Apple ecosystem. In the end, it's about the Apple ecosystem and the vertical integration that they've been able to do over the last 2 decades.
So in other words, you're saying that instead of having a laptop or a basic computer, we're going to put on goggles and have our phones and be able to walk around and be in a computer.
You could argue that is the future, but that's not imminent. Like, it's not near term. It's all about what is it that they can do in terms of expanding the scope of your iPhone to really tailor it to the next leg of computing. And that's why I bring in the generative AI aspect, because Qualcomm has argued you are going to run your large language model on your phone. You're not going to do it on your cloud. That's what inferencing is all about. And Apple hasn't mentioned anything around it. So this event is quite important from
It's Mark Gurman's territory, but let's channel Mandeep Singh right now. Is there any discussion about what happens after Cook? Is there like a succession plan or an envelope and a desk, or like how long does he keep this going?
I mean, really, right now they're at a crossroads where supply chain diversification is paramount for investors. And until they fix this in terms of Apple actually diversifying their supply chains, Tim Cook is the guy to facilitate that.
Is this buzz about Huawei's new phone legit? Do you appreciate that buzz?
Well, I think it's very hard for Huawei to embed the latest leading node chip because, look, China government has thrown a lot of money in terms of building semiconductor manufacturing. But for them to get all the pieces right, chip, packaging, assembly, everything, it's very hard. And we know semiconductor manufacturing is very iterative. That's why TSMC is finding it hard to replicate their fab outside of Taiwan. So I have my doubts in terms of the phone being as good as an iPhone or...
Even if it's not as good, say it's 3 years back. Let's say it's like the iPhone 12, whatever. Are we missing the mood of a country shifting away from Apple? That's what I'm trying to identify. And if there is a mood shift, does it really matter whether it's the equivalent of the iPhone 12?
Well, why would consumers want a phone that's equivalent to iPhone 12? As a consumer, Chinese consumer, you want your hands on the latest gadget, and we know they're very savvy with all the app usage.
But if I wanted a better phone, wouldn't I just get a Samsung? There's a reason I buy this, and it's not just because it's a decent phone. The Samsung is arguably a better phone. It has a better camera, has done for ages, but I don't buy the Samsung. The reason I buy this beyond the technology that it has. I've had it for a long, long time. I'm a part of the ecosystem. It's really, really sticky. But also at the same time, there's some brand recognition associated with this, even here in the United States. And I'm wondering whether that's changed in China, whether that's really the brand you want to carry anymore.
I don't think so. I think you're going to see a rush to upgrade, especially from Chinese consumers, before there is an explicit ban, let's say. And in my opinion, everyone gravitates towards, the perceived attractiveness of Apple. And it's because of the ecosystem. It's a software. It's everything that's vertically integrated about an Apple ecosystem.
So how does the ambassador of Tim Cook address some of the concerns that have been expressed in share prices, if expressed by analysts at this launch, or even in the next couple of weeks, if he wants to maintain that kind of enthusiasm within China, while also maybe shifting and diversifying some of that risk?
Well, so they clearly have to work with the Chinese government. And so far, Apple has done a pretty good job. I mean, there is no other mega tech company that has 20% revenue exposure to the Chinese end market. And so to give Apple credit, they have been able to work through the issues. But clearly, I think from a China perspective, they want that local company, Huawei, to start making the phones. And that's why they're investing so much.
This is un-American. We got to change from Apple over to Pumpkin. I mean, this isn't this. I saw this like 3-4 times this weekend. You know how we rush it? We get Christmas decorations out.
I know.
Like November 1. Meg Terrell over at CNN with the action photo out on Twitter. Thank you, Meg. Their medical correspondent. Pumpkins now, it's 50 days to Halloween. John, you buy the orb right now. It's not going to make it, carved or uncarved.
It's an American illness, isn't it?
Let's
go.
Lisa, help me here. When should we be buying the pumpkin?
I'm all with you in terms of early decorations. Pumpkins are it's fall and they grow in fall, so they are harvesting pumpkins. But I'll take your point. So
this is like a pre-Halloween purchase.
Yeah, it's sort of like celebrating fall, and I can get behind the idea of that because you can see the leaves starting to change when you go, outside of the city. So I'm just saying I understand that.
I had 3 of them last year.
I do agree though that pulling out, the Easter Bunny after Christmas is sort of crazy.
Yeah. January 1.
Yeah, January 1, all of a sudden, those like marshmallow Easter bunnies.
It's like buying roses.
Really?
You want to do roses on Valentine's Day?
Yeah, you don't want to buy them near Valentine's Day. It's expensive.
No, you want to buy them the day after.
Day after.
Because they're on discount.
On sale. Mandeep, thank you. Mandeep Singh of Bloomberg Intelligence. It's a long story we don't have to go into.
We fortunately don't have to go into it.
Keith Lerner of Truist Advisory Services joining us in about 5 minutes' time. Really important week on several dimensions. We've got CPI and retail sales in America. The good news is the Fed isn't speaking, so that's data and the Fed taken care of. Tom, on the company side of things, we've got that debate between UAW, the Detroit Big Three, negotiations ongoing, and we've got the unveiling of the iPhone 15. So plenty going on this week, that's for sure.
There's a lot. It's hugely going on. I'm going to go ECB as the top item, but we bust Lisa's chops about it. But the bottom line is, it's a toxic brew. I'm not kidding. I mean, there's like
when have I been pessimistic today?
But there's a lot of toxic brewedness out
Super
there.
Toxic, yeah. Equity futures on the S&P just pulling back from session highs. We're positive here by 0.4%. Yields are pushing higher by, let's call it 3 basis points on a 10-year, 4.30. And in foreign exchange, the euro just a little bit stronger. The euro against the dollar positive here by 0.2%, 107.19.
So I am expecting there to be not necessarily a wholesale adoption across the world, but we have many governments that are looking what the EU is doing and are in the process of introducing similar regulations or variants thereof. Then I think it'll be very interesting to see how these global companies will adjust their business practices. Will they implement the obligations of those regulations only with respect to Europe, or whether they do it globally? And sometimes it may be very difficult in today's conversation environment about which is more hostile or more skeptical of the big tech companies. If Facebook, for instance, cannot use targeted advertising, or Instagram cannot use targeted advertising on minors in Europe, can they then justify that they continue that very same practice in the United States and elsewhere? Because there will be many who say, well, you have ceased those activities in Europe. Don't you care about protecting our minors as well? And it is harder for reputational reasons for Facebook, for instance, then to confine its conduct and the changes it will have to make to Europe alone. So I think we will see some ramifications of those regulations outside of Europe as well.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping. Look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
We're in a brave new world, as we call it, and there's lots of sort of shifting sand.
I think that we're entering a very important period here, where there's probably going to be a handoff from the focus on inflation onto the real economy data.
That bullish sentiment has really waned, and what that has done is it's really taken the tailwind out of the market.
We don't believe there's hikes next year. We believe there are hold next year.
The Fed, the ECB, they're stepping harder and harder on the brakes.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. Mr. Ferro really diving into the 9 o'clock hour, getting set up there as well. Futures up 17, Dow futures up 38. VIX is not giving me much information. It's just sort of, I'm going to call it, Lisa, almost positioning Monday here on September 11th, and we'll see the Vice President in Lower Manhattan here in the hour at a remembrance at 8:45 of Flight 11. But it's just sort of like get ready for the week Monday is sort of my feeling on it.
Yeah, it feels like there's nothing going on. It sort of feels like a lack of conviction Monday, where people are just kind of waiting and nobody really has a sense of where they want to go, but they kind of want to tweak things around the edges and wait and see. It feels like a tipping point kind of moment, but it's kind of, filled with ennui almost. This sense of we don't know even what we're waiting for.
I don't know what ennui means, but it sounds good. We'll go with it this morning. I'm going to go with the 10-year real yield, 1.96%, showing the conundrum out there. Be honest, I don't know what the real yield is in Europe, but it's going to be real for Christine Lagarde on Thursday.
Brutal assessment from the European Commission. They're trying to maybe spin it slightly different by saying that maybe this isn't really a stagflation type of profile going out. But how does she grapple with this? How does she support economic growth, which isn't their mandate, by the way, while also dealing with CPI that's north of 5% in the region?
Going back when CPI was back like that in the middle 60s, I think, even the early 1960s as well. And of course, what we hearken back to in the 1960s is there was a 3-year period where I survived on Hostess products, Twinkies. They had this pie thing. We lived for this stuff. For our international audience.
Okay, that's not food. I'm sorry.
We need to stop the show now. Is basically grape jelly and peanut butter combined with grape jelly buys Hostess Twinkies.
People are eating breakfast that I'm just imagining right now.
We had
Hostess
Twinkies for breakfast.
Twinkies with peanut butter and jelly from Smucker's. So basically, if you're just joining the program, hold on a second. The actual news is Hostess Brands is going to be acquired by J.M. Smucker for $34.25 a share.
That's very good. You nailed that. I mean, Chart Banner, I sent an email to Chart Banner, I think it was Sunday. This was rumored over the weekend that this was going to be there. And I said, you got to be careful. You can't show the little pink snowballs. I hardly had those.
You hardly had those.
My sisters took the pink snowballs, but Twinkies were a food group.
Were they?
For a 3-year period.
And how did you emerge from that 3-year period?
I emerged from it healthy and, like every other kid trying to get to the next thing. I think I went from Twinkies to Genesee Cream Ale, but that's a different story.
Well, there is a bigger story here with respect to capital markets being open and some of these acquisitions. It's supposed to be acquisition M&A Monday, remember?
Scale.
And yes, so it's scale. There's a consolidation, but the fact that there's also the Instacart IPO that's also in there, especially after last week's issuance of corporate debt, the market is open. It might be slow, but capital markets are open, even at high yields, even at some of these concerns. Again, it doesn't feel like anything has broken from yields where they are, which raises this really deep question of why should they go down?
Peanut butter and grape jelly is bringing me an EBITDA margin of 21 cents on the dollar. We didn't mention this yet. We'll get to it quickly here before we get to Keith Lerner here with Truist Advisory. Lisa, we got to open up in Asia. We got to hire people in Asia. We're going to Asia, and then there's UBS off the Credit Suisse merger going, maybe not.
Yeah. Well, and we've seen this from other big banks too on Wall Street, right? I believe that Morgan Stanley cut back some of their staff in China as well. How much is this just because are they really even going to be allowed to do business in the same kind of way in mainland China, certainly, and in Hong Kong? Does it have the same kind of international position, given its interconnectedness with Beijing? I mean, it's sort of a question that you're not going to get an honest answer when you hear from any of the megaphones coming out of the big banks, just how sensitive it is.
9% profit decline there, but far more importantly, I'd link it into Goldman Sachs. It's the time of year. It's the time of year where people are right-sizing as well. On the data front, help me here, Lisa. Futures up 19, NASDAQ up 0.7% on the NASDAQ 100. I'm focused on yen, stronger, 146.64 off some Bank of Japan chat.
Yeah, speculation, not just speculation. UADA coming out and talking about by the end of this year having a sense of whether they can move away from negative rates. I'm also just generally looking at dollar strength across the board that has faded. And now we are solidly in dollar weakness with the euro even stronger versus the dollar, despite what we heard from the European Commission. The idea confirming recession, 0.4% contraction in Germany's GDP, leading to this really subpar growth perspective in that shared currency region.
Right now, we're going to go into a conversation. Gina Martin-Adams later in the hour to round it out with Claudia Sahm. Right now, Keith Lerner, Chief Market Strategist, Co-CIO at Truist Advisory Services. And the major charm here, folks, is he is truly legit on the technical aspects across equities, bonds, currencies, and commodities as a CMT. Keith, thank you so much for joining. What do the charts tell you? We've got like 8 narratives going on. It just seems a jumble. Is the technical structure of the markets plural? Is it a jumble?
Yeah, well, great to be with you and Lisa this morning, as always. I think jumble is a really good word, Tom. I mean, as we kind of talked before the break, as you look at the overall equity market, we think at this point it's not time to be on offense or defense, but be somewhat patient for a better opportunity to do so. If you look at the S&P itself, you're basically in a range, kind of digesting the big year-to-date gains, and you're in the middle of that range, 4,600 on the upside and about 4,330 on the downside. And there's not a lot of momentum. And I would say as we head into this kind of busy week, but also this month, there does seem to be a lack of upside catalyst as well. So again, we're just okay, this is the time to sell. And sometimes when you say you're neutral, they think that you don't have an opinion. And we do have an opinion. We're strongly neutral, saying we should be more aligned with, where your long-term asset allocation, of course, stocks, bonds, and cash, sticking higher quality, and not taking those big bets across asset classes. But I will say, where we've been taking bigger bets is we've been overweight the U.S. all year. We've been most negative on emerging markets. That spread is wide, and we're staying up in quality and in fixed income. And we don't think you're being compensated today for the risk that you're seeing in the high yield market or the investment grade market.
Keith, great brief. Thank you so much. Keith Lerner is with Truist this morning. The only thing I know, afterthought strongly neutral on our math teacher. That's where we are.
Evidently.
We're like 3 days into the torture, and I said, well, what do you think of Miss Wang? And she said, I'm strongly neutral.
I think that both of my children are strongly neutral on their scholarly experiences. I think that that's really fun to listen to, because he really raises good point, which is people think that means you don't have an opinion. But it does. It's just that, there's not a lot of conviction to push you one way or another.
Granted, we've had this titanic lift in rates, which is completely unusual, and it's wrapped around the pandemic and all that. But the heart of the matter is, we really don't know how to act at these points, as El Arian brilliantly says this morning, the last mile. This is all new. We really don't know what to do we?
And this is the reason why the Fed and the ECB are waiting, right? I mean, it makes sense. But at that point, so if you're an investor trying to get ahead of things, do you just basically say, we can't?
No,
so then we're just going to be in the middle.
Lift of the market this morning on the Standard & Poor's 500 up 21 points, S&P up 0.5%.
It's a good point, though, in terms of when some of these higher rates, you talked about that surge in rates, when it's going to really become the norm, where it percolates in so you don't have to say it's going to hit the market when it is hitting the market. And that's the reason why I think it's interesting that we're seeing the Instacart potential IPO, as well as the Twinkies and the Hostess situation being acquired.
I mean, Smucker's been making money for years. I mean, they mint the money on it. Instacart, to me, I mean, I don't know anything about it. I'm not qualified to warble on it. But the answer is Instacart the kind of business that should be going public? I mean, are they like profit making, and are they going to become a Dow Jones Industrial member?
Well, I will say that they're being valued at about a quarter of what they were just a couple of years ago, which, again, is it because they have to kind of capitalize right now, cash out while they can for their owners, or is this that it's only going to get worse, or it's not going to necessarily be as high a valuation? Either way, people are throwing in the towel. They're raising money despite the higher yields and despite valuations that are subpar relative to recent history.
In this 8 o'clock hour in New York, it is September 11th. We welcome all of you around the world. We'll have remember it's at 8:46, and what I think is so important, Lisa, it is not Manhattan and the Pentagon and Shanksville, Pennsylvania, but it is also a president returning home. He will be in Anchorage, Alaska today.
Not in New York or near the Pentagon, which is cause for some concern. On a bigger stance, though, it is amazing to think that it's been 22 years, and it is still catastrophic and very present in people's minds who were here during this event.
It is September 11th. Thank you for joining Bloomberg Surveillance.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
I think that we're entering a very important period here where there's probably going to be a handoff from the focus on inflation onto the real economy data, and it's going to be a slow process. But I think that I'll repeat what I just said. Yields probably go sideways for now, but when they make the next big move, it's very unlikely to be up.
Stephen Major of HSBC, and that is what Bloomberg surveillance is about. What a difference, I believe this was on Friday, between Major looking for lower rates at HSBC and Lisa Abramowitz, Mr. Davis, Earl Davis, at BMO Capital Markets, Bank of Montreal, just flat out going the other way, looking for longer.
The gap between the bulls and the bears getting further and further apart. And I have to say, what happened overnight really confirms the uncertainty here. And I'm talking about the Bank of Japan in particular.
Yeah.
And the discussion of UEDA possibly knowing by the end of this year whether or not to end negative rates. That changed the scenario in markets. Is it going to have a lasting effect, and could it on the U.S. market for Treasuries?
That's one of the uncertainties out there. And what I would say over the weekend, you just sort of look at the zeitgeist, your eyes are glazed over, and you're looking at the computer screen, and the answer is the set of uncertainties right now are just extraordinary. And it's led by China. I think China takes top billing, but all these different narratives that we have clearly indicate, how do we get to November? How do we get to January? Where are we the 4th of July of next year? I have no clue.
I keep going back to Diane Swank saying that she has the humility, and I do too, of saying I don't fully understand all the different threads and how they're going to come together in terms of painting the new economic narrative.
Our thoughts to Diane Swank and all of the National Association for Business Economics, including our Michael McKee, that we're so close to what we saw 22 years ago on September 11th. Right now, we're going to dive into a conversation, and this is an informed discussion with a gentleman from Brown Brothers Harriman. Yes, currency is a litmus paper, but for Win Thin of Burma and for all of his work at Columbia, a good time to speak of the broader Pacific Rim. Win, my question for the day is simple. Are we going to see an export of disinflation out of a troubled China to Hanoi, to your Burma, and for that matter, across the Pacific to America?
I think that's the process that's in place. And to me, that's not a bad thing, right? We're central banks around the world, both developed and emerging, are fighting inflation. So, hey, a little bit of disinflation really isn't a bad thing. Now, the bad news is that disinflation is coming at a cost for China, right? We know that the economy is slowing much more than anticipated or desired. So it's a double-edged sword. But I think right now, with the market so focused on inflation, a little bit of disinflation is good news. But hey, we've got a long way to go before we can sound the all clear on inflation fight.
I've got to ask the question, Dr. Thin, that people want to know from you, which is, can yuan go round trip back to 2005, which is about an 8.20 level? Do we see an outright devaluation as a solution for a troubled Beijing?
Well, I think they've been trying to resist that. If you look at the fixings and some of the sort of measures at the margin, they've been trying to prop up the yuan. They don't want it to fall out of bed. At the same time, I don't think they can really do much against it. And we go back to sort of monetary policy divergences. As long as the People's Bank of China is in easing mode and the Fed is in tightening mode, there's really, to me, only one direction for dollar yuan, and that's higher. Again, they'll try and control it. I think the devaluation would be very, very dangerous because it would be bad for instance, Chinese corporates. They have a lot of dollar-denominated debt, and all of a sudden that debt becomes much more expensive to service. So for now, I think they hold off on the devaluation, but they lean against the depreciation. But again, it's not much they can do. It's like trying to fight the tide.
When we take a look at all of the stories that are kind of percolating, we were talking about the different narratives that are coming out of the woodwork and creating this confusing brew, I would say, more than a toxic brew necessarily. The one that stands out most to me is the Bank of Japan. And yesterday, what we heard from the Bank of Japan Governor Ueda was that if the Bank of Japan becomes confident that prices and wages will keep going up substantially, it will end its negative interest rate as among the options available, and that they will know this by later this year. How much does that change the game?
Well, it's really interesting. It tells you a bit about positioning, Lisa. I think everyone was long dollar yen, and we had these comments out of Ueda, but really, if you read between the lines, he's saying it's data dependent. You mentioned if wage and price pressures go the way they want, then maybe they can remove accommodation. It's to me, a very nuanced way of saying, hey, it depends on the data. And to me, the data is not so great out of Japan. Talking about wages, we just had wage data last week from July, much weaker than expected. The wages are not keeping up with inflation. So they're not getting that missing piece of the puzzle. So to me, the question is, well, how is the Japanese data going to go? And to me, it's been weakening. We had orders data out overnight, much weaker than expected. The domestic orders plunged 30%. So it's not just a China external story. Domestic activity in Japan is at risk. And I think that's the reason why, despite all this talk, and it is really just jawboning, the Bank of Japan is likely to be on hold for the foreseeable future.
So what do you take away from that? That positioning is perhaps overly weighted to a weaker yen, or that positioning is such that the reaction that we're seeing today, not just in currencies, but also in the bond market in Japan, is inaccurate and it's going to reverse?
Yeah, I do. I think the underlying fundamentals. Again, we go back to central bank divergence. Bank of Japan on hold. The Fed is tightening, and that's going to, I think, really be maintained through year end. The positioning to me tells me that you had this sort of violent reaction to what I thought was a very balanced, nuanced comment. He said, if wage and prices go the way we want, then maybe we can remove accommodation. It's really, quite qualified. He's not saying anything about really promising anything. As any central banker should not at this point. They should be very much data dependent, sort of staying nimble. Anyway, regardless, the violent reaction to me tells me that, yes, we're probably, the dollar rally has been going strong. Maybe we got a little overextended. DXY has been up 8 straight weeks. So, it's time for a little bit of shakeout. But to me, I think it's very dangerous to go short dollars into the CPI and PPI retail sales. To me, the data suggests that headline is starting to creep back up to 3.5%, 4%. Core is stuck near 4%. And that tells me that the Fed's nowhere near done. And I really think the market's underestimating the capacity of the Fed to tighten further.
Winthin, what is your dollar call out a year? I mean, it's an easy question with a really tough answer for anyone right now. What is your dollar call?
Oh boy, to me, a year is like an eternity in the market. That's a lifetime.
Agreed.
So I would say, look, 6 months out, I am very, very confident the dollar continues to power higher. Even between 6 and 12 months, I lose a little bit of conviction. But the way things are going in the rest of the world, the Eurozone's tipping into recession, UK are also tipping into recession, China's struggling. Yes, the U.S. Will likely go into recession next year, and that's sort of where my call becomes a little bit nuanced. But if and when the U.S. goes into recession, then that's when the dollars can sort of, I think, start to go down. But we keep pushing that out. To me, it looks like the momentum. Q3 remains strong. It's going to carry over to Q4. So maybe mid-year next year we get a recession. I don't know. It's all anyone's guess. But that's to me is the game change for the dollar. When the U.S. goes into recession, the Fed starts to recalibrate its settings. Now that said, I don't think they're going to slash rates immediately. If inflation is still 3-4%, I don't think they're going to turn around quickly.
Winthin, thank you so much for the brief this morning. Winthin of Brown Brothers Harriman and Claudia Sahm coming up, as well as Gina Martin Adams. So we've got a pretty eclectic way to get you to the 9 o'clock hour as well. I love what he said there, honestly, and he's a grizzled pro about trying to get out a proverbial 1 year. I couldn't write a 7-page, like the way Anthony Dwyer at Canaccord Genuity does. He just throws it out. This is where we'll be in a year. I don't have a clue.
Yeah, I don't think we can game out where we're going to be in 2 days, which is the reason why Wynn was talking about how people are kind of hesitant to really make any big moves. He was saying it's dangerous to go short the dollar heading into CPI and PPI because people are underestimating what the Fed is willing to do.
Well, we'll see what the Fed will do, and I agree. You and John have mentioned this. We've got to get beyond the news flow this week down to the UAW strike on, I believe it's Friday, or I can't remember if it's midnight Friday or midnight Saturday.
It's midnight Thursday. It's 11:59 is when the deadline hits on Thursday.
And so then into Friday.
Friday.
Okay, so I'm glad somebody's got this figured out.
But, burning question for you, Tom.
Yeah.
Did you actually subsist on Twinkies?
Yeah.
For
years?
They had
these
3 years?
These fruit pie things that were painful. Smuckers to take out Hostess. It's a blue chip stock. Talk about free cash flow. Thanks, Dad. Futures up 23. Stay with us. Claudia Sam next.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly with just a couple people. Our average restaurant now does about over $1 million per restaurant in digital sales.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Bloomberg Surveillance. It is September 11th in New York. We welcome all of you. Lisa Bramwitz and Tom Keene. John Farrow will be with you in the 9 o'clock hour. The elite meet to greet in downtown New York right now. We've seen former Mayor de Blasio, many others. The Vice President will be in attendance today as President Biden is heading from India back through Vietnam and will be in Anchorage coverage, Lisa, this afternoon, a different 9/11 for the President of the United States.
In Alaska, rather than New York City, one of the epicenter, or the Pentagon in Washington, D.C., on a day that still feels like it was very recent to a lot of people out there. I think that we cannot emphasize enough how it doesn't feel like 22 years.
And it doesn't feel like 22 years. In fact, I would even go so far as to say that it's harder every year for me. I believe this, yes, the vice president now moving to the ceremonies, which circle around 8:46 this morning. And of course, the first plane striking these buildings. And it's shocking when you read the history again and remind ourselves it was a 17-minute, I believe, differential between the first and the second hit in New York. And I think back then I thought it was like a 2-hour difference, and it wasn't.
And just
17 minutes.
It was. It feels very recent. Just the visceral experience of the fall.
I think both of us struggle with it. Some other people do better, but there we are. And for all of you worldwide, we'll bring you some images of this at 8:46 and through the 9 o'clock hour. We do this with markets open as they opened after 9/11. Futures up 23, Dow futures up 79. And the yield space, higher yields. I'm going to call it, can we say it? I haven't used this phrase, Lisa, in months and months. Dare I say it's a risk-on feel today?
It is an ambiguous feel, I would say. It is a neutral, a strong, aggressive neutral that Keith Lerner was talking about, at least
painfully
in the
neutral.
Exactly, in terms of lack of conviction ahead of a massive week for economic data.
It'll be interesting to see. Joining us right now, Claudia Sahm, who's taking a Victory Lab, founder of Sahm Consulting, former Fed economist. Claudia, you absolutely nailed a good number of months ago when everybody calmed down about the recession game. Revisit that call right now. Can you calm down about the recession call, or are there datas there within the Sahm rule that says we must beware?
Right. So first of all, no victory laps. I'm not going to do that as a forecaster. It was very clear for well over probably 2 years that we had a lot of the inflation was driven by disruptions from COVID and then from the war in Ukraine, right? So that's what we're seeing unwind, and markets have reacted well to that because as inflation comes down, that says the Fed needs to do not as much, and we have lower risks of recession, and we've seen that. And so I understand why the soft landing has gotten popular. And yet I am concerned, right, as I watch the labor market data. So the payroll data, they were averaging 3 months, 150,000 through the last 3 months. That's half of what they were doing early in the year. We have seen payrolls cool off at a really steady clip, and they got to bottom out soon. Right? Like if things keep going south, that is what a recession looks like. So I think we're in this very hold your breath kind of moment with the economy in terms of now we're going to see, is this normalizing, getting back to pre-pandemic, or are we heading towards a recession?
This is a really important way to crystallize, Claudia, what a lot of people are looking at as encouraging news in the labor market. What about you makes you say it's a hold your breath kind of moment where we're not sure whether it's going to normalize or keep going south?
In the labor market, there's many key pieces that they get momentum going, right? So the unemployment rate starts out slowly and then it builds up steam, right? And we haven't seen the unemployment rate moving up. The Sahm rule, the recession indicator, is far from triggering, but that doesn't mean that by the end of the year, we're in a space where it's picked up enough steam and we're in a recession. So the labor market is so important because it really supports the consumer spending, and we've seen the labor market cooling off. We should eventually see signs of consumer spending cooling off. There's been downward pressure on inflation, but it's a really tricky needle to thread in terms of doing just enough, but not too much.
Which really feeds into this question of whether what we're seeing with the UAW and some of the discussion around strikes and discussions around getting paid more is something of a rear view mirror, as we were talking about earlier in the show, or whether this is a precursor for what's to come, especially as there is a reglobalization or something of that nature going on. What's your view on that?
I think there's an aspect of it, particularly with UAW, that is a looking backward, right? We've had some years of really strong economy. We have seen big profits by the automakers, and they don't renegotiate these contracts every single year. So now is the time, right? And there's a lot of history. They took a really weak contract in 2009 because the automakers were kind of on the cliff's edge, and now the tables are turned, right? So I think this UAW, I think, is a very backward-looking. And I think it makes a lot of sense why they're asking what they're asking for.
Dr. Som, there's a modest uproar in the United Kingdom about getting the eco data wrong, and that the eco data was pretty gloomy, and they're reassessing and redoing the math, the statistics, to a more optimistic United Kingdom. Do you have faith in our data? Could we be in for a data surprise out of the good people in Washington?
We need to be very careful about reading too much into a single data point. We're going to get a lot of data this week. You should look at the totality of the data, because if you hang your hat on one piece of data, we got revisions in prior months of payrolls. This has happened all year, right? We think it's strong, and the next month we find out it's not as strong. The New York Fed did some really nice analysis of the PCE core inflation, and there's a good band of revisions. Like right now, we could have something from 3.7 to 4.7. That's a big. I mean, that's a big band. So these are things that we need to keep in mind, and the Fed knows these things.
Right.
Like, we think about revisions, but it makes it really hard.
Right.
Like, we don't know what we think we know.
Claudia Som with us, and we will continue with Dr. Som. The 9/11 memorial, Mayor Adams with other assembled mayors, including Mr. Bloomberg. I had a sighting of Mr. Giuliani as well, and Mayor de Blasio. Along with them, the Vice President and the Governor of New York, Governor Hochul, Lisa.
All looking to commemorate a day that feels very recent in the minds of most people in New York in this business, and comes at another pivot point. And we're talking about the economic trajectory of the United States right now. And we remember 22 years ago when this really keyed off a real fundamental economic shift, not just for the city, but more broadly as well. So with us is Claudia Som, and I want to go there with you in terms of this muddle that we're in, this sense of whether we're going to see some sort of similar turmoil in the data that will really come out in a way that's predictable, and how we sort of look at those pivot points.
Yeah, well, I think Claudia Som has been really, really good on this. And to review this, folks, she has always been not a skeptic. This is important. But Dr. Som has not been a skeptic, but she said dig deeper into the data than the simplistic data, particularly that the financial media has. So I think there's a huge respect, even among elites at the Fed and frankly at other central banks, for the granularity of what Claudia Som does.
She was saying that it's a hold your breath moment for the labor market, that there could potentially be a continuation of the decline that we're seeing in some of the momentum, and how that could be a real problem. We're speaking ahead of a key week of economic data, CPI on Wednesday. We get out of the United States.
I completely forgot about that. We have CPI on Wednesday.
CPI on Wednesday.
I missed that.
PPI on Thursday, as well as retail sales at a time where people are wondering how long the U.S. can keep having consumers spend to such a degree when savings really do come up.
Yeah.
And this all comes the same week that the ECB has to make a decision, really with a slew of conflict and slowing growth.
Over the weekend, this happened to be a weekend where I did a lot of reading, and the different narratives that are out there are extraordinary. And you say to yourself, within equities, bonds, currencies, commodities, where are they going to fit in? And John was talking about the persistency of iron ore actually showing a China that's not going to end. I mean, for those of you on radio, we've lined up the events of the week, and what's not on there is China. Maybe this is a week where we walk away from China, but I would suggest, I don't hear people talking about 0%, 1%, 2% Chinese growth. I think there's a more buoyant tone there, even with their financial challenges domestically.
Well, today, or overnight, I should say, heading into the U.S. day, there was some strong credit data published out of China, which raised questions, are we at peak pessimism for China, which might have been part of the reason why the UN was actually responding to some of the jawboning that we heard from the People's Bank of China. I mean, this to me is interesting. Are we seeing signs that things aren't quite as bad?
And to dovetail it in with Mandeep Singh here, the key thing for Mandeep Singh is Apple's supply chain, which is where Mr. Cook created his career at Apple. And that goes again to we're bringing it full circle here to the president visiting Vietnam, just as one example, or maybe the hopes and dreams of India, where there's a complexity here of these stories dovetailing together, and I can't tell you where they're going to be. We're in September. Where are they going to be Halloween? 50 days out when my pumpkins have rotted.
Right. Which story is going to be more important? Do you buy a pumpkin early? Is that what you do?
We buy them decorative, and then, we have a carving feast like everybody else. It's embarrassing.
Wait, you buy them pre-painted? You're a pre-painting
No, I'm not doing the pre-painting thing. But, the vet bill and kennel fee, they got to go out trick-or-treating. So,
What are they going to dress up as? Cats?
Well, they go as cats. One year they went as cats. That didn't work out.
But this is a good point in terms of not really understanding how to game out further. What's going to be the predominant story at a time where geopolitics is coming in at a changing sort of economic regime?
We welcome all of you on a September 11th, on a Monday. September 11th for us on the weekend is just different. It is about a working day, as it was, with futures up 22, with life going on 22 years out. The imagery is very appropriate for September 11th, but this time is different. At the Pentagon will be the First Lady. In Manhattan will be the Vice President of the United States. The second husband will be in Pennsylvania, I believe. And the president flying back from India in Vietnam, that in itself, some huge ceremony in Vietnam. And to see the president have remembrances here. We'll see this later this afternoon, I believe, in Anchorage, Alaska. So it is a different September 11th, Lisa.
It is a different September 11th. And, we were talking earlier about how long it's going to remain such a front and center kind of visceral feeling. And it just has not faded. And we keep talking about how much that just has been a present feeling. It reconfigured the downtown of New York City. It reconfigured certain aspects of markets, really. And yet, one thing that as we celebrate the sort of opening of markets every day with the ringing of bells, life does go on. And there is that sort of push-pull amid the tragedy.
The hallmarks of our lives, and for those older, very few in remembrance of Pearl Harbor, but the idea of John Fitzgerald Kennedy's assassination in 22 years on from Pearl Harbor was Pearl Harbor 22 years on was 1963. I find that stunning. When I did that math in my head, I believe it was yesterday, it really set me back here. And we see it, of course, in Manhattan. The beginning of the ceremonies here, 3 minutes away from a first remembrance of a first plane striking the World Trade Center with mayors assembled. It was good to see Mayor Giuliani and Mayor Bloomberg there, as well as they lived it.
We're 3 minutes away from the moment of silence. Claudia Sahm back with us for a moment. And I would love just, Claudia, to get your sense of how an economy reshapes following a tragedy, following a massive disruption, and what lessons kind of are applicable today.
Right. Well, we're watching it today with COVID. I mean, we've certainly had national tragedies like 9/11 in the past. It's slow and it's painful. I think many economists underestimate that 3 years ago, we shut it all down, right? And there were a lot of disruptions. And I think, I certainly underestimated how long it would take to get things back on track, the transitory. It wasn't 1 year, it was 2 years. And I think there's a lot of disruptions we've seen that they're not unwound, and they may not, right? Like they may have a lasting imprint on the economy. But I think mainly it's just we got to give ourselves some time to get there.
Claudia Sahm, thank you so much for rejoining us again today. Dr. Sahm, of course, with all of her work at Sahm Consulting and, of course, with the Federal Reserve System. That reminds me, at least, of the courage of Roger Ferguson. Alan Greenspan was abroad on September 11th, and the vice chairman stepped up big in the absolute chaos that there was through that day and even into the next day, September 12th. Roger Ferguson is the one that solidified the financial system of America on September 11th.
A lot of commemoration today on the anniversary, the 22nd anniversary, when we think back to a time that was so recent, it feels like, in so many ways, that did reshape many aspects of downtown. The pomp and circumstance has grown with the years that have gone on, but really the emotion still very much present, Tom.
We welcome all of you worldwide and across this nation for this set of ceremonies. We saw the Pentagon earlier this morning, and I believe we'll see that later. And of course, Shanksville, Pennsylvania as well. And again, the President of the United States in Anchorage, Alaska. Look for that later this afternoon. There is, it's still emotional. There is a bell in Lower Manhattan. It's every year. I keep waiting, Lisa, for this to get easier, and it just doesn't.
No, it does not. And it doesn't for all the families that were torn apart, and it doesn't for all the people who lost the people with them who loved them.
Mayor Adams lined up with the governor of New York and others. Let us listen in now to this moment of remembrance. In Manhattan, in New York, a ceremony that we've seen for 22 years. Again, Bloomberg will give you full coverage through the day on Bloomberg Radio and Bloomberg Television of these memories across the nation. We'll listen a little bit more to this beautiful music. Firefighters, police officers as well. A data check here to continue back to our world. The future's up 23, Dow futures up 71, and the VIX 14.16. As we look at the equity markets and where we are in 2023, I can say it was easier in October of last year when Gina Martin Adams said, you have to participate, you have to be in the market. She never said, go to cash. She joins us today at a time where a lot of people want to go to cash right now. Cash is 5% plus, etc. There's an allure there. There wasn't there over 16, 17 years.
Right. And it is a very different environment. The equity risk premium is substantially lower than it was 15, 16, 17 years ago. It is a much more difficult environment for investing because of the distortions in the equity market as well. If you look at where the valuation excesses are in the S&P 500, they're almost entirely in the tech space, in the top 5 to 7 stocks specifically, and those stocks are very, very vulnerable at this moment in time, as we've experienced over the last couple of weeks. Any news on Apple, which is the biggest company in the United States, but also now bigger than the entirety of the small cap index in terms of market cap, is going to have a very significant impact on the index at large. So there are a lot of distortions to contend with. It certainly is a lot more difficult this time of this year than it was this time of last year, when investors were all very fearful. Now investors have generally gotten back on board, have been more interested and engaged in the equity market, and that naturally creates much more difficult investing conditions.
Is this a frustrating time to be trying to come up with strategy?
You know, I think that you could say that about any point in time. It's always frustrating. It's always challenging. There are new challenges. Part of the reason I love what I do. It never is never the same. Every day is different as an investor. Today's investing climate is absolutely substantially different than it was, especially 10 years ago, right after the great financial crisis. You had an environment of certainty with respect to interest rates that was unique in historical perspective. We had not been through that kind of climate before, at least as an investing generation. And when you have an environment of extreme certainty in interest rates, extreme certainty in terms of inflation and inflation levels, as well as volatility, that creates very different investing conditions than that which exists today. I think the most frustrating thing for most investors today is how generationally different the interest rate landscape is, the inflation landscape that is the backdrop for that interest rate landscape. Incredibly contentious and difficult for an investor that's been in this market for 20, 30 years. in which we just haven't seen this kind of climate.
Right now, people are talking about the difficulty in trading ahead of some key data that we get this week. CPI on Wednesday, PPI on Thursday. From your vantage point, how important are those data points? How do you trade around them at a time where it's not going to be one data point that moves the needle for the Fed?
Yeah, so it's different now than it was, say, earlier this year. Inflation became this major turning point for stocks late last year, early this year, when CPI crossed over PPI for the first time in more than a year. Consumer prices were finally rising faster than producer prices. Both are decelerating. So now it's a matter of continuation. That critical turning point was really consequential for equity portfolio strategies, without a doubt, and was a point in time when you wanted to rotate into more cyclically oriented sectors, away from defensive sectors, toward sectors with the potential for more margin expansion, whereas before we were sort of just generally worried about everything. Now it's just, can we continue to see this momentum, which is a very different environment. And frankly, it's a lot more difficult because you don't have these major turning points, these major catalysts for change. It's, will the Fed finally stop? It's, will CPI and PPI continue to improve? Which creates actually greater degree of stress and risk than the major turning points, which are the bigger opportunities.
My textbook says I'm supposed to look out 3 years. So if I do the math on Walmart at a revenue growth of 5% per year, I think that's a simple revenue growth of 15%. Microsoft's going to give me, say, 11% per year, which is a simple growth, double 33%.
Right.
Why in God's name wouldn't I buy Microsoft over Walmart?
Well, I think that most investors are doing that same calculation and coming to the same conclusion based upon where multiples are. You would assume that that is arguably priced in the
So
stocks.
are they rich? Is Microsoft or these luxury goods in France and the rest of them, are they value stocks?
They are still growth stocks. They're too rich to be value stocks, unless you get a surprise to those expectations, which I think is increasingly what investors are counting on, is not only am I going to get that 33% growth, but I'm going to see a surprise to the upside from that growth outlook. And that's what's commanding this excess in terms of
What do your
valuations.
people say? I don't care what I think, or
a lot of it, frankly, depends upon the rate of assimilation of AI and the rate of growth of AI. It's
she
transition in capital spending.
She has no clue. She's just reading Mandy.
That's very true. I think we all are, honestly. We all are trying to understand exactly what the implications are here.
Well, and I think that's what got priced partially into this tech space over the course of the last 6 months is, oh, wow, this is something new. We don't know how to price it, but we're going to presume that it's a lot faster potential growth than we were pricing 6 months ago. What is that faster potential growth? It's largely going to depend upon how fast those programs get embedded into capital spending plans, how fast they become an integrated part of overall operating efficiency improvements. And these are still TBD, right? We don't know, for instance, how fast a consumer staples or a retail company is going to pull AI into their operations. We have a pretty good handle on technology providers themselves. What we don't know is the rest of the economy and how fast that can improve.
It's a blue chip stock. Hostess was taken out. I lived on Twinkies for there was a 3-year window in the 60s where I single-handedly propped up Hostess. Is Smucker's, do they care? Does Smucker's Hostess, do they care about AI?
Sure, why not? In terms of their brand value, think about what their intangible assets are on their balance sheet and how important their brand is to them. To the degree that they can utilize AI to assess the degree of brand improvement.
AI is going to help them
100%.
With peanut butter, grape jelly combined?
Believe it or not, because they can utilize these technological advancements to understand their client base better. They can use any form of technology to figure out how to access their market faster. These are all efficiency improvements for these companies. In particular, the brand-centric improvements have huge upside for utilizing AI to figure these things out.
What does it mean to you that some of these deals are coming through right now? I mean, the fact that we are seeing this acquisition of Smucker's buying Hostess, of the idea that Instacart is potentially going public even at a reduced valuation. Are they trying to time the market? How is this playing out?
I don't think they're necessarily trying to time the market. I think it's a combination of things. The first is, one thing to consider is companies are sitting on an enormous amount of cash. And I think that we sort of forget the fact that cash on corporate balance sheets is still near all-time highs. Even with debt increasingly accumulating and the cost of debt rising, cash is still enormous, and it is fueling some degree of transaction value. The second thing to consider is just in an environment of uncertain growth, where growth prospects are going to come from, sometimes the best way to utilize that cash or to utilize your balance sheet is simply to buy growth. When you can't invest in it yourself, you have fewer return on investment ideas. Buying growth turns out to be a pretty reasonable opportunity for some of these companies. And then in terms of deals coming to the market, I mean, we've been through 20 years now of just no deals coming to the equity market. So any deals coming to the equity market are generally pretty well subscribed. In particular, deals that are in hot spaces, in growth areas of the market, deals are going to be subscribed because there is still some demand for equities, public equities, despite popular belief, and there's very limited amounts of supply.
Thank you so much. Gina Martin Adams here with Bloomberg Intelligence here on the equity markets. This afternoon, one of my favorite people, Howard Lutnick of Cantor Fitzgerald, will be with us in the 2 p.m. hour. He has, with his son, such memories and pain of September 11th, an important annual visit with Mr. Lutnick, always valued by Bloomberg. We're going to leave you this morning with the reading of the names. And Lisa, the hardest part here, these kids got bigger.
Yeah, well, yeah, they lost people who they didn't even remember.
They were little.
They were little.
And they're not little anymore. But it continues. Thanks to our team for the imagery today of September 11th. And we'll continue this. John Farrell will have it on television through the 9 o'clock hour, and we'll have it on radio as well. It is September 11th.
Firefighter Gerard A. Barbera.
Paul
Capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Live
from New York City this morning. Good morning, good morning. For our audience worldwide, we start with this quote right here from John Williams of the New York Fed to Mike McKee. Monetary policy is, quote, in a good place. Going into the Federal Reserve meeting next week and going into some important data this week. Equity futures positive here by 0.5% on the S&P. On the NASDAQ pushing higher as well. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, the Federal Reserve going quiet ahead of CPI data. Secretary Yellen feeling good about a soft landing as President Biden weighs in on everything from China to John Wayne.
Good evening, Vietnam. Good morning back in America. Now, let me also speak to significant business we got done in India during the G20 summit. This was an important moment for the United States to demonstrate our global leadership and our commitment to solving the challenges that matter most. Really what this trip was about. It was less about containing China. I don't want to contain China. I just want to make sure we have a relationship with China that is on the up and ups. China has a difficult economic problem right now for a whole range of reasons. There's a movie about John Wayne. He's an Indian scout. And they're trying to get I think it was the Apache, one of the great tribes of America, back on the reservation. The Indian looks at John Wayne and points to the Union soldier and says, he's a lion, dog-faced pony soldier. Well, there's a lot of lion, dog-faced pony soldiers out there about global warming, but not anymore. All of a sudden, they all realize it's a problem. I just think that there are other things on leaders' minds, and they respond to what's needed at the time. But I tell you what, I don't know about you, but I'm going to go to bed.
We're just waking up. President Biden from the G20 over the weekend. Bloomberg's Anne-Marie Hordern will join us shortly to discuss all things Washington, plus investors bracing. The key pieces of economic data this week. U.S. inflation coming up on Wednesday. Retail sales on Thursday, setting the stage for the Federal Reserve and its next rate decision just a week away on September 20th. This as Secretary Janet Yellen expresses fresh optimism that the U.S. will be able to contain inflation without major damage to the job market, saying this: every measure of inflation is on the road down. That conversation still ahead with Citigroup's Kristen Bitterly, along with TPW's Jay Poloski. Plus, JP Morgan's David Leibovitz joins us at the opening bell as Apple prepares its big iPhone unveiling tomorrow. This after shares fell by nearly 6% last week. Caught between the crosshairs of the tension between the United States and China. That's going to be a big conversation for us a little bit later, with equity futures positive here going into that opening bell. But first of all, for us this morning, it's September 11th, marking the 26th anniversary of the 9/11 terror attacks that hit New York and Pennsylvania back in 2001. We honor the victims, first responders, and all of those around the world impacted on that very day with a moment of silence in observance of when United Flight 175 struck the South Tower of the World Trade Center.
Christopher Bohan.
Lawrence Francis Balso.
Vincent M. Bolands Jr.
Tori Hamzavi Balorci.
Alan Bondarenko.
Andre Bonheuer Jr.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah. He's a troublemaker.
Yeah.
What did you get up to this
driven primarily by multiple expansion. Going forward, we need to see that earnings uptick and that earnings come through with that stronger growth as we shift from Fed tightening to fiscal expansion and manufacturing recovery.
Jay, can you say the same thing about multinationals exposed to the slowdown in China, the stagnation in Europe?
Well, one of the things that should help those specific companies, John, is if the Fed is done, as we expect, the dollar rally, which has been pretty strong over the last 8 weeks, up 8 weeks in a row, surprisingly to us anyway, we think that does not gain traction. And therefore, over the coming year, the dollar should weaken relative to the euro. It's at a record low versus the dollar in terms of valuation. Same with the yen. And that will help the multinational companies. And we've done a lot of work of this over the years. And really what drives U.S. companies is what happens in the U.S. Even if they have exposure to other parts of the world, the driver is what goes on in the U.S.
8 weeks of dollar strength into this week. The euro right now stronger against the weaker dollar, on the session at least, at 107.30 going into the ECB on Thursday. Over the weekend, the focus, of course, on the G20 wrapping up in India. World leaders discussing a wide range of topics from climate change to China. This is Secretary Yellen expresses confidence that the U.S. will stick a soft landing, saying this: "I think you'd have to say we're on the path that looks exactly like that. Every measure of inflation is on the road down." AMH is with us here in New York City. Anne-Marie, the politician speaking there or the economist?
Well, it does sound like she's looking at the slew of U.S. data. And what that does show is that as inflation is coming down, they are still able to maintain a robust jobs report. And this is really an opportune time for the Biden administration to want to tout this potential soft landing because, of course, Biden is not just the president right now, but he's looking for re-election next year. So it does seem that we're hearing more of growing confidence from the administration about sticking that soft landing. Of course, though, Jonathan, Secretary Yellen also talked about the fact that they are monitoring the slowdown and what's going on in China and the potential risks that that might mean to the U.S. or global economy.
Looking for re-election with crude at $87.60 and gasoline prices going in the wrong direction. Anne-Marie, what's the official take from the White House on that now?
Well, it's challenging. And what we did hear from some officials is that they think that what we saw in terms of what Saudi Arabia and Russia did, which was extend those cuts for longer than what was expected, is that they thought the market would stabilize. Of course, the concern is that we're actually past peak driving season in the United States, which was in the summer. So it's very weird that you see gas prices ticking higher. And $4 is what we're nearing towards on the national average. And obviously, that is a huge political problem because every day American consumers will be reminded, because it's right there on the side of the road like an advertisement, that it is expensive to fill up your tank as it is expensive for other items. Inflation is a key concern for Americans, and they continue to give the Biden administration poor remarks when it comes to handling of the economy.
AMH, thank you. On the latest, a wide range of issues over the weekend. Kristen Biddley, crude, close to 90. How does that square with the slowdown narrative in Europe, in China right now?
So when we're looking at what's happened, I think with crude prices, we clearly saw commodity prices jump around 6-7% in Q3, but they're still below their July peaks. And so we would not chase this recent rally in crude oil. A lot of it is more related to some of the policy driven and also demand side driven. And clearly, I would say the major driver of the spike in the price is really what Saudi Arabia and Russia are doing right now. So I don't think that there's a broader macro context here in terms of what is happening in Europe and China. And particularly, I think for anything from an economic perspective for China, what we really need to see is stimulus. And so we need the Chinese government. That's the major catalyst in terms of whether we see that fueling additional rallies within commodities.
Jay, it's not just crude though, is it? It's a conversation we've had before. It's iron ore as well, multi-month highs. What do you think's going on here?
Yeah, no, John, we'll take the other side of those comments. We're long commodities. We've been adding to commodities over the course of this year. There have been significant outperformer relative to bonds, and we expect that to continue. Yes, it is partly supply driven, but it's also demand driven. China oil imports are up sharply, and we think that suggests that the economy is starting to pick up. We're of the belief that one of the things we need to see, we talked about transition and traction. Obviously, the drips and drabs of Chinese policy need to gain traction. We do not expect the big bazooka stimulus. That's highly, highly unlikely. What we do expect is over the next couple of months, the stimulus policies that have been brought to bear over the last couple of months, there have been many of them, but they've been kind of small, will kind of catch traction together and drive the Chinese economy higher. And look, China is still growing at 4.5%, 5%. Manufacturing PMI was 49.7 last month, up 3 months in a row. Trade numbers last week, which everyone bashed, were actually better than expected and up sequentially. So we're of the view that in the coming months, China is going to reflect a better growth path, and that's going to be constructive for those very commodities that you mentioned. And so we have exposure and continue to hold exposure in the energy, industrial metals, as well as other segments of the commodity space.
Jay, look at that, like magic. You managed to say it and the lights stayed on. Last time Jay Pawlowski was bullish on China, the lights went off. Jay, stick with us. We'll talk about China and input costs a little bit later this morning with Jay Pawlowski and Kristen Bidley. Just want to set the stage for you this morning, going into the opening bell about 11 minutes away. Equities with a lift after a week of losses. The S&P 500 higher here by 0.5%. So equity futures pushing higher. Into the bond market, yields look like this, just a little bit higher as well on a 10-year by 2 basis points. The 10-year yield here at 4.28. The 30-year yield higher by 3 basis points to about 4.37. The New York Stock Exchange and the NASDAQ now observing a moment of silence to remember the terror attacks occurring 22 years ago on September 11th, 2001.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
us on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Equities high here. Let's get you some morning calls. First up, Morgan Stanley upgrading Tesla to overweight, saying its custom supercomputer could add another $500 billion to its enterprise value. Next up, Bernstein downgrading Brown-Forman to outperform, highlighting the company's improving margins and accelerating growth outlook. And finally, Baird naming Block as one of their top picks, saying shares are oversold after Square's system outage just last week. Final word now from Jay Pawlowski and Kristen Bitterly going into the opening bow 6 minutes away. Kristen, later this week, it really is crunch time for UAW and the Detroit 3. And one question that's dominated this program over the past week is whether that is an example of a hot labor market or just rear view type mirror stuff that we'll leave behind into 2024.
I think it's going to be rear view mirror. I think ultimately when we look at the impact that something like that could have on the overall economy, it's very, very different. And I know there's a lot of comparisons that people are making back to the 1970s when you had unionized labor representing, close to a quarter of all of the U.S. Labor force. Now it's around 8%. And so while that is something that obviously could have an impact, it's something that could lead to stronger wage growth overall. I don't think it's something that is really going to drive a lot of the economic activity and a lot of the market activity into the end of this year.
Jay, which one is it?
Yeah, I would concur with that, Tom. We're really focused on real income growth, and as inflation comes down, as disinflation takes hold, the consumer is actually generating real income growth, and that's our focus. That is what we believe will sustain consumption and drive a shift from inventory destocking, which is what we've had over the last year, to inventory restocking, and that's what's going to drive the manufacturing rebound we expect to see through the end of this year and into 2024.
Manufacturing up to services and not services down to manufacturing. The bullish outlook from Jay Pawlowski alongside Kristen Bitterly. To the two of you, thank you. To kick off the trading week, 5 minutes away from the opening bell. Equity futures pushing higher here by 5 or 0.6% on the S&P. Into the bond market, yields drifting a little bit higher as well on a 10-year yield higher by, let's call it 2 basis points of 4.28. Coming up, JP Morgan's David Leibovitz joins us on why U.S. equities are poised to outperform the rest of the world. That conversation is coming up next. Your opening bell is just around the corner.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
Look, I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? how's it going to resonate with their consumers. So as much as possible, I think probably I'll try and play that role.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
.24 seconds away from the opening bow this morning. Good morning to you all. Equity futures pushing forward, up higher, positive by 0.6% on the S&P. On the NASDAQ, up by 0.8%. Looking better this morning. We'll talk about that move in Qualcomm a little bit later in about 5 minutes' time. There's your opening bow. Switch to the board and get to the bond market. Going into CPI later this week. Retail sales later this week as well. That's Wednesday and Thursday, respectively. Yields higher by 2 basis points into that, just short of 430 at 428.60. After 8 consecutive weeks of dollar strength, we pulled back just a touch against the euro. Had a little look at 106 in the past week, 107.35 this morning, positive by 0.3%, and just shy of $88 a barrel on WTI, near the highs of the year, 87.95, positive by 0.5%. About 30 seconds into this session, equities higher by 0.6%, punchy on the NASDAQ. One stock to watch at the open is Tesla. Morgan Stanley upgrading shares to overweight on potential upside from its Dojo supercomputer. The analyst writing this, quote, "The same forces that have driven Amazon Web Services can work at Tesla, opening up new addressable markets." Simone Foxman has the story. Hey, Simone.
Hey, John. Yeah, supercomputer Dojo is being designed to essentially allow massive amounts of data during training processes to be processed by Tesla. And analysts at Morgan Stanley saying it could be worth add as much as $500 billion to the company's market value. Last close, we were at $790 billion worth of market value, so enormous amount of potential value added here. But the Morgan Stanley analyst also writing that it could put Tesla at an asymmetric advantage in a market that's potentially worth $10 trillion. The idea is essentially that it could make the company a software and services company rather than one just simply focused on hardware, by allowing this training data to be processed more quickly. Now, this is particularly interesting, however, because just a couple months ago, back in June, these same analysts at Morgan Stanley, led by Adam Jonas, saying that shares were pretty fully valued there around $265, but now putting a new price target, $400 on the stock. Shares, of course, in the moment about $261, up about 5% in today's early trading. John.
Simone, thank you. That 5% move in the first 2 minutes, that works out roughly $41 billion of extra market cap for that name right there, just like that. Turning to big tech, 2 names for you. Apple, Qualcomm. Apple is extending its agreement with Qualcomm for 3 more years, signaling its own chip isn't ready. The chip maker stating this agreement reinforces Qualcomm's track record of sustained leadership across 5G tech and products. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. The piece of technology is the modem that allows iPhones to connect to 5G networks or prior generations of lower scale network. And this deal runs for iPhone for 2024, 2025, and 2026. You'll remember, John, that Bloomberg's reported that in-house, Apple has been working on its own modem along with its other proprietary silicon strategies. And the story here is that doing it yourself is difficult, particularly when you want your modem to be able to connect to the latest generation network, 5G, but also work across jurisdictions. And you know what's interesting going into this Apple event tomorrow, and I think you and I will talk about this later in the program, is that we believe the iPhone 15 that was to be launched tomorrow would be the last generation that used a Qualcomm modem chipset. Well, based on the agreement that's out this morning, that is not the case, and Qualcomm will be the modem supplier for the next 3 years and 3 generations of iPhone to come. Financial terms were not disclosed, although it was indicated by Qualcomm that the agreement in terms of dollar volume or dollar amount is the same as their prior 2019 agreement. You and I have talked about what drives an upgrade cycle. We used to talk about the 5G super cycle. One thing that analysts point to is that this is pretty bullish for Qualcomm, bearing in mind that it won't be that long before we talk about the 6G super cycle and what that might mean to keep Qualcomm in this position as the pivotal supplier to Apple.
You know, we're discussing this in about 10 minutes' time. You also know that I want your view on that last story. Adam Jonas, that call over at Morgan Stanley. And I know you've read that. What did you make of it?
Yeah, look, it's really interesting because Adam Jonas first came out with this thesis in 2015, right? That the long term of Tesla would be very different to just being an electric vehicle maker. He saw them as offering a service akin to an Uber or a Lyft, a rideshare service where Tesla controlled its own fleet of vehicles and the proprietary software. Fast forward to 2023, and that's not quite reality. But in all the conversations around NVIDIA and them having the leading GPU for AI and training large language models, we were talking about Dojo in the context of training data, neural networks before NVIDIA. It's an area that Tesla has some competence in. They've pledged to invest about $1 billion in R&D to continue doing that. And you know, the point that Jonas is making is that it opens up more end user use cases, the ability to sell software services at a greater scale. So 2 things. Caution on Adam Jonas's history of making big predictions, but also credit to Tesla in the work they've done in proprietary silicon and in computing.
Helping to lift this market as well. Tesla up by 5% or so. Ed, thank you. Big move on the NASDAQ, up by close to 1%. On the S&P 500, up by 0.75%. That move on Tesla, potentially the best move of the month so far for Tesla. Sticking with tech, Citi expecting shares of Microsoft to outperform, saying this: the stock could trade well into earnings with a stabilizing PC market and accelerating revenue trends. That stock up also by 1%. Some big calls out there for tech. I want to turn to M&A. J.M. Smucker agreeing to acquire Hostess Brands for $5.6 billion US. The Hostess CEO saying this: we believe this is the right partnership to accelerate growth and create meaningful value for consumers, customers, and shareholders. Isabel Lee has this one. Hey, Isabel.
Hey, John. So investors will get $34.25 for each Hostess share, and that's a 22% premium from Friday's close. And shares of Hostess, which is the Twinkies maker, has surged more than 26% since before August 25, and that's the day that Reuters first reported that they're exploring a sale. So company sees the deal adding to an adjusted EPS in the first fiscal quarter, and they expect it to close in the third fiscal quarter. So that's around April 2024. So Bloomberg Intelligence says this acquisition may revive growth in the consumer division, and bakery goods have soared during the pandemic, and Hostess holds around 19% of that market share. As for Smucker's, it's fallen around some 11% year to date. But here's one thing I learned, John. Smucker was founded in some 126 years ago by Jerome Monroe Smucker, selling cider and apple butter door to door in his horse-drawn wagon. And now it's a $14.5 billion company. For now, those shares are lower by around 8%, while Hostess is up around 19%.
And now they're getting a piece of snacks that have no expiry date. Is that right?
Probably. I actually don't eat that a lot.
Extra long shelf life. Like 20, 30, something like that. Isabel, thank you. The latest there on that story. I want to turn to the media space. One question. Bills Jets, can you even watch it tonight? The contract dispute between Disney and Charter could leave New Yorkers in the dark for tonight's game when the Jets take on the Buffalo Bills. New York Governor Kathy Hochul and Bills supporter is pursuing repayments for subscribers, saying this: it's simple. If you pay your cable bill, you deserve to get the services you pay for. Abby has more. Abby.
Hey, John. Well, that does seem like a reasonable proposal by Governor Kathy Hochul, although I'd almost be willing to bet that she might no longer be in office by the time that made its way through Albany. Now, putting all of that aside, of course, we're talking about a financial feud between Charter Communications and Disney. On August 31st, Disney pulled ABC, ESPN, and some of its other channels from Charter, which owns Spectrum. So you have 15 million people across the country that are not going to be able to watch the Jets' opening season game. Now, in normal seasons, this might not mean all that much. We all know, even I as a non-football person knows, that the Jets is pretty beleaguered. They have not been in the playoffs since 2010. That's the longest drought for any team in any major sport here in the USA. But we have Aaron Rodgers joining the team. So everybody wants to see this game. So you have folks, especially here in New York State, 1.5 million people who may not be able to watch this game. Now, of course, they can sign up for other streaming services. Bars here in New York are really excited for the business as folks come in to see this game. But you have this financial feud again, where Spectrum is claiming it offered Disney a fair deal to carry its channels, but Disney demanded an excessive increase in price. There's no end to the blackout. On the year, John, Disney down 6.1%, Charter up 25%. This, of course, as Disney works to go through some of the kinks, including its struggling TV business.
Abby, thank you. If New York sports was a stock right now, it would not be doing well at all. About 9 minutes into the session, equities positive by 0.6% on the S&P. JP Morgan's David Leibovitz weighing in on the road ahead for markets and writing this. Growth is proving to be resilient against the backdrop of significant monetary tightening, suggesting that a tension between growth and inflation is beginning to materialize. David joins us now for more. David, can we start there? Can you start on that tension between growth and inflation? What do you mean by that?
Absolutely. So, if we go back to the beginning of this year, everybody thought that the second half of 2023 was going to be particularly challenging from an economic perspective. And what we've seen in the event is simply more resilience in the growth data, and that's continued throughout the third quarter, which obviously makes it difficult for inflation to return to where the Fed would like it to be. I oftentimes think about inflation as being like economic sweat, right? You end up with inflation when you're running an economy above its trend rate of growth. We estimate trend in the United States is somewhere right around 2%. And so the 2% plus growth that we've seen this year, we believe is going to make it a little bit more challenging for inflation to get back to where the Fed would like it to be.
What's the stubborn inflation trade then, David? Where do I want to be?
So I continue to think that the Fed will stay higher for longer, and so we continue to see opportunity in shorter duration fixed income. On the equity side, we think you want to lean into value, right? These are more cyclical companies. They tend to be more sensitive to the overall pace of growth, and so we want to take advantage of that window while it remains open.
Do they leave me exposed to the international story if I was trying to avoid the slowdown in China, the stagnation in Europe? How would I go about doing that?
Sure. So, I think value is interesting in the sense that, on the one hand, you have things like energy and financials. On the other hand, you have things like utilities and consumer staples. And so we would be leaning a bit more into the defensive parts of the value complex. But as you and I chatted about, I think last week, with energy prices at $90 a barrel or oil prices at $90 a barrel, there's arguably a story there as well. And so it's more about picking and choosing within value as opposed to embracing the style as a whole.
David, on crude, and you're right, we did talk about this last week. Let's do it again. What do you think that speaks to? 91 Brent, 88 WTI.
So I think at the end of the day, there's an issue on the supply side and an issue on the demand side as well. We're seeing, if we start with demand, we're seeing growth in places like Europe and China obviously come under pressure. But, here in the United States, things are still progressing relatively nicely. And so while pockets of demand may be rolling over, we're not seeing demand in general or in its entirety begin to show material signs of weakness. At the same time, you have limited supply. And I think that that's really been the story as of late. Right, with OPEC and other oil-producing nations cutting back on the amount of oil that they're supplying to the overall market, that's pushed prices up to levels that haven't been seen in quite some time. And we can't forget about the United States, right? We obviously generate more oil here, produce more oil here than has been the case in the past, but do we produce the right type of oil? And that's why I think you're seeing diesel prices in particular move aggressively higher.
That's a great point. Close to record output. The latest number, 12.8 million barrels a day in the United States, getting closer and closer to 13. David, when we put it all together, what's the preference at the moment? Domestic, US, or international?
So we would be leaning more into the U.S. relative to the rest of the world. When we look at what's happening in China, and it kind of feels like policymakers may have their hands tied in terms of stimulating that economy in a more effective way. You look at Europe, cracks are beginning to form. Inflation is stubborn, but growth is in the process of decelerating. And so, the U.S., it's not perfect, but arguably it's the best house on the worst block. That's where we would prefer to hang our hat. And within the United States, we do have a preference for large caps relative to small caps. We do think that volatility is going to pick up here as we get closer to the end of the year.
And some of these great brands just caught in a rock and a hard place at the moment, between a rock and a hard place. I'm thinking of Apple. I know you can't speak directly to that kind of name, but David, the exposure to China at the moment, what kind of exposure are you and the team looking to take?
So when it comes to the China story and the underlying exposures, I think that there are, two ways to think about that aspect. One is the exposure on the supply side, right? Does a certain business make a lot of things in China? Two is exposure on the demand side. How much of a market does China represent? And as we've seen with some large technology companies as of late, the demand side is real. And so I think we need to be tuned in, particularly to regulatory risk going forward, because if I was a betting man, my best guess would be that we haven't seen the end of the trend that's kicked off here as of late.
I think most people sitting at home nodding their head agreeing with you. David, thank you, sir. David Leibovitz there of JP Morgan. Speaking to some of the tensions around the story with Apple over the last week, that stock down last week by close to 6%. Coming up, Apple preparing to launch its next iPhone.
What continues to come out of Cupertino is the gold standard. This is a mini super cycle, despite a lot of the bears coming out of hibernation mode, after Apple's run.
That conversation up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. JetBlue has traveled a long way from its startup days, but CFO Ursula Hurley says growth won't change the airline's quirky attitude.
At the end of the day, we view ourselves as a disruptor and a maverick in the aviation industry, and I'm really excited to play a meaningful role in that growth journey.
Watch Chief Future Officer Wednesday on Bloomberg. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
They've gained an incremental 125 million users over the last 2 years. 250 million iPhones have not been upgraded in 4+ years. And if you look at this special chip camera technology and what continues to come out of Cupertino is the gold standard. And that's why I believe, especially with a lot of big carrier discounts, this is a mini super cycle, despite a lot of the bears coming out of hibernation mode, after Apple's run.
They came out of hibernation big time in the last week or so. Dan Ives of Wedbush reiterating his bull case for Apple ahead of tomorrow's big launch event. The company preparing to roll out the iPhone 15 along with their newest smartwatches and AirPods. This coming as Apple extends an agreement to get modem semiconductors from Qualcomm for 3 more years, a sign that its effort to design the chips in-house is taking longer than expected. Ed comes back with us for a little bit more. Ed, big day tomorrow. A lot of weight on the shoulders of Mr. Cook going into this launch.
Yeah, and you and I won't know if this is a mini upgrade cycle until after the fact, but what we're expecting is 4 variants of the iPhone 15. 2 base models, the 15 and 15 Plus, 2 Pro models, the Pro and Pro Max. And as Dan Ives was talking about, a big focus on the Pro lines, on the silicon updates and the camera technology. So on the iPhone 15 Pro and Pro Max, we expect Apple's A17 processor, its latest generation processor, along with a U2 UWB chip, RF chip for short distance connectivity. On the camera side, we're expecting not just software upgrades, but also optical hardware upgrades, particularly on the Pro Max, that will take it from a 2x zoom to a 6x zoom. These are substantive hardware upgrades that we haven't seen in recent refresh cycles. On the design side, titanium sides to the Pro line as opposed to aluminum or steel, a sort of higher quality but lower weight product. And then again, updates to iOS along with some kind of more minor updates to the Apple Watch series and then USB-C connection coming to the AirPods. The timing of this Qualcomm announcement this morning really interesting because we believe that the iPhone 15 lines to be announced tomorrow would be the last generation that Apple relied on Qualcomm's modem. That's clearly not the case. This deal between the two runs through to the 2026 edition of iPhone. And as you said, it's evidence that making it yourself is hard. Apple isn't quite there with its internal work on the modem. Qualcomm has the best chip at connecting to 5G networks, and it won't be long before we're talking about 6G networks. Just real quick, John, on silicon, the base models of iPhone 15 and 15 Plus, they'll have the A16 processor, which was in the 14 Pro lines. So they're just recycling their tech from those Pro last year and moving them to the base model this year. Gosh, that's a lot.
Speaking of challenges, just away from all that jargon, just for a moment, the 2 big challenges in the past week, 1, Huawei, 2, China, and China specifically banning phones at a government level and maybe across the state firms as well. Ed, what do you think is the bigger issue for that company at the moment?
Yeah, look, I still go back to what Apple told us in the earnings call, and I'm surprised that more people aren't speaking about this. China was a pocket of strength in a broad, weak quarter for Apple in the June quarter. It was a record in China in the June quarter. They swung to 8% top-line growth in China from a 3% decline the prior quarter. And they attributed it almost solely to switchers, consumers in China buying an iPhone for the first time or switching from a non-iPhone or non-Apple brand. So my question to the market is, does this Chinese government action impact the psychology of the consumer there such that it outweighs the hardware upgrades that are coming in 15? It's still such a key market. So the impact, we don't know what it will be because we can't quantify how many users are sprinkled across these government agencies. But it's worth asking the question.
I'm asking precisely the same thing. Ed, thanks for being with us, mate. We'll catch up with you tomorrow. Let's stick with tech. Oracle earnings coming after the closing bell. Investors focused on whether its cloud unit can continue gaining market share. The analyst over at Mizuho had this to say: despite the uncertain macro, demand for back office applications remains robust. Anurag Rana of Bloomberg Intelligence joins us now for more. Anurag, what can we expect a little bit later?
Yeah, I think we should expect decent growth on the back office cloud applications. But to be very honest, the biggest question is what is going to be the cloud infrastructure growth, because that's the big number that surprised everybody last quarter. It grew 77% in constant currency. And that's where I think the bulk of the call is going to be around that particular product and how it's gaining momentum in an area where Amazon and Microsoft are, the growths have been slowing down in the last 12 months.
We'll get your reaction a little bit later today. Anurag, thank you. That stock is down by a little more than 1%. Those earnings coming after the close. About 22 minutes into the session, equities advancing here by 0.4% with some sector price action. Here's Abby.
And that gain for the S&P 500, John, is the best day in the month of September. Right now, not surprisingly, we have most sectors higher, led by consumer discretionary up 1.6%. Tesla is greater than 5% gain on that Morgan Stanley call, really helping out there. Tech overall, though, down slightly. Industrials also down. over the last couple of months, John, in fact, in this quarter, one of the best sectors, energy. It's heading to its only up sector this year and the best sector since December of last year, up 12%. Really a turnaround there.
There we go. Abby, thank you. Coming up next, your trading diary, stacked week, just around the corner.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well? Or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg.
So far, so good. Early days, I know. 25 minutes into the session, equities advancing here by 0.5% on the S&P. The NASDAQ looking okay as well, going into a key week again for Apple and that launch of the iPhone 15 just around the corner. That's the equity price action. Here's the trading diary. Coming up, President Biden delivering remarks in observance of 9/11. That's at 4:45 Eastern from Alaska. Tuesday, Apple's launch event from Cupertino, California. Wednesday, we'll get US CPI data. Thursday, initial jobless claims, US retail sales, and an ECB rate decision. And finally, the UAW strike deadline with Detroit's Big Three. Big week ahead. From New York City, this was the countdown to the open. Thank you for choosing Bloomberg TV. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Welcome to Bloomberg Markets. I'm Alex Steele. Here in the United States, we're marking 22 years since the 9/11 attacks. Memorials are being held around the country, remembering and honoring the 2,983 men, women, and children killed in the attacks. We now head to the next moment of silence to observe the fall of the South Tower in Lower Manhattan.
Gilbert Franco Granados. Lauren Catuzzi Grancolos and her unborn child. Elvira Granito. Winston Arthur Grant. Christopher S. Gray. Ian J. Gray. James Michael Gray. Tara McLeod Gray. John M. Grazioso. Timothy George Grazioso. Derek Arthur Green. Wade B. Green. Wanda Anita Green. Elaine Myra Greenberg. Donald Freeman Green. Gail R. Green. James Arthur Greenleaf Jr. And my brother, Kevin James Murphy. Kevin, we love and miss you. Beth, Connor, and Caitlin know that you are with them every day. We have all had the privilege of seeing Beth's strength and the incredible job she has done, and we know how proud you are of your family. We're lucky to cherish the time we have together, and we are grateful to be part of their lives. They are close and loving as a family can be, and your spirit lives on with them. And I would also like to thank everyone who has been part of this memorial service for the past 22 years. You have been here with us to pay tribute to our loved ones and to make sure they are remembered and honored. Over the years, you have treated us with respect and with compassion. Your actions allow us to keep our focus on our family members who are no longer with us. Thank you all for being here with us. May God bless you, and may God bless America. And my grandfather, firefighter Robert James Crawford. Being your granddaughter is something I will always be so grateful for, and a title I am blessed to have. I'm so proud to be part of you and to be able to carry you with me wherever I go. Our hero, we love you to the moon and back. Keep watching over us. We know you're always close.
Eileen Marcia Greenstein.
Elizabeth Martin Gregg.
You've been listening to the observance of the fall of the South Tower in Lower Manhattan. We want to take you now to the moment of silence near Shanksville, Pennsylvania, to observe the crash of hijacked Flight 93.
Replaying at the site. Thank you.
Christian Adams. Lorraine G. Bay.
You've been watching the moment of silence from Shanksville, Pennsylvania, in observance of the crash of hijacked Flight 93. And you can continue to follow today's events commemorating the 9/11 attacks on the Bloomberg terminal on LiveGo. From New York, I'm Alex Steele with Tom McKenzie in London. Guy Johnson is off today. Tom, I very much appreciate you joining me on this solemn day here in the United States. That said, we are looking at markets. For the equity market, we're relatively on the upside ahead of a very big week, which I feel like have tons of things that could really shake up different parts of the market.
Yeah, the early optimism in Europe has faded a little, but you're right, it is still there. We're still holding on to gains. So far, you're looking at 2 straight days of gains for European markets after a challenging week last week, and it is very much about US dollar as well, at least for now. A big week, as you say, lots on the docket. The ECB meeting, of course, inflation data out of the US. That, of course, brings us to our question of the day. What is the main event this week? Joining us now are Bloomberg's Edward Harrison and Christina Kino of Bloomberg Markets Today. Christine, let's start with you. What for you is front and center?
Well, Tom, you know what? I mean, I'm going to go out on a limb here and say it's not inflation data from the U.S. It's not the ECB. I'm actually going to be watching the UAW strike potential because this is one of those sort of wild card events that could really upset the current trajectory of economic data and the narrative that we have from the Federal Reserve and central banks around the world. We generally know that inflation is on its way down, maybe less so in some parts of the world, but certainly heading in the right direction. We also generally know that policymakers the world over are kind of heading to this pause sort of moment. But, you know, this potential strike from auto workers in the U.S. is exactly the sort of event that could upend all of that. I mean, we're looking at $5.6 billion of growth shaved from the U.S. economy of just 10 days of strikes. And I know a little bit about strikes, having moved from London to New York. You know, London, as we know, Tom, it's the land of strikes. We've seen it impact both inflation and growth data over the last few months.
It's just going to follow you. And you know what? We hadn't talked about this before, but I totally agree with you. I think that everything can be important, but I'm really watching those strikes, particularly the political ramifications. Edward, so what say you?
Yeah, you know, I'm going to piggyback on what she had to say, but I'm going to say it's the CPI. And the reason is because that's what's going to allow us to understand how responsive the Fed is going to be to the incoming data.
But is the market going to have the right interpretation of the data?
Right. That is a good question. I think that the interpretation the market has is that the Fed's done in terms of their hiking or nearly done, and then the question becomes 2024. So I think CPI, if it surprises to the upside, is going to tell us the Fed is more likely to stay on hold. All the rate cuts that we're still pricing in for 2024 may not be there, even if we have a UAW strike. And let me just say that the interesting bit is that when you look at the Fed, now we have 3 different Feds that are giving us nowcasts. We have over 5% from the Atlanta Fed. We have 2% or 2.2% from the New York Fed, and we have negative 0.5% from the St. Louis Fed. So you have a very different outlook from the 3 different Feds. So the UAW strike could be something that changes the trajectory because we really don't know where we are at this particular juncture.
Which makes the comments from the Treasury Secretary so fascinating, of course, Janet Yellen. And Christine, I want to put this to you then. She sees on every metric the inflation picture heading in the right direction. And again, reiterating her view that there will be a soft landing for the U.S. economy. Is she right?
Well, Tom, I mean, based on a lot of the data that we've seen, it seems like the soft landing narrative probably has a lot more water now than a few weeks ago or even months ago, right? When a recession was very much kind of front and center for a lot of investors. And I think what we really have to thank for that is just the resilience of U.S. consumers based on what we've seen from the job market specifically, but also just generally. I mean, consumer spending patterns still holding up very robustly, even in the face of higher prices and what have you. And so I think it really is because of that. That's why that the narrative now seems to be shifting to not the worst case scenario as we had envisioned even at the start of the summer.
Are you guys watching technical levels at all? And I say that because I feel like last week was a really big week for the dollar, for Apple. We're looking at a golden cross for the Bloomberg Dollar Index where it could really be a strong bullish signal. Like, are you guys monitoring that, or is that sort of like, okay, yeah, we know that we could see upside. Let's just move on to the fundamentals, Edward?
I am. You know, there's a channel that we're in terms of upside for the yield. I'm looking at 438 for the 10-year, and I'm looking at 444 for the 30. 444 for the 30 would get us back to 2011. 438 would get us back to, I think, 2007 on the 10-year. So we're in a channel upward for yields that potentially CPI could give us more oomph to the upside, and that's very negative, not just for bonds, but also for stocks.
Yeah. Christine, what about you?
All right.
Sorry, Tom.
Well, you know, I think...
No, I was going to pick up on the sorry, Christine, I was going to pick up on the channel higher for yields and then tie that in. I don't want to let you go too easily, Christine. You've left us, we're still in mourning, but around the ECB, because of course that's going to be a fascinating decision later this week as I look at yields here, at least in the Eurozone, edging slightly higher again.
Yeah, absolutely, Tom. And that really puts the ECB in quite a bind this week. I mean, we have seen expectations from the market in terms of what they're going to be doing, still pointing toward a rate hike. That's really the standout among a lot of other central banks, where a lot of traders are kind of accepting that perhaps the Federal Reserve and the Bank of England nearing the end of the rate hiking cycle. Really not the case for the ECB. But then at the same time, we're also starting to see more data showing negativity in the economy, right? We're seeing some of those PMI indicators slowing down, forecasts for just a slower economy in general. And, you know, this really is the price that the ECB has to pay for being the last major central bank out of the gate to really deliver those rate hikes.
I like how Tom had to get the ECB in there. Like, these guys didn't say the ECB at all, but you're like, I got to put it in there because I'm in London. It's a fair point. It's a fair point. We'll look at that in the 11th. I guess my other question here is, none of you have mentioned China. And we did see a stronger fixing than normal. We have a relief for the yen and the yuan. We get a data dump on Thursday night. Property prices, retail sales, we're waiting to see if a countrywide bond is going to be able to be paid. Is this priced in, do you guys think?
Well, you know, I'll respond because I think I was thinking, you know, before we leave, we should probably talk about the yuan and also about Japan in terms of their potential intervention, because that's what everyone else is talking about today. My view is that that's a sideshow to a certain degree. That number one, in terms of intervention, if you want to intervene, your monetary policy has to be in line with that intervention, and as long as the PBOC and the Bank of Japan are still easy, you know, their currency is not going to do very well. And ultimately, the center stage is the United States and the strength of the U.S. consumer, because that's where the rubber hits the road in terms of how well this global economy is going to do.
Christine?
Well, you know, I think the China story, again, Alex, right, is priced into a large extent. And I think now the narrative has shifted to how bad do things have to get before the Chinese authorities finally come out with that stimulus bazooka and really target consumer spending, because that's ultimately what a lot of people are waiting for at this point in time, right? And so, you know, unless we get to that point, it seems like we're kind of in a bit of a holding pattern in terms of how markets are interpreting the China news. We know that it's bad news, right? And that has been priced in a few weeks ago when we got that big negative data dump out of China. And so if it is just a continuation of that pattern without any action from the authorities, then it might just be a story that bubbles over for quite some time.
All right, we got CPI, UAW. All right, that's where we're at. Edward Harrison and Christina Aquino, thank you both very much. Really appreciate it. Some breaking news for you. This is according to CNBC. The Disney and Charter are nearing a carriage deal. You're looking at both of those stocks hitting session highs. This is, of course, a deal of how much Charter is going to pay to broadcast Disney's cable channels. According to CNBC, they could be nearing a carriage deal. All right, coming up, more on the question of the day. What is the main event this week? Nisha Patel of Parametric Portfolio Associates joins us next. This is Bloomberg.
ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
I think there's still a window for a soft landing, but I think they should be very aware of the fact that there is a squeeze play going on consumers. You've now got these higher oil prices, higher gasoline prices, you've got a resumption of student loans, people are having to deal with these higher mortgage rates, and they're gradually pushing up their credit card balances, but there's a limit to that. So you're going to see consumer spending slow down.
If you look through a variety of earnings calls, companies saying consumers are becoming more cost conscious. They are pushing back. They are adapting to this intense price environment around them. So I would say expect some moderation. From my seat, I wouldn't see that as reason to panic, though. I see that as evidence of rationality.
The consumer really has taken on a lot this year. And, they've gotten a little bit of relief, but honestly, there's a lot of consumers that think they really just haven't seen as much relief as they need.
Those were some of the Bloomberg TV guests responding to an MLive survey on the outlook for U.S. consumers, which brings us to the question of the day, because we do get U.S. retail sales later on this week, is what is the main event? In my mind, there's a ton of stuff going on, whether you're looking at potential worker strikes for Chevron in Australia, or if you're looking for the auto worker potential strike, you got Apple, the ARM IPO, technical levels, China dump, ECB, CPI, there's a lot of stuff. Nisha Patel, Parametric Portfolio Associates Managing Director for Fixed Income, joins me now. I appreciate that you're fixed income, so I appreciate that the question is skewed. But what's the main event for you this week?
In my view, I think it's the CPI data. So I think, the market is, look, as we've seen with where 10-year Treasury yields have gone, there's a lot of optimism that we're going to outright avoid a recession, a significant slowdown. But inflation continues to be above that 2% target, right? So there needs to be that continuous momentum that it's trending downwards. Otherwise, there's going to be some concern that hawkish tilt that the Fed has, they're going to continue to raise rates, and you could see rates going higher from here, which in turn, has a negative impact on the long-term growth of the economy and the impact to that.
So, Nisha, how much conviction do you have? It sounds like you align with the Morgan Stanley warning that maybe the markets are not pricing in enough the risk around a recession. How much conviction do you have that it's the long end of the curve that you want to get exposure to at this point?
We are very convinced that you at least want to start thinking about hedging, right? So, again, in this rhetoric of rates could stay higher for longer, you have money market and CDs earning 5+%. There's a very short-term and short-sighted kind of narrative here for investors. But we're pounding the table here saying this is a time you want to start hedging for exactly that, right? If rates correct, long-term rates start correcting for, let's say, inflation trends down, you have slower growth. Economic data, week over week, month over month, is starting to slow that shift and slow down. This is what investors want to start positioning for, having duration in their portfolio. And the Fed, well before they start cutting, this is a very communicative Fed. We're in a different era here. You have to start thinking about this is going to be priced into the market well in advance before the Fed even starts cutting rates.
So is going long duration a yield play, or is it a capital, or is it appreciation, a price appreciation play?
So I would say it's a little bit of both. If you look at absolute yields, you're looking at very attractive yields, especially in the investment grade space, right? I think high yield spreads continue to be on the tighter end today, so we don't feel that investors are necessarily getting compensated for it. You start looking at investment grade yields today. In the investment grade corporate space, you're looking at yields close to 5.5%, 6%. On the municipal bond side, tax equivalent yields of 6.5%. That yield provides not only a significant amount of income, but a significant amount of cushion if rates were to continue to rise from here. But on the flip side, to your point, that upside per return potential, that appreciation, that can occur if rates drop. It's fairly significant, right, by having duration in clients' portfolios. So it's a very attractive and opportunistic time to start legging into the market and adding duration here.
So, Nisha, I mean, given your relatively cautious outlook about the economy, do you expect to see spread widening then within investment grade? You say you are being rewarded for that risk at this point. Where do you see that widening of spreads in a more challenged environment then, economically?
We do. So, right, if we have kind of that slower growth being priced in through year end, it is in our view that we're going to see the 10-year at a lower yield by the end of this year than where we are today. We're expecting IG spreads to kind of hang in there. You could see a little bit of widening from today already, to keep in mind that they're at, kind of at averages or tighter to kind of the 10-year average. High yield spreads is, I think, where you're going to really start seeing that crack, right? You really haven't seen a significant widening in high yield spreads, which is where you typically start seeing the cracks when you have that slowdown in recessionary period. So that's another reason why I think the high yield space, you could have more of that spread widening occur in that part of the market where a lot of it isn't being priced in.
Do you think that the Fed's going to cut because they're going to normalize, or because there's going to be damage to the economy?
I think they're going to, I think you have a Fed here that isn't going to cut rates to normalize. I think they're going to do it and use that tool if they need to re-stimulate the economy. Right now, you still have this whole one more rate hike possibly being priced in, right, even before the cuts start. But I don't think you have a Fed here, especially with where inflation is, especially how strong labor markets continue to be, that they feel like they need to normalize rates and bring it down simply because that's what they've historically have done.
All right, Nisha, thanks so much. Just if you're counting, it's 2 for CPI and 2 for the UAW, and Tom's like doing something with the ECB. All right, Nisha Patel of Parametric Portfolio Associates, thank you so much. Nice to see you. All right, still ahead, Apple and Qualcomm extending their deal on modem chips for 3 more years. What that winds up meaning for Apple, that comes up in the startup next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So
beginning of 2025, if not the tail end of 2025, and they wanted to give themselves a little bit of leeway agreeing through 2026. Now, you have to look at Apple and how many devices they have. They have several SKUs of the iPhone. They have many SKUs of the iPad. They have the Apple Watch as well, and they need to get their own modem to work in all of those different devices and also have them certified to work across the world on hundreds of different carriers in hundreds of different countries. And they have to deal with the bureaucracy of that as well, the testing, the different conditions. They have to have the chip work on 3G, 4G, and 5G. And that's not something they can do in one full swoop. So my belief is they'll begin the transition with 1 or 2 models in 2025 and gradually expand that to more models across 2026 and into 2027.
Mark, Ian, bear with me. This is what Qualcomm said this morning in their statement. This agreement reinforces Qualcomm's track record of sustained leadership across 5G technologies and products. And as Ian outlined, the deal carries through the 2026 generation of iPhone. And as Mark, you just outlined, you think that this will be phased with Apple. Where does the modem sit within Apple's other activities in silicon? Because actually, I think what we expect in 24 hours' time is more proprietary silicon from Apple going into the latest handsets.
Yeah, it's just one leg of the stool, right? Apple's hardware technologies organization, the modem is a high priority component there. They have offices in San Diego, Cupertino, multiple places in Europe, including in Munich, Germany, working on this modem. They have thousands of people on the effort. The person in charge of the modem is actually a former Qualcomm vice president who left about half a decade ago to come to Apple to work on this project. Johnny Srouji, who is Apple's senior vice president of hardware technologies, who oversees all the custom silicon, there's a special place in his heart against Qualcomm. And so certainly this is a very important effort for Apple. They want to design Qualcomm out of all of their products. They've been working on this extensively. They've run into battery life issues. In terms of where it sits in the overall organization, they have their Mac chips. And then tomorrow they'll announce one new chip, the A17 processor. That's going to be the company's first 3-nanometer chip. That's a major milestone for the company. There's also going to be a new wireless component that's less significant, but certainly the A17 chip will be one of the core elements of the iPhone 15 Pro and Pro Max announcement on Tuesday.
So Qualcomm shares up 3.5%, on track for the biggest jump since July. Earlier in the session, on track for the biggest jump since May. And let's spare a thought for Qualcomm and what it means for them. You know, I said that this was a surprise, knowing that Apple was working on its own modem, but this is good news for Qualcomm.
Yeah, I mean, you looked at the analyst notes this morning and they're saying this is like $7 billion of good news for Qualcomm. Qualcomm had an analyst day last November where they said, look, just take out the Apple numbers going forward. Take them out, act like we don't have that business anymore, and they still do. So clearly that's a pat on the back for their abilities. This is a very difficult thing, as Mark just explained. It's not just a case of, hey, design a nice piece of silicon. You know, there's a lot of software tuning, a lot of work, a lot of insider knowledge that goes into that. And the fact that a company with the resources of Apple cannot replicate that effort in a timeline that they had set for themselves tells you that Qualcomm is doing a good job.
All right, Bloomberg's Mark Gurman on Apple, Ian King on Qualcomm. Thank you. And speaking of those analyst notes, let's bring in Jordan Klein, Managing Director at Mizuho Securities. In a note out today, Klein wrote the news is a best-case scenario for Qualcomm, as some thought maybe Apple would only do a 1-year supply deal and then move on to their own chips. Mark Gurman just explained that. So how do you see it, Jordan? The transition using Qualcomm's modem to using Apple's own proprietary silicon based on the deal announced today?
Well, thanks for having me. I mean, I agree with your host is kind of what they said, that Apple's been working on this for years. It's taking them longer. You know, we think they're going to gradually migrate over to their own custom baseband. It's going to take them, you know, again, probably at the earliest till 2025. You know, we think it could be their lower end SE4 that could start using their own baseband, and then they would gradually shift to other models in the lineup in 2026. So, you know, but it's 3 years. It gives them time. And in the meantime, you know, Qualcomm kind of sustains its leadership position and gets the added revenue and earnings that they would have lost starting next year.
Jordan, I spent all of 2021 and all of 2022 talking about the 5G supercycle. Unbelievably, my mind's already going to 6G. And I just wondered if you could talk us through how you see Qualcomm as positioned if we're all going to move on to 6G and the relationship with Apple in the future.
Well, it's a great question. I mean, again, like I said, Qualcomm is viewed as the best company in mobile technology, and there's a reason for that. They've been doing it longer than anyone. But if you ask the company about 6G, and people have on their earnings calls, I mean, they don't even really think it's going to be an impact until the end of the decade. So, you know, at the earliest, you're talking 5-6 years away. It's going to take a long time for that to evolve. So I think right now their focus is broadening their revenue base, moving beyond mobile. I mean, there's a reason at that investor day a year ago, they told the Wall Street community to kind of take this Apple business out of their revenues. I think that they wanted to move beyond Apple. They want to go into automotive, IoT, other areas of the market, even PC computing, where they can diversify beyond mobile. So look, it's going to be really big for them when the industry is finally ready to go to 6G. But to be honest, I think we've got multiple years between then and now before it will really matter for the stock or investors.
I've spoken to Cristiano Amon so many times about this move towards automotive. Indeed, actually, the importance of on-device running of LLMs, you know, it's another area for Qualcomm. Can they maintain technology leadership for smartphone modem at the same time as trying to move and grow these other areas?
Well, I definitely think they can. I think that they make so much profit and money from the baseband and the modem business. And really, when you think about it, I mean, their licensing business is almost 100% margins. It's basically a license to print money. And they take a lot of that and they use that to develop, you know, new areas of silicon, new technologies. And they're out there talking, you know, a big game about how generative AI is going to move from in the cloud in these large, big data centers towards the end user device. And that's where they think they'll have an edge because of their advantage in mobile processing units, where they're also a leader. So I think, again, the time's going to tell if users are going to want to, you know, upgrade their phones to a more powerful mobile processor where they think they can get advantages doing AI on their device.
Jordan, of the universe of chip names that you're covering, who do you see as best positioned to take advantage, I suppose, of the CapEx and R&D commitments right now that are going into how technology companies of all sizes use AI within their core businesses?
Well, I think first and foremost, that conversation or that answer has to start with NVIDIA. I mean, there's a reason it's almost doubled this year because they're just dominating the shift in terms of processing from CPUs, traditional server chips, towards global, you know, graphics processors, which are much higher power, much more energy efficient. So I think you start with NVIDIA that again has a big advantage and a lead over their competitors. But I think as we go into 2024, companies like AMD clearly are going to be in the mix. Marvell and Broadcom are also big contributors or contributing to this AI investment thesis. And then I wouldn't count out Intel. And I would also look to these memory companies like Micron, because you're going to need a lot of memory to run these systems.
Jordan Klein of Mizuho, good to catch up and have you here on Bloomberg Technology. Thank you. All right, so the clear top story of the day is Qualcomm and Apple, but let's check in on the markets. The story is outperformance in the technology sector broadly. NASDAQ 100 up 0.6%. Look at the underperformance in semiconductors, though, down almost a percentage points on the Philadelphia Semiconductor Index. Yields creeping higher, up 2 basis points, 4.28% on the US 10-year yield, and Bitcoin is still at around $25,000 per token. Remember, CPI Wednesday. The market's kind of treading water a little bit going into that eco print. Why? Because we want to see what the Fed does in reaction to it and how the market prices that in. So many more technology stories ahead. This is Bloomberg Technology.
what do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
From New York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Okay, so this is the market story. US majors trading in the green today. The S&P 500 near its 4,500 level. The story has been outperformance in the session of technology. We get the CPI print Wednesday. In the last 7 days, a new story snuck in, which is concerns about China, US-China tensions, but also what's happening with the technology sector in China. Remember, the NASDAQ 100 is up more than 40% year to date. Why? Probably artificial intelligence. Let's tie this all together and bring in Linda Dussel, Federated Hermes Senior Equity Strategist. That's a tough thing to ask, Linda, but right now, from a technology sector perspective, what is driving these markets?
Well, I think you made the important point, which is that artificial intelligence, the AI craze, isn't really a craze; it's a revolution. And as your previous guest discussed in depth, whether or not we peaked out in our use of ChatGPT for the moment. Lots of companies out there are building for what is going to be a great productivity enhancer. So it's very exciting. It's moved the market this year to date. And of course, it's had a nice little correction as well into now. So steadily now, we look at it again and say, maybe it's time to get back in. And then we trade down semiconductors.
Linda, as an equity strategist, even if you're taking a macro view, how has artificial intelligence changed the data points that you look at? We'll talk about the Fed and CPI in a minute, but I just wondered if you've changed your approach, the commentary you look at, where you look for information to try and understand what AI is doing.
Yeah, well, I appreciate that question because just as a general equity strategist, it behooves us all to learn about AI and how quickly it might come and change our lives. So I guess the bottom line for anybody who's looking at stocks is the company that you're looking at grasping this, or are they turning a blind eye to it and expecting it to go away? Those who are investing in this, even looking for companies that are hiring for AI talent, is one very interesting way to look for stocks out there. And the productivity enhancement that should be expected over the next 10 years can come a lot quicker than many people think, and that's obviously going to show its way through earnings.
Linda, is there any specific subsector or area where you see most potential upside from investments into whether it's accelerated computing or into large language models, the underlying technology behind generative AI?
That's a very interesting question. It's going to probably cross through all sectors of the economy. But when you look at, really, there's two areas of it: the information part of it, those jobs that are highly information oriented that can be at first helped by AI, and then maybe see jobs displaced by AI over years going forward. So that'll be some of the more highly paid, highly compensated areas out there. I don't know if you're a lawyer, maybe you need to watch out here, that type of a thing. And then on the lower end of the spectrum, you'll see cost cutting in terms of labor in areas that are heavily labor intensive but that are repetitive, and that goes to the robotics side of things. your retail sales clerks, are in big trouble. I think if I was looking to give advice to a young student, I'd say, you might want to go ahead and be a nurse instead of thinking about going to work at the mall, for example.
I am not a lawyer. I did go to law school, Linda, but I know a number of startups here in the Bay Area that are looking to use AI for the review of legal documents. I think we better also talk about China. The story about China is kind of the tension between the US and China's central government, but AI is at the heart of that. And I just wondered how you see the latest headlines from China impacting this market.
Well, China in general as a place to invest is something that people are ever more afraid of for numerous reasons, and this is just one extra thing to add to that. We want to be self-sufficient here and move lots of production here to the United States, and I think other countries around the world the same. This is going to take a lot longer than many think.
Yes.
Not being an expert at this at all, but seems very clear that we as the United States and our leadership may want to try to tamp down those concerns. And as you know, some of the best money being spent in capital expenditures in the manufacturing side is because of things like the CHIP Act, where money's coming from our government to help get more self-sufficient here in the United States. So we can try to wean away from China in this way, but it will be longer. It'll take longer than many think. And, just bringing everything back short here will probably take longer than many think.
Linda, CPI Wednesday, where is your head at with the Fed and what that means for the tech sector?
Well, we at Federated Hermes believe that you will see probably one more hike this year. Maybe it's November. Maybe they wait one more time, and that is something that is probably reasonably expected. In the tech sector, that's a long duration asset, and you really don't want to see real rates going up, and they've gone up fairly quickly here, as versus inflation expectations. If we're right about inflation expectations are coming down, then Fed, please stop raising rates. It just makes it more dangerous, more vulnerable for these stocks that are long duration, like tech.
Linda Dussel, Senior Equity Strategist over at Federated Hermes. Good to see you. Coming up here on Bloomberg Technology, Alibaba's former chief Daniel Zhang quits. More on the details next. This is Bloomberg Technology.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is Deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
time for talking tech. First up, India's edtech titan Baiju's made a surprise repayment proposal to lenders almost a year of conflict over its debt. Sources say the firm is now offering to pay back its entire $1.2 billion term loan in less than 6 months. And Intelsat, the world's biggest geostationary satellite operator, is trying to get a foothold in a technology that's gained traction in recent years, low Earth orbit satellites. The company has taken stakes between $5 million and $25 million in 4 businesses focused on low Earth orbit to offer new services. Plus, Alibaba's former chief Daniel Zhang has decided to quit just months after agreeing to lead the company's cloud division and introducing a new layer of uncertainty to China's largest e-commerce company, just as it's navigating a complicated breakup. Let's bring in Bloomberg's Isabel Lee out of New York for more. What does this mean?
Hi, Ed. Actually, this was really a surprise to many. It comes after 2 months after his appointment. We have Goldman Sachs saying it's a surprise, Bloomberg Intelligence saying that this will likely mean that the new partners will have more of an influence in the strategic cloud decisions of Alibaba. And Bloomberg just last Monday reported that Alibaba was in talks to raise funds from China's state-owned entities. So the departure really caused some people to raise some eyebrows. And this comes after an 8-year storied career for Zhang. But not to worry, he will still be in the Alibaba's ecosystem. He'll be running the $1 billion tech fund of the firm. But still, the reshuffle comes as Alibaba navigates this complicated and historic breakup into mini baby babas, as we've discussed a lot in your show. But now I guess the certainty is really getting to the investors. Alibaba shares fell as much as 3.5%. That's their biggest fall in something like 3 weeks, Ed.
You know, Joe Tsai is like more of a known quantity to us here in the United States, at least. He's one of the co-founders of Alibaba, alongside Jack Ma. But tell us about the 2 new guys, not necessarily new, but newer names to an international audience.
So Zhang gave up his dual roles of CEO and chairman to Eddie Wu and to Joseph Tsai. So the 2 are close confidants of Ma. Let's go with Eddie Wu first. So Eddie Wu is lesser known, but he has been with Ma since the beginning, and he's a computer science major. He's credited for the development of the PayPal-like Alipay. We have Tsai. He's a well-known deal maker, and he's a Yale alumnus, and he's a former lacrosse player, if that's of any significance, and he's the owner of Brooklyn Nets. And like Wu, he was with Ma since the very beginning, so that probably tells you that Ma probably really values loyalty. But this means that the 2 of them will be responsible for steering a $230 billion company around after years of struggling since 2021 when China really cracked down on the tech sector. So this is going to be an interesting space to watch. It's very much it's new, it's unexpected, and it's in the middle of a huge historic reshuffle.
All right, Bloomberg's Isabel Lee with the lowdown on Alibaba. Thank you. Coming up here on Bloomberg Technology, curious about the future of quantum technology? I certainly am. The CEO of D-Wave, the world's first commercial supplier of quantum computers, joins us to discuss his tech next. From SF, this is Bloomberg Technology.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this, put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Technology. Ed Ludlow here in San Francisco. A quick check on the markets. This is the picture with the NASDAQ 100, up 0.7%, outperformance in the technology sector. We get CPI data Wednesday, and as we heard from guests in this hour, a big view to forming how we feel about the Fed based on that data print. But we're coming off a 1.4% drop on a weekly basis on the NASDAQ last week. There have been concerns about China. We're through the bulk of earnings season. It will come around again. From a points perspective, one of the big stories in the session is Tesla. Basically on track for its biggest jump since the end of January. Morgan Stanley out with a note, raising their rating on the stock to overweight from equal weight, adding a street high price target of $400. Adam Jonas and co are basically saying, look at Dojo, Tesla's supercomputer, and their work in semiconductors. This is going to add $500 billion or up to $500 billion of market cap. And they basically say this is like an AWS moment for Tesla. Like Amazon was able to enter new markets like cloud computing with AWS, they see that opportunity for Tesla. Remember, go back to 2015, Adam Jonas burst onto the scene with a 70% raise of his price target on Tesla because he saw the future being in robo-taxis. Present day 2023, we're not quite there, but it's an interesting call nonetheless. And it's having a pretty big impact on markets this Monday. Right, pivoting stories. Supercomputers are not the only type of technology with growing commercial appeal. Enter quantum computing, an entirely separate kind of technology with the capability to accelerate various sectors in society. I'm really excited to say that joining us now to walk through this tech wave is D-Wave CEO, Alan Baratz. It's one of the first commercial quantum computing companies in the world. And Alan, I would say that's a good place to start, this misconception that quantum computing is still at the theoretical stage. It's not out there in the real world. That is a point of view that you would disagree with.
Absolutely, Ed. First of all, thank you for the opportunity to be here today. I'm really excited to be able to speak with you. So you're absolutely right. Most people in the industry are saying that quantum computing is years away from commercial reality. But at D-Wave, we took a very different approach to quantum computing, one that has allowed us to deliver commercial quantum computers today. In fact, we've been delivering them for almost 2 years now. We have over 60 commercial customers that are leveraging our quantum computer to see improved performance in a broad array of business applications.
Alan, I'm going to play devil's advocate for a minute. You've 60 commercial customers, you've been delivering computers. I look at your revenues and they are low. If quantum computing's in the real world, why are you not booking more sales as a real commercial product?
Sure. So first of all, commercial quantum computing is still early. In other words, even we were not commercial until a little over a year ago. So we've achieved that milestone, and we are now getting started building the business. We have seen our bookings accelerate quarter over quarter for 5 quarters now. We have seen our average deal size grow significantly from tens of thousands of dollars to well into the hundreds of thousands of dollars. And we are supporting applications as far-ranging as employee scheduling, e-commerce delivery, customer loyalty rewards optimization, optimization of marketing campaigns, even improving the performance of shipping ports. So it is early days, but we're off to a great start, and we're really excited about the prospects for the future.
Alan, the basics of quantum computers, if one can say such a thing, is that they use quantum mechanics to carry out calculations as opposed to with sort of higher efficiency than supercomputers. What is it about D-Wave that is proprietary? What is it that's unique about your technology?
Yeah, so as I mentioned earlier, we've taken a different approach to quantum computing from everybody else in the industry. And in fact, we're the only company in the world that pursues quantum computing in the way we do with the technology that we have developed. And we've developed that technology entirely ourselves, everything from the design to the manufacturing of the quantum computers, to the software for programming the system, all the way up through the quantum cloud service, which is the vehicle by which our customers access our quantum computers. We've designed, we've developed, we deliver that ourselves, and we have extensive patent coverage for all of that technology. We have over 200 US granted patents and over 100 in process worldwide. That space for quantum computing is owned by D-Wave.
Alan, a few weeks ago, we had a company called Phasecraft from the UK on the program talking about their work in quantum algorithms and quantum computing. And one of the observations made by their founder was that China is making progress in the field of quantum computing, but that it is a cooperative initiative globally for those in the field. Could you speak to how you view China's progress in quantum computing? Because as you know, China right now and its access to technology is a mainstay of the news cycle.
Yeah, you're absolutely right. And in fact, this is a real concern. China is investing over $15 billion in quantum computing. I was in Europe last week, actually. I was in the UK, Switzerland, Germany. They're all investing heavily in quantum computing. The UK over $4 billion in quantum. Unfortunately, the US is currently investing less than $4 billion in quantum computing. In some sense, we're the laggard in this space, and we absolutely must get our act together because this technology is going to fundamentally transform the way businesses operate and have a huge impact on the social and the economic environment, and the U.S. must accelerate its investment in this area.
All right, Alan Barat, CEO of D-Wave, thank you for joining us here on Bloomberg Technology. All things quantum computing, saying that word more and more. Now, coming up, Techstars CEO Maël Gavet joins us to talk about the outlook for the early stage funding ecosystem. They're changing how they do their accelerator program. Want to understand why? That's coming up next. This is Bloomberg Technology.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis, we're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations.
Let's check in what you need to know.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
All right, it is a big week ahead for IPOs in the technology sector. Let's kick it over to New York City, where, who else? Bloomberg's Shonali Basak has all the latest. Shonali.
It certainly is a big week. We're going to zoom in on Instacart because it's setting the stage for an IPO that could value it at up to $9.3 billion. But here's the thing. That is less than a quarter of what it was worth at the height of the pandemic. Let's bring in Bloomberg's Katie Roof to break it down because, Katie, we're looking at this Instacart IPO, and it is not the only one that might be facing a down round.
Sure. So, Instacart was well aware that the market conditions have affected its valuation. They had lowered their own internal valuation, which is the 409A valuation, to $13 billion last year due to market conditions and possibly due to their own slowed growth. But some people are saying that bankers may be trying to price these things conservatively in order to ensure a pop so that it's well received in the market and therefore opens the window for additional IPOs.
Well, another example of this would be, for example, Klaviyo, which even with a valuation that's closer to where it was last in private rounds, it is still lower. But they are bringing in some interesting massive names at the beginning: BlackRock, AllianceBernstein. What does this say about the model to taking companies public now?
Sure. And so I think at this point, most people in the tech industry are no longer in denial. The market has been in a correction for over a year now. And so companies, are aware, especially if they're coming to market, that it's not going to look like 2021. And so it looks like a lot of them are accepting that. But, we'll see. I mean, with Klaviyo especially, they're so close to where their last valuation was from last year that, they may end up being a $9 billion company or more if they do pop on that first day.
Now, when you think about Instacart, Sequoia, D1 are among the largest investors. Tiger Global, Coatue, two very well-known Tiger Cubs that have been investing in these these hot pre-IPO companies. How important is this Instacart listing to them?
Well, they're going to make a lot of money regardless because these are firms that invested, especially Sequoia, when this was a very young company. And so depending on what share price they got in, it's still going to be, for most of them, it's going to be, a lot lower than where it's trading at. Some of the ones that invested at 39 billion valuation or whatever, I mean, they're going to lose money on those shares unless there's a gigantic pop. But overall, I'd have to do the math. But if you're investing when it's $1 a share or less, you're going to make a lot of money.
Bloomberg's Katie Roof all over it, breaking a lot of news in this market. Thank you for your time. Ed, back to you.
Yeah, my thanks to you, Bloomberg Shanali Basak, alongside Katie Roof there. As Shanali said, that's one end of the scale, pre-IPO where IPO is imminent. Let's go to the other in today's VC spotlight. Techstars, the largest pre-seed investor in the world, is making some strategic changes to the way it operates its accelerator program, starting with a move to a 2-term schedule. Let's get more details on that from Techstars CEO Maël Gavet, who joins us now. We had Gary Tan on the program on Friday. Summer 23 class of Y Combinator came to a close, and he was talking about what was different this time round. Very interested to hear from you that you are also thinking a bit differently about the accelerator program. Explain what you've done.
Yeah, absolutely. First, thank you for having me on your program. As usual, that's a pleasure. So the big news for us is that we're moving to a 2-term model for our accelerator program starting in 2024. And what it means is that our accelerator programs will now start together and end together twice a year. And so the first spring term, which we're about to open, we'll be running 22 programs in 16 cities across 5 countries. And we will also have a remote program, and a lot of this program will be in partnership with corporate entity like JP Morgan or Audi and a few more. So that's the big change.
You and I were on stage together at Startup Grind earlier in the year, and I asked you a question that elicited such a response from the audience afterwards, which is, how do you find candidates? How do you go out and find the right pre-seed stage companies?
So we're lucky to be a very well-known brand, and a lot of entrepreneurs around the world know that they should come to us if they are interested in getting a first check. And we receive thousands and thousands of applications every month. And so we go through this application. What is very specific to Techstars is that we have local teams in the different countries that I mentioned before. And so we have the opportunity to meet in person with these entrepreneurs on the ground, whether it's New York, Seattle, San Francisco, but also Paris, London, Tel Aviv.
Maël, you're joining us from the Middle East. I believe you're in Saudi Arabia right now. We know all about Saudi money in growth stage companies, but you are looking at the very earliest stage of Saudi founders. What is the landscape like there?
So it's still a very early, very young ecosystem. Part of the reason why we've been active in the Middle East for a little over 5 years, running accelerator programs and making investments in the region. We now have over 60 investments in the region. Part of the reason why we're there is because we are usually building the deal flow that then the VC industry invests in. And when we came here, part of what we were asked to do was to go and find entrepreneurs, find people who wanted to be entrepreneur, find women who wanted to be entrepreneur, and help them get there, help them be VC backable.
There has been a debate among venture capitalists on the pros and cons of partnering with Saudi LPs or taking money from Saudi LPs. Where does Techstars sit on that debate?
We are an apolitical organization. We go where we believe that we can help entrepreneurs. We have deeply rooted into our culture and into our mission the idea that talent and ideas are evenly distributed around the world, but opportunities are not. And so whether it's the US, Canada, Saudi Arabia, or Japan, when we see an opportunity to go and support founders on the ground, we go there.
One of the things that Gary Tan reflected on Friday was that 35% of the Summer 23 class was an AI-focused startup, but by the end, more than 50% were looking into AI in some way. Is there any number you can give us about where those sitting in your accelerator program proportionately are focused in AI?
The number are fairly similar. The challenge is always to distinguish when AI is the core business that you're investing in versus an enabler of the core business. when you look at our latest investment throughout 2023, the vast majority of companies have leveraged AI in one form or another, and about 20% of them, 20 to 30% of them have AI as the core of their business.
Mael, my colleagues Shonali and Katie Roof were talking about everything that's to come this week in the IPO market. I know that you're investing at the other end of the scale, but you've been through so many markets. And I just wondered if you give us your perspective on how much of a starting gun this week is for tech IPOs in 2023.
This is an important week, if anything, because the entire tech ecosystem has been waiting for that week for a very long time. There hasn't been really any significant IPO in the last 12 months. And so everybody's watching what's going to happen. Is there going to be a successful Instacart IPO, which will give increased confidence to venture capitalists and to venture-backed firms to go and get ready? Or is it going to be very tuned down, and in that case, the companies are probably going to wait a little longer to go public. So big week.
And finally, Mael, you have access to just an astonishing body of data, real-time data about the health of very small companies around the globe. How has the pre-seed market held up, over the volatility of the last 18 months or so?
The early stage founding ecosystem has cooled quite substantially, with obviously the exception of artificial intelligence and climate tech. Having said that, if you look at pre-seed, the valuation have remained fairly stable. There continues to be a really great deal flow for pre-seed investors, lots of innovation driven not just by AI, but also blockchain and nanotechnology. And so all in all, compared to growth stage company that really took the biggest hit so far, the early stage pre-seed type of companies have been fairly protected.
Techstars CEO Mael Gavay investing in thousands of early stage companies across the world. Thank you for joining us on your travels. Now, coming up here on Bloomberg Technology, Charter and Disney reach a deal ending a blackout of ESPN and ABC. We're going to bring you those details next. This is Bloomberg Technology.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, host Hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Today's going viral. You know what we're talking about, the US Open. Novak Djokovic and Coco Gauff taking home the champion titles over the weekend. But about 15 million customers of Spectrum Cable TV were not able to watch as ESPN, ABC and their sibling TV channels showed blank screens amid a business dispute with Charter Communications. However, breaking news this morning, a deal has been reached ending the blackout for millions of pay TV customers hours before the first broadcast of Monday Night Football, making Bloomberg technology producer Jackie Lopez a very happy Jets fan. Let's get the important details as Disney shares on the move. Bloomberg's Chris Palmieri, who leads our media coverage, joins us from LA. What do we know?
Well, you can see the market reaction. Disney's up a little, Charter's up a lot. It looks like Charter got much of what it wanted. Two big takeaways here. Charter wanted to include Disney streaming services in their basic cable packages at no additional charge to customers. It looks like that's happening. So for the $60 a month package of cable channels, you get Disney Plus with ads thrown in there. Similar deal for the people who pay more for ESPN Plus. Also, when they launch an online version of ESPN, the Papa channel, if you will, which Bob Iger, CEO of Disney, has said they would, that will be included in the cable bundle as well.
Yes.
So big win there. Other big surprise here is that a lot of these lesser channels are off the Charter system. And some of them are pretty well known. FXX, a spinoff of FX, Disney Junior, Disney XD, Freeform, which used to be ABC Family Channel. Those won't be available to Charter subscribers.
So you have the share reaction, Charter up more markedly, Disney up a percentage point. You get a knee-jerk reaction in the Bloomberg Jackie Lopez index because she's excited. But here's the bit in the story I don't understand. There's a more narrow lineup on Spectrum. So it's not all good for Charter, right?
No, well, what that means is they traded, yes, subscribers to Charter won't get those channels anymore, but they used to have to pay for those. And the game in cable TV for a long time was, let's create these spin-off channels and you get more money from the subscribers. You know, but you just don't have Disney Channel, you have Disney XD, Disney Junior. And those marginal channels are going away because the cable bundle costs so much. And that strategy isn't working anymore. And to see all of those channels dropped by the second largest cable provider is big news. It really signals that those channels will probably see a lot more of them fading away.
Yep, they still get Nat Geo. That's important. Bloomberg's Chris Palmieri, thank you very much. That does it for this edition of Bloomberg Technology. You can recap the show on our podcast, where you get it, wherever you get your podcasts. Apple, Spotify, iHeart, and of course, on all of your Bloomberg platforms. From San Francisco, this is Bloomberg Technology.
City.
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside? What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, probably I try and play that role.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Welcome to Bloomberg ETF IQ. I'm Shonali Bassick in for Katie Greifeld.
And I'm Matt Miller. A lot going on today with potential IPOs, some M&A. It's pretty risk on.
It's pretty risk on, but not everywhere. We're going to talk about where exactly people are taking on risk today.
Yeah, let's take a look right now at the more than $10 trillion global ETF industry. In just a few moments, we're going to speak with Steve Lapley, global co-head of iShares fixed income ETFs at BlackRock, to discuss where exactly he sees opportunity in his markets.
And despite a surprise rally in the S&P 500, in terms of a downfall, investors are still hedging their bets. We're going to talk about those hedging costs, especially when it comes to the SPY, Matt.
And from a blog in 2005 to an ETF in 2023, we'll look at an equity fund unlike any other that doesn't even do any trading.
And Matt, we're always going to talk to Eric Balchunas first with Bloomberg Intelligence. He's back with us, and he's looking at the flows.
Thank you, Shonali and Matt. And yes, the hedging cost is very apropos because we're sort of seeing this in the flows, right? A little bit of tension in the flows, tug of war. Yes, SPY is at the top, and you like to see that, and VU as well. But you look a little further down, you're getting S-Gov rate, a little bit more return to treasuries. I want to go into that in a minute as well. But also Q-Tech is interesting. That's an ETF that's only the tech side of the Qs, and it happens to be outperforming the Qs this year. Not much is, it's up 40%, but interesting trade into the Qs. So let's go look at the outflows. And this is where the real Qs, is getting hit hard. 3.3 billion. Again, you hate to see it if you're looking for bullish sentiment. And also you can see money coming out of LQD and HYG. And let's take a minute, though. These flows aren't everything. There's also the mutual fund world. And I want to look at money market mutual funds because they also, I think, talk about this idea of people maybe taking money off the table. Look at the assets in money market mutual funds, up to 5.6 trillion. Kind of took a little break during the summer when everybody was in equities, but people are coming back in. 138 billion in the past 6 weeks going here, and $1 trillion over the past year. That is 9 times what all fixed income ETFs have taken in. 9 times, Matt. That is a lot of money. It makes this fixed income, the money into treasuries, look very small. And again, 5% yield, dollar NAV. It's a big time value proposition for investors right now.
All right. Thank you very much, Eric. Let's talk about that right now with Steve Lapley. He's global co-head of iShares fixed income ETFs at BlackRock. And Steve, let me first get your comments on money market funds. I mean, I've been watching this index more closely this year than I have any other in the 23 years I've been here. What do you think of the massive pile of money in money market funds?
Yeah, I think it's a reflection of investors not really knowing what to do at this point. So obviously equity markets have rallied. We've had some reprieve from last year's red across the board, but I think investors are still fairly uneasy about what the Fed's doing and what direction inflation will ultimately settle in. So you're seeing a lot of cash on the sideline. We're seeing this in our flows as well. So this year we've taken in around 13 billion in the very short end of the Treasury curve into about half of that in SGov and about half of that in T-flow. And there's just this real appetite for safety at the moment, especially when you can get north of 5% at that front end of the curve, whether you're in Treasuries or prime money markets, et cetera.
How volatile are the flows? To what extent is this a lot of using the ETFs to hedge current positions versus long-term plays?
Well, Shonali, I think it depends on what sector you're looking at. We've seen pretty volatile flows in credit, particularly in the larger, more liquid funds like LQD and HYG. So there's been a fair amount of flow volatility. I mean, net, you're seeing outflows in those credit risky sectors. But interestingly, in Treasuries, you've seen positive inflows. Yes, there's some whippiness around TLT, but it's still up 15 billion year to date. And so where you're seeing flows more sticky will tend to be the higher quality exposures like Treasuries, multi-sector like ag. We've taken in over 11 billion into that fund, about 3.5 billion into Universal. So you are seeing investors putting money to work in these higher quality exposures and sort of staying with it.
Steve, if you're a trader and you're looking to trade this in your retail investor, what's the move here to sort of try to find your opportunities or just dump it all in IUSB or AGG and just sort of let that do the work and reflect the changing market?
I think that's one approach. So it is very, very hard to time the top in rates. It's extremely difficult because, as you've seen this year, we were bouncing around sort of the high threes in the 10-year, and then in August we marched upwards of 4.25, and now we're pushing 4.30 again. So it's hard to time the top in rates, and I think investors are better served by picking a broad allocation where they want to put money to work in fixed income. You are seeing a generational opportunity in yields. You have to go all the way back over a decade or more to see the type of yield that you're seeing now across the market, whether that's in the front end or more broadly. So I think it is important to reallocate to fixed income. You could allocate to AGG or IUSB, or if you wanted to allocate in an active context, we have launched an active fund, BINC, with Rick Reeder's team. That fund has outperformed both Ag and Universal since its inception. So that's another direction you could go as well.
I've been hearing a lot of people saying that they're not getting as much return as they need to compensate for the risk in high yield. And I know you have some products there. Buy-Right is the brand name that you've got for some of them. Tell us about that, and why do you think we're not seeing wide enough spreads to attract investors in retail when we are seeing such incredible inflows into some of your Buy-Right Buy-Right products?
Yes, so Matt, going back to high yield, if you look at long-term spread averages, we are inside of the 5 and 10-year average. It's around 400 basis points right now. If you look at Bloomberg's high yield index, you're around 375 over Treasury. So it is inside of that longer-term average. I think investors are still looking for yield, but they're a little bit wary of going down in credit. So I think that explains a lot of the flows we've seen in Buy-Rights, because in particular the Treasury product TLTW has seen some pretty enormous flows year to date. That fund is now sitting over $700 million. Its trailing yield is in the high teens, and even now its current yield is still in the low teens. So that fund has outperformed 20-plus Treasuries, TLT itself, by over 7% year to date. So that gives you a feel for what that extra income can do for you in a sideways market, or if rates are rising, it can help cushion some of that downside if rates are actually going up, like what we saw in August.
Yeah, and Steve, the Buy-Right concept is sweeping over the equity market too. JEPI was a huge hit. But can you just take a second and just, what are you giving up here? I mean, you get the 12 to 16% yield here. What do you have to forego? What's the risk if you're an investor?
Yeah, that's right, Eric. So in exchange for this income, there is a cost, and that cost is you are giving up potential upside. So if you believe that we could be heading into a slowdown, going into next year, and you want to own duration, by using a buy right strategy, you're going to give up the benefit of that duration. In other words, if rates rally from here due to a slowdown, due to some risk off event, you are giving that up. You're giving it up deliberately in exchange for higher income. So you have to make that call. Do you believe in, sort of higher for longer, or are you a little bit more worried about things turning here going into the end of the year, beginning of next year?
Speaking of things turning, at what point do things like HYG, J&K start to feel the love? Is it worth really taking on credit risk at this point, given how uncertain the macro is?
Yeah, I think that's a great question. And again, so far in terms of ETF flows, investors appear to have been very hesitant to go into high yield. What's strange about that is that the returns this year have actually been pretty decent. So, you've returned, I think, upwards of 7%. All in yields are, around 8.5% on high yield. So again, the long-term spread averages are snug compared to where they've been over time. And so I think that's what's giving investors pause. One way to play it, there are products out there that are more defensive in nature in terms of high yield. We have, for example, a high yield defensive bond product, HYDB, which has tended to perform pretty well over time, but it's meant to deal with a downward turn in the credit cycle. And so that's a way to play it if you're worried about things turning south and getting into more of a negative credit cycle here as we head into next year, and if you believe growth is going to slow.
Steve, great to talk to you today. Thanks so much for joining us. Steve Lapley there of BlackRock, talking to us about the fixed income industry that he covers there, as well as really the economy. I guess that's how the questions, they're going to always be interrelated. Coming up, the S&P 500 surprise rally is rewarding traders who bought in early, but fears of a downturn still persist, including a bet against one of the largest ETFs of all time, SPY. This is ETF IQ on Bloomberg.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is Deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg.
Welcome back to ETF IQ. It's time now for the ETF Brief, where I highlight one story and trend, or three stories and trends that caught my eye. I want to start with BRNT. This is the Wisdom Tree Brent Oil ETF, because if you look, it has had the largest outflow on record. That is $500 million pulled out of the Brent ETF after you had Brent oil surpass $90. You're still looking at Brent on the rise, still at its highest levels since November, the highest levels all year. I also want to take a look here at the EM world because you're looking at a lot of choppy economic data coming out of China, and you're watching the iShares emerging markets ETF ex-China just rise at a much faster rate in assets than you are seeing for the rest of the universe that does involve China. That differential has just gotten wider throughout the year. And lastly, I want to talk about the appetite for hedging the stock market, because even though you've seen the S&P largely on the rise this year, some volatile sessions, some choppy sessions has shot up the cost of hedging against a 10% drop in the SPY ETF. And that cost has just picked up in September, Matt.
Appetite for protection.
Need protection.
It reminds me of the famous Guns N' Roses record.
I went to their concert last week, so it makes sense. I'm talking about it now.
Shonali Basak here with me. Let's talk about this issue with Bloomberg's Jess Menton, and we'll kick it off with the potential of destruction here. Why is there such a worry that this stock market is going to suddenly tank when we're so far above where we thought we would be at year-end already?
And so many traders have gotten burned trying to hedge this year, especially when you look at double-digit rallies in the S&P 500 as well as the NASDAQ 100. But you still have a lot of people just skeptical in general about the economy, but clearly we've seen the data continue to be resilient. But you've seen some of that hedging start to pick up again this month. Not surprisingly, we do have the CPI report later this week on Wednesday, and then of course we have the Fed decision on September 20th. But if you're a bull and you looked at this could potentially be more of a bullish indicator for them, because if you're on that side of the coin, you would want people to still be a little bit more fearful, because then you don't have everybody all of a sudden the pendulum swinging to people are too optimistic about the rally. So that's something that's been a little bit interesting when I'm speaking with strategists.
Yeah, and I'm curious as where else you're seeing this view reflected. Not so much that bullish view, but that cautious view that we're seeing in the hedging. How is this reflected through the ETFs when it comes to the growth world?
Right, so that's a great question. And when you're looking at more broadly with the hedging and some of these, sometimes it's a little bit harder to gauge. So this particular metric I was taking a look at, along with Carly Wana on our U.S. equities team, it's more 1 month implied volatility. When you're looking further out, it's a bit harder to gauge, just because when you think of the zero options and more when things come to maturity within 24 hours for the S&P 500, you're not seeing it quite as much in the longer term gauges, just because people are trading a little bit more quickly. And then of course, if you were going into Labor Day weekend, you might not want to hold on to particular option buyers with certain puts like that. They may not have held that, but then coming into this month, they may have gotten that again, just because you do have obviously the CPI report and then the Fed decision. But really, when you're thinking about September, Goldman Sachs actually was mentioning there's actually more than 50 investor days this month. So typically they were actually saying they're neutral on selling put options, just because they think that volatility would pick up beyond even when we're talking about like CPI or the Fed decision.
By the way, we were talking with Jessica Rabe earlier from Data Trek, and she mentioned something I thought was interesting. They have recommendations towards doing the VIX hits 24, 36, or 48, which is like we're so far away from that. Does the VIX work in any way to tell you when volatility is going to pick up, or does the VIX only show you when you're already in kind of the eye of the storm?
So Chris Murphy from Susquehanna, I was speaking to him about this last week, writing this story that we put over the weekend. And for him, he still thinks that when you're looking at the VIX, it's probably going to maintain below 20, because once it gets closer to that level, there's certain things in the options market that people are betting on, and then it prevents it from continuing to move above that. So in his mind, he's kind of skeptical that we'd actually see a big move unless there's some sort of outsized events that could really drive that further.
Our thanks to Bloomberg's Jess Menton. Still ahead, we're going to drill down into the equities market with Ed Alfenbein of Advisor Shares up next. This is ETF IQ on Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg ETF IQ. I'm Matt Miller alongside Shonali Bassick today.
And with us is Eric Balchunas from Bloomberg Intelligence. He's back with today's Drill Down, where we focus on just one ETF. Eric.
Shonali, today we look at CWS. Stands for Crossing Wall Street, which is a blog, stock picking blog that was converted or still exists, but is now an ETF based on it. As you can see, it's actively managed. It's a very concentrated portfolio, 25 stocks. Tends to look at quality and value, uses fundamentals. So it tilts a little more towards the mid-cap or smaller large caps. $73 million in assets, pretty good for an active fund. Expense ratio 75, but that's a fulcrum fee. If they outperform, they take a little bonus. If they underperform, you get it's a little bit of a less of a fee. Let's look at the holdings here. You can see this isn't your typical active fund that's loaded with like Amazon and Apple. You can see just by looking at these stocks, you're going to know some of these names, but as you can see, these are going to be a little less. So this thing has an average market cap that's much less than the S&P and a slightly lower price to earnings ratio. Let's look at the performance of this versus the S&P, which is its benchmark. But I threw in mid caps because, again, this thing does tilt down a little bit. And you can see it's up 123% since its inception. Slightly underperforming the S&P, but blowing away mid caps. So this thing it's going to outperform when the Super 7 or these mega caps take a break. So if you see that coming, this ETF is probably in a good position to have some outperformance, which again should draw more looks.
Thank you, Eric. And joining us to talk about this ETF is Edward Elfenbein. He's a portfolio manager at Advisor Shares Investments. What are you looking at when you are...
Or looking at.
when you were thinking about the direction of this market and what can outperform in the world that you're in?
Right now, I mean, what we're looking at, it looks like the Fed is going to pause next week. Maybe it's about 50-50 we'll get a rate hike coming in November. But I think right now there's been a concern that if we're going to cut rates right now, the Federal Reserve is going to bring us right back to the playbook of 2020 and 2021. So back then we see Zoom and Moderna, and now that's being replaced by the Super 7 and the intelligence, all of that kind of stocks. That's just going to replace that, and we're going right back to that. I think the market is assuming too much, and I'm looking at a lot of these high-quality, low-beta names that I think look very good right now.
So what, I mean, I guess I could say Trexco is your favorite, but what do I take as your favorite considering all the names that we just saw there?
Well, I'll tell you one that you might like, which is Miller Industries. And this is a wonderful company. It's not followed by a single Wall Street analyst. I love this. It's a tow truck company based in Chattanooga, Tennessee.
Nice.
It's a wonderful little company, and they just had a blowout earnings report. And I can't say if it beat expectations or not because no one follows it.
So there were no expectations.
There were no expectations.
That we know of.
I was looking through your holdings historically just to see what you're buying and selling, and I did see the move to industrials. One stock you sold out of, I mean, this is like a perfect trade. You had Disney for many years. It crushed it. You sold it exactly 2 years ago. Since then, down 56%. What alarmed you? What got you to get out of that company at that time?
I got to tell you, that was a really difficult one because it was a company I had a strong conviction in, but I really didn't like the culture that I saw forming at Disney. I don't like when companies treat their customers, particularly their core customers, like an ATM, and I got that feeling that's how Disney was behaving. Very high prices across the board, and that, of course, there was a leadership change, so that made me make the decision to pull the plug on Disney.
But that's the farthest thing from an orphan stock that there is.
That is true.
I mean, Miller Industries and Disney are like two ends of the spectrum, right? Because everybody on the street follows Disney. No one follows Miller. Does that matter to you?
Not at all. I go wherever there's a bargain.
Now, if you're taking a look and you think that there is either a soft landing or a harder recession, what would you trade out of today that you are still in if you think things were going to get worse than the market currently thinks it is?
I mean, the obvious choice is a lot of these Super 7 stocks. They really have run so far. Even if you don't have to exit your position, it's a good time to take profits on those. That's the number one concern I would have.
Just a little bit about positioning this fund in a portfolio. We do a lot of work on how active should move forward, and you're concentrated, which I think is a viable lane because you can complement cheap beta rather than competing with it. How do you position this to advisors? Are they looking for performance mainly, or does that active share, which is 96% in your case, does that matter to them because it could be used as a satellite position?
I think they really just like the concept of it, the idea that we don't do any trading. No trades are made during the entire year. We focus on just the high-quality names, and we stick with them. We only trade, we have a 20% turnover each year, so 5 of the 25, 5 go in, 5 new ones come in, 5 go out.
You have this fulcrum fee that Eric was talking about. I'd never heard of it before now, and I don't think it's widely used in the industry. How has that worked out for you and for your investors?
I think it's been great personally because I've been getting a nice bonus, so that's good. That's good. We believe we were the first ones in the ETF space to use that. It does exist in the open-end community. I don't know if any others have used it, but I think it's a great way to say to investors, we are aligning with your interests. We have skin in the game. And I think it's a way that Wall Street will be moving towards those sorts of qualities.
Double down on that because on one hand, ETFs have brought down the fee structure for the investing universe to begin with, but with all of these new actively managed ETFs, that is getting a little more expensive. Do you think that this fulcrum idea might take more steam with those higher fees that we're starting to see?
I certainly hope so, because one of the problems is a lot of these smaller ETF shops, I'm afraid, are getting pushed out. So we turn 7 years old next week. I don't know if our kind of fund could launch in this type of atmosphere. Maybe we got in at the right time. But I think things like the fulcrum fee and the tax efficiency, I think these are going to gain steam and become larger as the years go on.
All right, fascinating story. Really glad to get you in here. Eddie, thanks so much for joining us. Eddie Elfenbein there of Advisor Shares. His ETF turned 7, CWS, as he said. If you just can't get enough of ETFs, a reminder that you can listen to Eric with Joel Weber, our editor of Business Week, on Trillions. That's their bi-weekly podcast that covers the industry and fascinating stories like CWS and Eddie as well. Also, I recommend following Eddie on Twitter because he says some stuff that just sticks with you I think about you in bed a lot because you once tweeted that it's too hot when both legs are under the covers. It's too cold when both your legs are out of the covers, but you need one under and one over in order to. That's to me makes a lot of sense. That does it for Bloomberg ETF IQ. I'm Matt Miller along with Eric Balchunas and Sonali Basak. This is Bloomberg.
We've been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, But it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. JetBlue has traveled a long way from its startup days, but CFO Ursula Hurley says growth won't change the airline's quirky attitude.
At the end of the day, we view ourselves as a disruptor and a maverick in the aviation industry, and I'm really excited to play a meaningful role in that growth journey.
Watch Chief Future Officer Wednesday on Bloomberg.
I'm John Olcott. Welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a quick check on where the markets are at this hour. Right now, we continue to see gains on the S&P 500, up 0.6%, 4485 is the level there. I guess on hopes that we get some good data out this week. Remember, we have CPI inflation numbers coming out on Wednesday, PPI coming out on Thursday. We do see the U.S. 10-year yield right now up about 2 basis points. Investors selling off those bonds to level 428.21 on the 10-year yield. The Bloomberg U.S. dollar index has come down about 8 points right now. It's still holding near some relative highs. 1250 is the level in the Bloomberg dollar index right now. Last year we got up to 1353, but 1250 is still nothing to sneeze at. And NYMEX crude unchanged right now, but at $87.53. The global benchmark Brent still over $90 a barrel. John, what are you looking at?
Well, a few individual movers. Let's start with Tesla, Matt. In percentage terms, top player in the S&P at this hour with an advance of almost 10%. Morgan Stanley making a very bullish case for the Dow Jones supercomputer, transitioning Tesla's business into a brand new market, which could open up possibly a $10 trillion industry. Meanwhile, we are watching within technology a nice lift for Qualcomm shares right now, 4% higher with that new or renewed modem chip deal with Apple. Everybody thought Apple was ready to move out the door with its own chips, but they're going to buy a little bit of time. And of course, we'll watch the Apple story this week with the big iPhone event. And then Tilray, the cannabis company, which trades in both Canada and the U.S., moving higher yet again. This is 9 of the last 11 sessions on a lot of the excitement. Some of it's speculative about what could happen in Washington on the cannabis front. We'll track that story. And Matt, we're also tracking the dispute between Disney and Charter, which has found its way to the resolution line. That has helped out both stocks in trading today. And obviously, at the end of the day, there were squabbles over fees and which channels to carry. But for anybody who was worried about getting access, if they're using Charter, to Monday Night Football, now they can get it ahead of the big game.
I was going to say, kicks off right before the Jets kick off. tonight on Monday Night Football. Now, one of the big events for this week is the U.S. inflation report on Wednesday, with investors wondering how it's going to affect Fed policy. Earlier, J.P. Morgan's David Leibowitz gave a colorful explanation on how he views rising prices.
I oftentimes think about inflation as being like economic sweat, right? You end up with inflation when you're running an economy above its trend rate of growth. We estimate trend in the United States is somewhere right around 2%. And so the 2% plus growth that we've seen this year, we believe is going to make it a little bit more challenging for inflation to get back to where the Fed would like it to be.
All right, well, let's get some more perspective on that. Sri Kumar, president of Sri Kumar Global Strategies and senior fellow at the Milken Institute, joining us with some more perspective. And, you know, I want to build as well on what Matt was alluding to. We'll get more looks at inflation this week, obviously. Coming into today, we had the Treasury Secretary painting the picture of a possible soft landing scenario. And yet, when you look at the markets themselves right now, they've been a little bit cautious so far in September. How would you characterize the market's mood on where the economy is going from here?
John, all great questions, timely ones. I have not been in Janet Yellen's camp for a long time. I don't believe in a soft landing. When you have had so much of excess in monetary expansion and fiscal expansion, like we had in 2020, 2021, estimating inflation to be transitory and for it to come back by itself, all of which were wrong forecasts, I find little reason to believe in the Treasury Secretary and her point of view today. Having said that, when you have had that much of an excess in the economy, John, it is going to take a lot of effort to bring it down. And we have brought it down from 9.3% CPI inflation. In June of last year, we have brought it down close to the 3% level, around that for the headline. But the headline is going to be up again in my expectation on Wednesday, and that is because of rising oil prices, and we are not going to have a soft landing, given that I think the Fed will have to increase interest rates once, maybe more times, if it seriously thinks about bringing the inflation down to its target.
So, Sri, first of all, great to have you in here. Thanks.
Good to be back with you, Matt.
Thanks for joining us. So we're looking for inflation to be around 3.6%, the headline number, 4.3% if you take out food and energy, going in the wrong direction, essentially, for the Fed. At the same time, we're on Thursday going to get retail sales out, which we're expecting to drop from a gain of 0.7% last month to a gain of only 0.1% this month. And if you take out, cars and gas, the expectation is for retail sales to go negative.
Right.
So how can the Fed raise rates with that kind of growth picture?
On the retail sales, Matt, I think the way to look at it is to look at both months together. As you said, the previous month was up much more than anticipated. The expectation had been 0.2 or 0.3% increase, and it came out at 0.7. So usually, if you look at the retail sales numbers going back the last couple of years, when you have 1 month which is extraordinarily rapid, the second month adjusts and comes back. But together, the retail sales are still above expectation for the 2 months put together. The consumer is still strong. I don't think he or she will be by year end. That's what the Bloomberg survey just showed as well. And I buy into it completely. That is what I have been telling my clients.
So, that's essentially my question, right? It's not just about retail sales on Thursday. It's about if inflation is going the wrong way, or if it's stubborn at a level that's too high, and then we start to get a real slowdown in growth, maybe even a contraction. How does the Fed react?
The Fed has two possible ways of reacting. One is to say inflation is above target. We told everybody that 2% is the target, and especially when it's going the wrong way, we need to tighten further, increase interest rates, reduce the balance sheet as much, if not faster. The second way to do it is to say we have twin mandates. We care not only about inflation, but also economic growth and employment. That is at risk, and we have to ease up now. My concern about the Fed and my constant criticism of the Federal Reserve is that they pay much more attention to the growth part of their mandate than to inflation. So the bottom line answer to you, what will the Fed do? They will declare victory at some point at a much higher inflation rate, and then start to inflate again because they're more concerned about growth and employment. Also, keep in mind, when that happens, we'll be just about a year away from presidential elections, and the Federal Reserve is very much a political animal, and it is going to be reacting that way.
So Matt's question was about the Fed. I'm going to get your perspective on what the markets ultimately is going to do. Let's say we get into this environment where the economy is ultimately cooling. Let's talk about the yield story, for example. What is your prediction on where yields ultimately go as the economy cools down?
John, on yields, I will answer you in two ways. First of all, the 10-year yield, 30-year yield, when you look at what happened to them on Friday, and despite the slight increase we have had today, over last week, the two 10-year and 30-year yields did not move very much. The 30-year yield actually came down Tuesday to Friday, even as the equity markets had a bad week. Why is that? Why are you still doing well on the bond market? And the reason is the bond market is getting prepared for a recession, and in a recession, a 10-year yield at 4.30, a 30-year yield at 4.35 to 4.40, they are extremely good yields at which you're going to get a good cash return as well as capital gain coming out of it. The second way to answer your question on yields is what is happening to the yield curve. The 2 to 10 yield curve has been inverted since the first week of July of last year. And in my reading of US history on the monetary side, that invariably and always leads to a recession. And I'm still looking for a recession to begin toward the end of the year, which is also partly the reason why I said to Matt that the consumer will not be strong by year end.
Sri, how does China play into your assessment of our economy? I was hearing on surveillance this morning some, I guess, optimism that they'll be exporting deflation, to the rest of Asia and then to us. That would surely be a help, right? On the other side, they have been at least part of the growth engine for the global economy over the last couple of decades.
Yes, China will export deflation to the countries which are big exporters and importers to it. But keep in mind, Matt, that US exports constitute 13% of US GDP. For example, when you compare it with a highly export-oriented country like Germany, which is 43% of GDP.
That's exactly why I was asking.
So, which is why when you look at the United States, it is what we call in economic theory as a closed economy. The rest of the world doesn't matter very much. And when that is the case, I think the US inflation is going to be more a product of its own policies rather than depending on China. But you're right. It will export the deflation to Australia. It will export it to Germany. It will export it to Brazil. These are the three countries which are very dependent on China as a market. But the United States, I don't see as much of an impact. So it is going to be differentiated across the world in my expectation.
Fascinating stuff. Great to have you here with us. Thanks so much for joining us. Kamal Srikumar, president of Srikumar Global Strategies. Great getting his perspective. Coming up, we're going to go from the important economic stuff to peanut butter and jelly and Twinkies. J.M. Smunker buying Hostess for $5 billion. The detail next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
Look, I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. Now, what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, probably I try and play that role.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis, we're going to go get straight to some breaking news.
I'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations.
Let's check in what you need to know.
This is Bloomberg Markets. I'm John Ehrlichman along with Matt Miller. Time now for our stock of the hour. The big deal today is peanut butter and jam giant J.M. Smucker acquiring Twinkie maker Hostess for more than $5.5 billion. Now, Hostess has enjoyed a big turnaround in the past decade after a bankruptcy filing. And for Smucker, they beef up again in what has been an ongoing trend of shelf space supremacy being a priority at the supermarket for these consumer players, Matt.
Yeah, very interesting stuff, especially because the brands that we all know and love, or at least that we all know, are so famous and such an important part, I think, kind of this country's culture. Let's bring in Bloomberg's Dina Shanker. She wrote the story today. And Dina, I just think there's so much you could talk about in this. The fact that Hostess went broke a couple times is almost impossible to believe, since they make products that we all buy and consume, or at least used to. I think a lot of us have quit at this age. But now Smucker is paying $5 billion to get, what do they want this for? Do they think that Hostess isn't doing enough with it?
Well, what we're seeing right now with consumers and what they're buying at the supermarket is that after this brief resurgence during COVID, where everybody went back to center of store and everybody was ready to get all those shelf-stable pantry items again, now consumers are once again returning to the perimeter. They want healthy, fresher foods, and that puts a lot of pressure on companies like Smucker that are really center of store and not what people might consider healthy. But there's one area where consumers are still buying a lot of packaged food, and that is snacks, and that makes Hostess a good potential addition to Smucker's portfolio.
It's really interesting, Dina. I mean, you quite literally wrote a story more than a year ago where this idea of more consolidation and maybe this company being involved in more consolidation was front and center. I get the sense that when you're talking to the analysts and talking to the CEOs right now, that if that's a trend that's being highlighted with this deal, it's a trend we'll have to continue watching within this sector.
I think we should absolutely continue watching this. We saw Campbell just over a month ago bought up Sovos Brands. We're going to see more and more of this. You know, companies basically have two options here. They can innovate and come out with new products,
or they can buy up other brands and add those to their options. Or, sure, why not do both? But I think right now we're going to see these packaged food companies continue to make moves like this.
I think they could execute better in terms of shelf space and display. I haven't been able to find a box of Chocodiles for years, which is, when you take a Twinkie essentially and just dip it in chocolate. It's delicious. Dina, thanks so much for joining us. Dina Shanker talking to us about the deal of the day. John?
All right, thanks, Matt. And coming up, Bloomberg calculating the toll on a potential UAW strike, what that would mean for the U.S. economy. We'll walk through those numbers when we come back. This is Bloomberg.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well? Or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
London, in Sydney, from Washington, in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg Markets. I'm John Oakman with Matt Miller. Time now for today's For What It's Worth. How about $5.6 billion? A potential auto worker strike in Detroit could do some serious damage to the U.S. economy. Anderson, an economic consulting firm in Michigan, estimates that a 10-day work stoppage could reduce American GDP by more than $5.5 billion. And this looming uncertainty coming just when the automakers were shaking off the effects of the pandemic and, of course, those semiconductor shortages, Matt. So obviously a lot of uncertainty in Detroit right now.
Yeah, I think that's one of the more interesting parts is that if they do strike, this could lead to inflation, more inflation, as the car prices that are now starting to either plateau or finally come down a little bit could turn around and go the other direction. In any case, as negotiations enter their fifth week, the Biden administration says it expects a deal between the union and automakers to be done. It's deployed top officials to help facilitate those talks. U.S. Senator Gary Peters of Michigan, he's hopeful that the talks between both parties are progressing as well.
Negotiations are continuing. They're robust, and certainly we hope that we can get an agreement before the deadline and avoid a strike. Right now, it's between the parties. It's between the auto companies and the UAW. That's the way the collective bargaining process works. They're at the bargaining table. They have to work out their issues. And certainly we all hope that they are able to come to an agreement.
So some are optimistic, but the two parties are still so far apart that I can't imagine how they get to a deal by Thursday night, which is the deadline. Let's discuss with Seth Harris, a former top labor policy advisor to President Biden and also a senior fellow at the Bund Center for Social Change. Seth, thanks so much for joining us. How do they get, you think, to an agreement? Because as far as I can see right now, the best offer from, Ford is like a 10% increase, and David Welch and our reporting out of Detroit shows that the unions are asking for more like a 46% increase.
Right, I'm with you. I think they have a very long way to go. I think it's right for the president and Senator Peters to be optimistic about the negotiations because they want to encourage the parties to get to a deal. But I think there's a substantial distance between the parties' positions. I think a strike is increasingly likely. That doesn't mean the negotiations are going to end. In fact, the opposite. I think a strike would cause the negotiations to accelerate. But there's just a fundamental disagreement between the parties about how this deal is going to end up being shaped.
Seth, we've had labor unrest in so many different industries in this past year, which means to a certain extent we have a playbook, if you will, at least from the employer side, from the industry side. If you look at the ways this could go for Detroit, I know you've even looked at some of the comparisons like what's happening in Hollywood versus, say, what happened recently with UPS. Can you walk us through that?
Yeah, I think there are two models out there. The Teamsters UPS model, we saw the UPS really understand the moment, understand how unhappy their employees were, and understand that they had to make quite dramatic changes to their relationships with their employees. So we saw them make those changes, and ultimately we ended up with a deal that 83% of the UPS Teamsters were able to support. In Hollywood, every bit of evidence suggests us that the studios simply have no idea what's going on with their employees, and they are negotiating as though it were the late 1990s, early 2000s. They are trying to cut costs, they're trying to cut staff, they're trying to hold wages down, and their workers are extremely angry. The studios essentially forced the writers out on strike and then seemed to be totally surprised when the actors went out on strike, even though many of the issues like AI are exactly the same. So we have these two approaches that we've seen recently. The question for the automakers is, which road are they going to travel down?
Well, there's one similarity I can see instantly, Seth, is that the studios are not making money on streaming, right? I mean, a lot of people think it's a business model that simply won't work. And on the other hand, the unions in Hollywood think that the studios are making tens of billions of dollars on streaming. Now, in terms of the automakers, Ford has said it's going to lose $4.5 billion on EVs this year. And how are the unions poised to take money out of those losses?
Both the studios and the automakers have made huge profits over the last several years. And the problem in Hollywood is that the studios and the streamers and others are competing against one another, and they expected their workers to bear the brunt of that competition. And the workers have said, no, 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 we're not going to pay the price for your bad business decision making. The automakers in Detroit and in the rest of our country are going to benefit tremendously from huge public investments in the transition to electric vehicles. Most recently, the Biden administration announced $13.5 billion to help American automakers transition their plant and equipment to electric vehicle and electric vehicle battery manufacture, as long as they keep those plants in their communities and they keep people at work. They've made a tremendous amount of money even this year. So I think that there's enough money to go around. There's certainly competition in both of those industries, and it's not exactly like the UPS model, but they certainly have the resources to cut a fair deal with their workers, and their workers are expecting it. Otherwise, I think we're going to have a prolonged strike.
All right, Seth, great to have you on. You shed some light on these issues, and I think a lot of people are confused, so when we get a voice of reason here, it helps a lot. Seth Harris of Northeastern University and the Bund Center for Social Change talking to us about these disputes. I want to just point out that we have a comment from the UAW President Shawn Fain in a statement. He says, we're ready to negotiate in Detroit 24/7, just as we have been for the past 7 weeks since we gave them our members' demands. So those negotiations, John, may go up against the wire, which I believe is 11:59 p.m. Thursday night.
So we'll watch for that, and what percentage of union support can come behind any conversations and possible deals here. We'll watch it closely. For Matt Miller, I'm John Olpin. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Bullish, bearish, or maybe something in between. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking you down to the closing bell here in the U.S. Let's take a look at how markets stand right now because you've got a second day of gains in the S&P 500 led by the likes of Tesla and Amazon, up by 2/3 of 1% at the moment. When it comes to the Treasury market, there isn't really any market-moving significant economic data or Fed speak for that matter to really move the needle here. So the 10-year yield moves up by 1 basis point to 4.28%. The path of least resistance seems to be lower price, higher yield. The Bloomberg Dollar Index, we're really keeping an eye on this one because the dollar rally has faltered. It had closed out 8 straight weeks of gains up until this point. That is the longest winning streak since 2005. And of course, there was data coming out of China as well. Better than expected data on China credit. So that gave a lift to metals, including copper. Romaine?
Yeah, let's talk a little bit more about that dollar, the record long hot streak that we had seen for the U.S. dollar. Well, put on pause this Monday as China and Japan actually pitching stronger measures to finally defend their weakening currencies. The offshore yuan strengthening the most versus the dollar since at least mid-March. This after the People's Bank of China warned speculators steer clear of any destabilization of the currency. Meanwhile, the BOJ, in an interview with Kazuo Ueda, basically hinted that the Bank of Japan, believe it or not, may actually be ready for a policy shift. Those comments on the possibility of ending the developed world's last key negative interest rate, that sent the yen to its best rally since mid-July. Of course, both currencies still among the worst performers on a year-to-date basis. But in the short term, what's bad for the dollar? That's often good for stocks, given the historical negative correlation, which as of today sits around 0.5. And here's an interesting factoid for you. The S&P 500 hasn't posted a loss on a Monday since June. And overall this year, Monday is most likely to be the day where you're going to see a gain. That's holding true today with about 9 of the 11 sectors higher and major contributions today from Tesla, Amazon, Microsoft, and Meta. Of course, all these names sitting on healthy year-to-date gains. Meta alone on pace for its best annual return ever. That's raising a lot of questions right now about how much more room stocks have to run. A big determinant of that answer is whether the unexpected strength in consumer spending this year maintains its heft into 2024. Scarlett, our latest MLive Pulse survey, gauging Wall Street clients just on that question. I'm not sure you're going to like the answer.
Yeah, that's right, because the survey found there is increasing worry about the outlook for the U.S. consumer, even as there's more buy-in on the idea that the U.S. economy will achieve a soft landing. Now, according to the latest Bloomberg MLive survey, only a quarter, if even, of investors surveyed here are positive on U.S. personal consumption for the foreseeable future. Now, the majority, and we're talking about 56%, see consumption turning negative early next year, while just over a fifth see the turn happening even sooner, next quarter. And here's why. Concern over access to credit and mortgage rates, or at least access to affordable rates. That's according to almost 60% of market watchers surveyed. This is, of course, all part of the long and variable lags of the Fed's campaign of interest rate hikes that began way back in March of 2022. About a quarter of respondents say the resumption of student loan payments will be the bigger obstacle, and about 18% see a labor market slowdown as the biggest threat. So it feels like, not that you can take it off the table, but it's less urgent than it was before. Romaine.
Interesting data coming out of the latest MLive Pulse survey. Let's get some insights out of our first guest as we kick you off to the close. Lori Calvasina, head of U.S. equity strategy over at RBC Capital Markets, joining us right now. And Lori, there's always a lot of talk about how the stock market isn't the economy isn't the stock market. I know economic conditions matter, but if you do see a tail off in consumer spending, how much do you think that could matter for equity investors?
Well, thanks for having me, Romaine. It's great to see you both again. Look, I think, what you said is very true, but I think an interesting factoid, and by the way, I love your one about the Mondays. I think an interesting factoid that I've seen on both the S&P 500 and Russell 2000 is that really, kind of in the post-COVID world, they've been trading very closely, if you look at trends on a year-over-year basis, with consumer sentiment data. So I guess what I would say is if we're looking at the consumer slowing down a bit from a spending perspective, we'd have to look at the underlying reasons for why that's happening. Is it happening because consumers are feeling terrible, that really trends are starting to become more onerous, or is it because they're becoming more value conscious, choosier, more rational? And one of the things we've talked about in this last reporting season is that if you looked across different sectors, across different industries, what I saw at least was not evidence of a consumer falling off a cliff, but a consumer that was reacting appropriately to the price pressures that were around them. I talked to one client today who said the consumer is essentially boycotting some of these higher prices, and I love that term. I think that's a great way to describe it.
Yeah, you can sort of throw me on that pile as well, Lori. A lot of sticker shock still out there, despite all the talk we have about inflation coming down. And to be sure, at least as far as headline numbers go, the official data goes, we've seen inflation come down, I guess in a meaningful way, meaningful enough that we're now talking about the Fed permanently on pause and maybe even something different as we get into 2024.
I think that's right. And, one of the questions we have is, when you start to look into 2024, what are the key themes and what are the key narratives that are going to be driving equities? And I don't think the street has quite figured that out yet. I think this conference season that we're starting to go into, really kind of that September period where it seems like every sector and every bank has a million conferences going on. I think we're going to start to get some hints of what those narratives are. But I do expect as we get closer to 2024, closer to year end, we're going to be talking again about the possibility of Fed cuts next year and how that's going to be boosting or perhaps impeding different parts of the market.
Lori, one area as we wait for some clarity on the economy, on the Fed and everything else that you like in particular is energy. And I'm looking at the 3-month performance. Energy up by 11.4%, outperforming every other sector in the S&P 500. You say it still looks pretty interesting despite this outperformance.
Yeah, and to Romaine's term on sticker shock, I looked at a chart last week of just sector performance since the beginning of August in the S&P, and I looked at it on the Russell 2000. It's just staggering how much energy has outperformed. And there have been some rumblings, I would say, around the street of maybe things have moved too far, too fast. Our commodity strategy team has said, things still look structurally very good, but maybe the oil price will take a little bit of a breather. What I did was just kind of double down and look at my models on valuation and earnings revision. I saw two things very clearly. Number one is whether you're looking at the Russell 2000 or the S&P 500 energy stocks on a median basis relative to the broad market, valuations still look very, very compelling. So despite that big move, we still have a very, and frankly, deeply attractive valuation profile. Number two, earnings revisions are starting to improve in the energy sector. And in the S&P 500, we're actually now seeing mostly positive revisions again. But importantly, we're very early on in that earnings revision recovery. So I will say, two models or two sets of models for both small cap and large cap are still sending me very strong buy signals at this point in time. And if you add on to the fact that the growth trade really still looks tactically overvalued and overbought and due for a breather, you've got to find, some parts of the value cyclical part of the market for that market cap to rotate into. And I think energy is one of the most attractive areas.
So you're saying that energy can hold on to its gains and even build on them, even if oil prices may have topped for now. I mean, WTI is at $87 a barrel. It's at the highest in a couple of months here, and there are some discussions that perhaps it might have gone too far too fast.
I think in the energy sector, when we look at performance, we're always sensitive to the direction of oil prices. I think, if it's sort of a modest consolidation, treading water, I think the sector can withstand that. If there's some sort of major collapse, which is, not what anyone over here is looking for, then of course you're going to have to rethink a thesis. But, I think the idea, that I'm hearing from some in the trading community that, this has just moved too far too fast. I'm just not seeing that on my models. I know some people feel that it has been a very fast move, but at least from a valuation and earnings revision perspective, we've still got a lot of room to run before I'll start to get worried on that basis.
Lori, always great to talk to you. Lori Calvasina there, head of U.S. equity strategy over at RBC Capital Markets, helping us kick you off to the close here on this Monday afternoon. A lot more coverage coming up here on Bloomberg Television with a closer look at Apple extending an agreement to buy modem chips from Qualcomm. This is for 3 more years. We're going to talk about what this actually means for Apple's plans for its own design chips.
Plus, summer isn't over yet. We're going to look at how extreme heat around the globe is becoming a threat to energy security and what can be done about it.
And here we are on September 11th, 2023, 22 years removed from one of the worst terrorist attacks on U.S. soil. A commemoration and a discussion up ahead with Howard Lutnick, the chairman and CEO of Cantor Fitzgerald, a firm that really felt the pain of that day and a firm that has really taken up the mantle for making sure that we never forget. That discussion coming up in just a bit. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
A solemn day of remembrance here. Bells tolling, bagpipes playing at Ground Zero here in New York City. It was one of the solemn tributes across the country as Americans look back on the horror and the legacy of 9/11. Almost 3,000 people were killed when hijacked planes crashed into the World Trade Center that day, the Pentagon, and, of course, in that field in rural Pennsylvania. The firm, Cantor Fitzgerald, it lost more than 600 employees when the North Tower of the World Trade Center fell. And just 3 days after that, our next guest began rebuilding that firm and making sure that we never forgot the lives that were lost and the sacrifices that were made to keep us safe ever since. Pleased to say that Howard Lutnick, the chairman and CEO of Cantor Fitzgerald, joins us right now on what has become for him an annual charity day, a way to raise money and awareness, of course, for what happened 22 years ago. Howard, give us a little bit of insight here. on just how much reception you've had on this particular day, this particular year, and on the years prior leading up to this.
So we started, the firm committed that 25% of everything we made would go to the families of those we lost on 9/11. And with all the commitment of all of our employees, we raised $180 million in the first 5 years for those families. And then after 5 years, we decided, all right, let's extend it out. So all of our employees, all these people behind you, they've all waived their pay, and we get celebrity ambassadors to come in. You got Nicole Kidman and Keith Urban behind me. Charlize Theron was here. President Clinton was here earlier today. Matthew McConaughey, Kenan Thompson. I mean, it just a who's who, sports stars, celebrities across the board, helping us raise money, and we give away every penny we do business with today. Hopefully about $12 million today, and we're going to give it to about 150 charities all around the world and in all the communities where our employees live and our clients live. And so it's the most uplifting day for a day that is really, really dreadful for us.
That's well said, Howard. And of course, in addition to the lives lost, just kind of the scar, I think, on the site. Yeah, absolutely. Who's that? Is that Nicole Kidman ringing the bell there?
This is Keith.
Is that Keith? Oh, there he is, Keith Urban. There you
Way to go, Keith.
All right, music superstar there, Keith Urban, and now the superstar Howard Lutnick there of the finance world. It's great to see you laughing. It's great to see that this has turned into something positive that will carry on. I mean, how much do you see, I guess the general sense that we're going to remember this? I mean, we're 22 years removed, and we know that as these events sort of get further back in time, there's always that tendency to want to just move on and turn to something else.
Yeah, so it's vital for us that we keep it top of mind, especially, right around today. I know there are people who are young. Like, for instance, this morning when I was walking around, I said hello to, we offer a job to every kid of someone we lost on 9/11. So we had a young woman today. Her father was one of our lawyers, Matt Leonard, and she was 6 months old on September 11th. So she joined the company, but you've got a whole new generation coming up, people who don't remember the day, and they've got to know the importance, the significance, and that you can't keep us down, that the firm of Cantor Fitzgerald will show. We had 2,000 people back then, dropped to below 1,000 after 9/11 because we had divisions with only 2 people in it. Every time you hear a cheer, that means we're just doing trades, raising money for charity. But we just kept growing and building. Now we have 15,000 people in the group around the world. We've got Newmark, fantastic company, Cantor Fitzgerald, and then BGC, where I'm sitting right now. And these companies they all donate everything to charity, keeping it alive and proving you just can't keep America down, and you surely can't keep Cantor Fitzgerald down.
Yeah, absolutely. And the fact that you've done this for now 22 years and have raised, I believe, a total of $380 million. That doesn't include today, so some astronomical numbers here. Can you take us back for a moment just to recount how you felt and what you went through the day of 9/11? Because, as you mentioned, there are a lot of younger people who didn't hear the stories firsthand, and I think it's important for them to understand how this is not just something that happened to your firm, but to your family as well.
So I was taking my son to his first day of kindergarten, and his kindergarten started on 90th Street in Manhattan. So he had a little backpack on, and we took a picture. In those days, they would put the time of the picture, and the picture was 2 minutes before the first plane hit. And so I got a call, and they said a plane hit the building. So I raced down to the building and started grabbing people as they came out, because I was at one door, but the World Trade Center had many, many doors, and I figured if one of my people came out of this door, they'd come out of all the other doors. But unfortunately, the highest floor I heard someone from was the 92nd floor. Then the building collapsed. I ran for my life, and I ended up, diving under a car. And you've all seen that sort of tornado of black smoke. Well, I was stuck in that black smoke, and then I wandered uptown until people were clean. When I called, someone was on a payphone, and I went to the front of the line, and they looked at me like I was a ghost because I was just covered in soot. And I called my wife to tell her I was alive. My brother Gary was in the building. He was 36. My best friend Doug was in the building. He's 39. I have dinner with his wife every year. Since then, we feel most comfortable together. So this was personal. We hired all of our friends. We hired people we cared about. And that was the rule for the whole firm, not only for me, but all of our employees. Let's go hire people we like. Let's go hire people we care about. And so if you lost everybody you work with, you know what you would do? You would cry. And I cried every day for years and years, because these were people you love. You love the people you work with. You just don't think about it that way.
Well, you've turned a tragedy into something much better, something stronger, something that gives back. We appreciate you. Howard Lutnick, the chairman and CEO of Cantor Fitzgerald, on this 9/11 charity day for the firm. Romain, do you remember where you were on 9/11?
I was in a car on my way about to enter the Lincoln Tunnel. We were stuck in traffic. We saw the smoke from one of the towers. At the time on the radio station, they just said there was a fire in Lower Manhattan and avoid it. So at the time, we did not know it was a terrorist attack. And at some point, they turned us all around, would not let us into New York. And at some point, while I was making my way back into New Jersey, we learned of the second plane hitting. So a very tragic day. But to kind of turn to what I think Howard was getting at too, you can cry, you can take that tragedy, but how do you turn it into something positive and good and lasting?
Yeah, and he's managed to do that every year for the last 22 years, which is remarkable. I was in Hong Kong at the time, and I remember I was watching TV, and someone said, "Turn on the TV, you need to see what's happening." And again, we didn't know what it was at the time, just a small plane flying in. But
and we didn't get a chance to talk to him. And I know later in the show we're going to talk a little bit about New York real estate, particularly in the wake of 9/11. You kind of forget just how devastating it was to Lower Manhattan. Not only just the people who lived there couldn't go there, the people who worked there couldn't go there. Businesses had to be rebuilt from scratch. So in addition to just the psychological toll of a terrorist attack, there was that economic toll as well, and how you rebuild a city in the face of that.
And of course, there's a little bit of a parallel, of course, right now with New York City in the aftermath of 9/11, New York City in the aftermath of COVID, kind of rebuilding and refinding its identity as well. All right, this is all stuff that we will get to later on in the program. You'll want to stick around. This is The Close from New York. This is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Apple extending its agreement with Qualcomm for 3 more years, really signaling its own chip is not ready yet. Bloomberg Technology co-host Ed Ludlow has the story. And Ed, there are 2 storylines here with this development, right? I mean, not just Apple's chips are not ready, but also Qualcomm doesn't have to make up a big hole and doesn't have to make up for the lack of its biggest customer disappearing in about 3 years. Which is a bigger factor for you?
Probably Apple. You know, the story is that Apple has been trying to control more of its supply chain on a vertically integrated basis. And, you know, the modem is a kind of key chip. It connects a smartphone to 5G networks being the latest. But the technology story is that Qualcomm quite clearly is the technology leader. You know, its modem allows a smartphone to connect to the present-day 5G network, but also older legacy networks. And as Bloomberg's reported, Apple has been working on its own proprietary modem for some time. The details of this agreement that you're showing on the screen takes Qualcomm through to the 2026 generation of iPhone, which is quite telling about how far off Apple might be in developing the modem chipset, while it has made a lot of progress in other proprietary silicon, for example, the processor and other medium bandwidth chips.
Well, yeah, I mean, we have to certainly give a hat tip, too, to Mark Gurman. I mean, he reported on this, I think, late last year. Qualcomm was basically saying they weren't worried at all because they knew that Apple was having issues getting that chip to work properly. I am curious, Ed, based on what we know today out of the latest reporting here, do you anticipate that there would be any disruptions in the new iPhone model that we expect to be announced at the event tomorrow?
It's a perfect and timely question because prior to today's deal, we went into tomorrow's Apple event assuming that the iPhone 15 would be the last generation to use a Qualcomm modem. Clearly, the terms of the deal cast a doubt on that. What we expect, based on Mark Gurman's reporting, but also the analyst reaction we've had on Bloomberg Technology today, is that Apple could phase the introduction of its own modem, right? If you look at what they plan to do for iPhone 15, their latest processor, the A17, is going into the higher-end Pro variants, Pro and Pro Max. The lower-end 15 and 15 Plus will have the A16 processor, which was the chip that went into last year's iPhone 14 Pro.
Yeah.
And so that's how Apple's done it. Reserve their latest proprietary tech for the high-end models, recycle older technology for the base models.
All right, Ed Ludlow, the co-host of Bloomberg Technology, you definitely want to tune in tomorrow at 12 p.m. New York time. That's where we're going to have special extended coverage of that Apple event where we are expecting the company to unveil its iPhone 15 and maybe potentially some other devices as well. Scarlett, what number iPhone are you on right now?
Oh, God, I know it's double digits.
That's good.
Yeah.
That's better than a lot of people
12,
here.
13? I can't remember.
Yeah, I mean, it gets to the question here. I know these sort of refresh cycles, it's more for the people who are still on, like, on iPhone, 8 or 9 and get them to upgrade to the latest models here. But, the price has just gotten crazy. And now we're learning, at least based on the reporting from Gurman and some other folks here at Bloomberg, that price is going to be higher than what the iPhone 14 was.
But they've been able to execute on it, right? Apple has managed to gain market share at the expense of Samsung, at the expense of Huawei. And, of course, Huawei was never a big phone seller here in the U.S.
At the expense of Huawei?
Yeah.
Here in the U.S.?
No, not in the U.S., but in Europe, for instance.
What about in China? I mean, we had the big story last week. Obviously, Huawei released its own sort of new smartphone. And, of course, that seemed to coincide with this sort of crackdown on Apple products being allowed to be taken into, I guess, government type of facilities?
Government
in
offices and state-run companies.
But it was all Apple products. It wasn't just phones. It was like you can't bring in a MacBook or AirPods.
And that'll be a dent, but it's not as if for private consumers they can't use their iPhone devices. Maybe they, too, are like teenagers here and they like the blue-eyed messages.
But it's a bit... You think that's going to be the typical...
I don't know. It's a status thing.
But it's a big issue, though, right? Because, I mean, if you do work in some sort of state-controlled enterprise, which, let's face it, is a lot of places, and you can't bring your iPhone there, are you going to have both a Huawei phone and
that's
then
what plenty of people do here. Yeah, maybe. More smartphone sales for everyone.
Scarlett Fu, more smartphone sales for everyone. All right, a lot more coverage. Stick with us. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is the countdown to the close, almost 2:30 here in New York. The broader markets higher on the day, showing a degree of strength. Not a whole lot going on in debt markets, but a mixed day for commodities. Let's get a quick check on what's going on there with Abigail Doolittle and our commodities close.
It is a mixed day, Romaine, indeed, on this board. Overall, though, we do have some strength for the Bloomberg Commodity Index, up about 0.6%. This, of course, as the Bloomberg Dollar Index is down 0.6%. The worst day since the middle of July, so some of those commodity traders taking advantage of the dollar weakness, which of course commodities are denominated in. Now you can see European natural gas really up in a big way, up 5.8%. This, of course, as those Australian Chevron strikes around 2 LNG production plants. They continue. It's estimated to be between 5 and 10% of global LNG supply. So supplies could be under threat. They have been for a few days on the rise than natural gas. Dr. Copper up 2.3%. I couldn't find anything too specific, but again, that Bloomberg Dollar Index is down. Now, New York crude earlier had been up ever so slightly, now down 0.3%. I believe that these are the only two commodities, at least the commonly ones that we track, that are down on the day. Wheat, though, you can see it really can't get a break, down 1.9%, really bucking the trend of some of the other commodities, in part as U.S. wheat inspections are up 28%, and then Egypt is allowing a recent wheat deal to be supplied by any source. It seems Romaine wheat traders not liking those pieces of news.
All right, Abigail Doolittle there with our commodities close. One commodity you didn't have up there is gasoline. Gasoline futures up for a fourth straight day here, and some of it might have to do with extreme heat. It's becoming a threat to global fuel supplies and posing problems for aging refinery systems, causing a spike in electricity demand and sending U.S. gas prices skyrocketing to some of the highest levels that we've seen in decades. Simon Casey joining us right now, Bloomberg's managing editor for energy and commodities in the Americas, and sort of talk a little bit more about this correlation here, because I've noticed that gasoline prices, both at the pump and, of course, what we're seeing in futures markets, have been creeping higher. Give us a sense as to why.
Well, you're absolutely right. So I think it was last week, we had U.S. nationally average gasoline prices at a 12-year seasonal high. So if you remember, this was a big talking point politically as well, economically last year, and it kind of went away earlier this year. Now we're back again. A couple of things going on. Obviously, the oil price is higher. We had OPEC Plus cuts extended last week. Oil has been sort of nudging higher to the 2 and just beyond the $90 per barrel mark. But as you say, this refinery issue is something that's kind of crept up on people, and it's not widely understood, I think. So you have higher temperatures around the world. We've seen extraordinary high temperatures in the southern United States this summer. We've seen high temperatures as well in Europe. This has made those plants less efficient. Refining gasoline is a precarious business at the best of times. These plants are very complex. They are difficult to handle. They often suffer outages. It's something that my team here reports on a lot. The higher temperatures just makes that process even more efficient.
I'm going to ask a dumb question. Why not do most of the refining when temperatures are cooler?
It's a year-round process. It would seem obvious, right, that you could maybe up the processing, the throughput during the winter months, and then store it for when the peak demand hits in driving season in the US during the summer months. It doesn't work like that. There's finite storage capacity. Everything's connected by pipelines. You've kind of got to keep it moving all the time.
Well, I am curious about that, the capacity issue. I mean, because there's two sides of that coin. There's the actual capacity to refine, and then there's, of course, the transport capacity, and both seem to be somewhat lacking these days.
I mean, look, generally, there hasn't been a major US refinery built in 40 years.
Yeah.
So the infrastructure we're talking about is old by any definition. The investment is there to kind of keep it running. Does it make any sense to invest in brand new refining facilities on a major scale when we could be at or are close in some cases, depending on who you believe, to peak gasoline demand in this country and maybe peak global gasoline demand? I mean, that's a very difficult question.
Yeah.
One investors are conscious of.
All right, Simon Casey, thank you so much for laying it all out for us. Simon Casey is Bloomberg's managing editor for energy and commodities in the Americas. I guess, Romain, as bad as gas prices are, if you drive a diesel car, it's even worse. And it's been consistently that way for a while now.
Do people still ride diesel cars? I mean, like passenger diesel?
Yeah.
I remember they were popular for a while, and then the scandal hit.
I mean, usually they're VWs. I know someone from
I know
Canada.
There's probably some like 70-year-old guy still driving around, like his diesel Mercedes.
Right. It's a German vehicle. It's always a German vehicle.
That's right. Yeah, I had one of those. Like, it was like a 74. It was great, and you just take your foot off the gas, and you get up to 35 miles an hour off the brake and without even touching the gas. It was fantastic.
Yeah, it was probably pretty noisy too, and you had to drive around to look for the right gas station as well.
Yeah, and
there was that.
And even with diesel, it didn't get that great of gas mileage here. But you're paying like $4 at the pump on average right now in the U.S., and we know how people get when you start to see those numbers creep
People
up.
drive an extra 5 miles to look for something.
When you're fueling up your Maybach, do you go for the
regular cheapest?
You go for the cheapest.
I don't do premium.
You don't do the premium in that?
No. Okay. It's been a long time. All right, still ahead. We've got expectations are being raised right now for Oracle's cloud computing unit, and of course its use of AI. We're going to preview what to expect before this afternoon's quarterly report, which we will break for you when it crosses the wire. This
what is
is
that
Bloomberg.
picture showing me? What is that?
That's the cloud.
That's the cloud. I always wonder what the cloud looked like.
Yeah.
There you go.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
My knights.
Yeah. He's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
All right, time now for our top calls. The big movers on the back of analyst recommendations. And we start off with Tesla, an upgrade today to overweight by Morgan Stanley's Adam Jonas, who also boosts his price target to a street high 400 from 250 a share. Jonas enthusiastic, giddy, if you will, over Tesla's so-called Dojo supercomputer for driving systems, which he says may actually put the company at an asymmetric advantage in the EV space and could boost the company's valuation by about $500 billion. That valuation up about 10% on the day here with Tesla. Next up, let's take a look at Tenable Holdings, raised to overweight from neutral. This over at JP Morgan, with the analyst saying the security software company showing signs of improving fundamentals. That includes margin expansion and free cash flow. He also says the company continues to dominate its peers in core markets, those shares higher by about 3%. And finally, let's take a look at DoorDash, an upgrade for that company to hold from underperform. This over at Jefferies, which sees underappreciated tailwinds to EBITDA from market share gains. The IPO disclosure from rival Instacart also boosting confidence for the space overall, particularly when it comes to the possibility for margin expansion. DoorDash shares up about 2% on the day, and those, guys, are some of our top calls. We want to stay in the sell side space and take a look at Oracle, the computer software company set to report quarterly results after the closing bell tonight, with artificial intelligence, of course, being a big focus for investors. For more on what to expect, let's bring in Brent Thill, analyst over at Jefferies. He currently has a buy rating on the shares that already have had a phenomenal run so far on a year-to-date basis. And we've seen some of the numbers already on that cloud infrastructure unit in previous quarters. Pretty strong growth there. You expect that to continue?
We do. We think Oracle's infrastructure business around OCI will continue to gain momentum. Remember, Oracle was late to the party. Amazon, Google, and Microsoft have dominated the conversation. Oracle was left on the sidelines, but they've gotten back in to the game with OCI, and that business is doing well. It's resonating well with AI companies, and we think ultimately they're being served as more of a backup than the primary. But they weren't even in the cloud conversation a year and a half, 2 years ago, and they're making their way back on the infrastructure side. And then on the application side, their HR and financial products are continuing to do well. It's really a duopoly between SAP in Europe, and then in the US, it's really them against Workday. So they're in good markets that are actually showing some stability. Their valuation's favorable, and they're actually showing some improvement in their execution.
With regards to what we hear out of them on AI, particularly the long-term strategy and the long-term revenue potential, how much support are they going to have in the interim from the traditional software business?
AI is really early for everyone. It's effectively a rounding error in terms of numbers for the whole industry today. We've said that the AI hype is here, but you're not seeing the revenue yet. You're going to see more revenue into 2024. So next year is going to be a way bigger year on the revenue side. So it's really early, and all these companies are loving the hype. So I'd say don't believe the hype in the short term. The wave is coming, and it's more of a 2024, 2025 impact. But that is going to help fuel accelerated growth as we look forward, and that's another catalyst. Oracle's hardware business is resonating very well among many of these AI companies that have to run workloads. They can't run them all on Amazon or Microsoft. So Oracle is in the mix. Again, wasn't really in the mix in the past.
So the AI hype is lifting all boats at Oracle, it sounds like. When we talk about Oracle, it's known, of course, as a serial acquirer, and it looks like it did make 2 acquisitions this year, Coherent and Cohere, one in May and one in June. what's the outlook here for further acquisitions? What does Oracle need in its portfolio of companies that it wants to build up?
Yeah, so they're lapping this quarter the Cerner acquisition. Cerner in the healthcare space, effectively duopoly, and they have a tremendous amount of synergy left in the Cerner strategy around healthcare. So I think if you think about their vertical approach, they've gone into different industries, such as healthcare, insurance, retail, and we think that vertical strategy is working really well for Oracle. They're going to do more in these verticals. In the infrastructure space, you mentioned, the partnership with Cohere Investment. They certainly could look at doing some tuck-ins in AI. I think right now, again, you're starting to see a lot of the M&A clear. A lot of the software industry is getting rid of some of these large acquisitions, and so we think M&A is picking up. From what our sources, and we're seeing a resurgence, partly because the regulators are letting things go through, and then secondarily, a lot of these companies are clearing these big deals. So Oracle, again, is over 1 year now into owning Cerner, and I think investors realize they do a really good job in M&A. They're cheap, and they buy good assets, and then they squeeze a lot of efficiency out of these assets over a period of time.
All right, Brent, great to catch up with you. Brent Thill over at Jefferies. A nice look at Oracle. Those earnings set to cross the wire after the bell. Expectations among the street right now, Scarlett, about $12.5 billion in revenue and $1.15 on EPS. So shares right now trading roughly at what would be a record high should it hold into the close. And we know there's so much talk about AI and the promise of AI, but the bigger question right now is how far in the future is that revenue, and more importantly, that profitability?
Yeah, and what are they going to say until then? Because that's a long time. It's a lot of quarters in between to continue stoking the fire of the hype without actually saying a whole lot.
Well, that's why I'm curious, too, about how much the legacy business ends up supporting this, because they're going to need that in the interim should that happen
Well, it sounds like it's benefiting from all the excitement that AI brings to Oracle overall, even if they don't need to highlight it when they have the earnings call itself.
Absolutely. Stick well with us. We're going to have full coverage, of course, of Oracle earnings when we get to the closing bell. But, Scarlett, we got to go back, of course, to what's going on here with transportation, particularly here in the city of New York, where congestion pricing, a big plan that has been in the works for years, is actually upon us, Scarlett. We're actually going to sit down and have a great conversation coming up with the former New York City Transportation Commissioner, one of the people actually who helped to sort of spark this idea. We're going to get her thoughts on the looming implementation of it. That conversation coming up after the break on our Wall Street Week Daily segment right here on The Close.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back to The Close. Time now for our Wall Street Week Daily segment with David Weston, the host of Wall Street Week. Coming by today with a conversation I'm very in tune with right now, and this is on congestion pricing, particularly here in New York, a way to, I guess, ease the traffic in New York, but that means a lot of restrictions for folks who do want to drive.
And for those of us who live in New York, everybody is talking about this. Unfortunately, we have the best expert in the world on New York congestion pricing, although I don't think she likes the name of it. She is Jeanette Sadiq Khan. She advises mayors around the world on transportation policy as part of Bloomberg Associates. That's the philanthropic consulting arm of Michael Bloomberg's charitable organization, that is Bloomberg Philanthropies. So Jeanette, thanks so much for being here.
Pleasure to be here with you, David.
This is not the first time we've seen this play. 16 years ago, when you were the transportation commissioner for Mayor Mike Bloomberg, our Mike Bloomberg, you tried to get it through. It didn't happen. So what's different this time? Is it going to happen this time?
I believe it is going to happen this time. 16 years ago, we had a majority of the New York editorial boards in support of that, which is kind of amazing to think about New York editorial boards all being in favor of this plan, a majority of New Yorkers behind it. And it passed the city council and was up in Albany for a vote, and then it was unceremoniously sidelined and never even came up for a vote. And 16 years later, we're in a very different position in the sense that we now actually have a city that has bike lanes and bus lanes and pedestrian walkways. But some things are the same. You know, we have chronic congestion. You know, it's difficult to get around town. And really, the secret of New York City's success and what it was founded on was its transit system. And so this is a once-in-a-generation opportunity to actually bring the resources needed to continue the investment in our subway and bus system.
So for those who are not actually in New York City, as I understand it, it's basically south of 60th Street. You're going to have to pay a fairly substantial fine or fee to get south of it. What's the pot of gold you're after here? I mean, in success, how does this benefit New York and its citizens?
Well, first of all, most of the people in New York City get around by subways and buses and walking. So 75% of people getting around don't drive. And so this benefits all of those riders. The 2 million people that come into New York City by subway and bus, they're the real beneficiaries. The residents of New Jersey, only 1.6% come in by driving. And the vast majority, so 98% of the people that are coming in from New Jersey benefit by better transit, by easier ways of getting around the city.
But has that been articulated? I mean, we still are hearing opposition from the governor of New Jersey, even from other jurisdictions within New York, such as like the Staten Island president and the Bronx borough president. A lot of folks who have basically said this is going to be a hardship for some of their residents.
You know, it's such a good point, because I do think when you think about the words congestion pricing, you have two very negative words, congestion and pricing, tied together in this one little phrase, which doesn't sound like anybody would want it. It sounds like a tax on your sinus condition, right? So the idea that it's going to make it easier for people to get around, that we've got a street dividend, we can make our streets safer, easier, more enjoyable, better for shopping, better for the economy. We need to articulate that in a more effective way. And we can build wider lanes for people to bike. We can build many more fast bus lines. We can make it greener for people to walk around the city. We could pedestrianize Lower Manhattan. All sorts of possibilities that are hidden in plain sight that we can do.
I think most rational people agree with that, or at least with the idea of it, the theory. And we know on paper it probably makes sense, and we've had examples of this being rolled out. Obviously, the city of London, probably one of the more successful examples of this. But it's one thing to have this on paper as an idea, and one thing to actually implement it. Because like you said, it isn't just about putting up the toll lanes. It's also about making sure the transit system is running on time and it's safe and people want to use it, or bike lanes are safe and people want to use it as well.
No, absolutely. And when you think about it, you know, you think about, it's really about paying your fair share in a way, right? Like every time you take the subway to come into Manhattan, you pay a $3 fare. If you're driving into the central business district, you pay nothing. So it's really about fairness, really, and setting it up in a way so that we are actually doubling down on the very systems that make our city so strong. 8% of the GDP for this country comes from here. You know, we're not going to continue to make those kinds of returns on investment by triple decking our streets, right? You already know, walking around the city, just how congested it is.
Yeah.
So we're going to lower the congestion. We're going to improve transit service. We're going to lower pollution. It's really win-win-win.
But are we ready? I want to pick up on what Romain said about the public transit system, because some of us take the subway fairly regularly. It'll get you there. It's very efficient. It's not the most pleasant thing in the world. When you compare it, for example, with London, it's very different from the London Underground as a practical matter. When are we going to get our subway system upgraded to the level of sort of a London?
Well, $1 billion a year will be generated and dedicated to the MTA. And so that's basically what we're looking to do. I do think that there's more that can be done in the run-up to congestion pricing.
Sorry, just to be clear, so a lot of the money that's coming from those tolls, that will go towards MTA.
It's dedicated to the MTA.
Okay.
Yeah.
And the mayor can't take it for things like
it. It's a
needs,
lockbox.
such as the migrants that are coming in. He's not going to take that and take care of the migrants?
And actually, that's a really important point, because we've been around that block before, where money that was supposed to go for something was, diverted for something else. This money is dedicated to the MTA and will go to the MTA. And I think when you take a look at London's example, for example, you saw when London implemented their congestion pricing program, they saw a 30% increase on ridership on their buses, and they saw a dramatic decrease in congestion in the central business district. We are likely to see the same.
We've seen this play out other places. We've mentioned London already, some other places. You're working on some future places. Has it ever not worked so well? Can we learn from that experience where it might not go right, and we need to anticipate that?
We have not seen an example where a city has rolled back on their congestion pricing program. In fact, they've expanded it, and that's what London's looking to do. That's what happened in Singapore. That's being expanded in Milan, Copenhagen, Oslo. You take a look at the cities that have implemented it, and they're all moving forward. So I think it's a pretty good sign. And, these are, obviously somewhat treacherous waters when you start out, right? Anything new is always, there's always pushback. When we rolled out City Bike, people were like, there's going to be blood on the streets.
Yeah, I remember that.
Pedestrianized
and I was
Times
like, it'll be
Square.
okay, particularly because in so many other U.S. cities that already implemented bike shares. But another issue, though, too, is this idea of spillover, right? If you can't go below 60th Street, there's this idea here that people will drive to, like, 61st and park on basically in those neighborhoods, taking up spaces or creating congestion there just outside of this zone.
Yeah, there's not very much parking there now. I think people will learn in pretty short order that doesn't work. Yeah. And New Yorkers are savvy.
Yeah.
They like to find the fastest, easiest way to get around. And we've got the richest network of transit in this area. And so it just makes common sense, to double down on this investment.
Jeanette, thank you so much for being here. That is Jeanette Sadiq-Khan of Bloomberg Associates. She's a principal there of transportation with a rather positive take on congestion pricing. Tomorrow, we're going to talk with the former World Bank President David Malpass about what came out of the G20 meetings over in India. And on Friday, we'll be joined by former Brown President Ruth Simmons about the challenges facing higher education today. That's going to be coming up at 6 p.m. Eastern Time on Friday, Romain.
Yeah, that's some great conversations I'll definitely tune in for. And I hope you talk a little bit more about this congestion pricing.
Oh, count on it.
Because my family's all riled up about this. I don't actually drive, so it doesn't really affect me. But anyway, a lot of other folks. Stick with us here. We are rounding out into the final hour of trading here on this Monday afternoon. A two-day rally afoot in U.S. equity markets on the back of a softer dollar and, well, a little bit of a tamp down when it comes to Treasury yields. Romain Bostic alongside Scarlett Fu. This is The Close, and this is Bloomberg.
Paul Jacobson assured me that when he takes the new Hummer EV on long journeys, It's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted to experience it myself. My family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery. It tells you where the charging stations are. It tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it, it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we've used that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
A few from the top here at 3 p.m. in New York. The countdown to the close begins right now here. Romaine Bostic alongside Scarlett Fu on what is setting up to be a second straight day of gains, Scarlett, here for equity markets, and a pretty strong day to boot.
Yeah, the gains are accelerating here with the NASDAQ at session highs up by more than 1%. You've got Tesla higher. You've got Apple, a lot of anticipation before tomorrow's big product reveal.
The big product reveal, yes. I'm told we're going to get another iPhone.
$1,000 plus.
When are they going to just roll out the car? That's all everybody wants to know. You know what would make Apple stock go to the moon? If Tim Cook came out in an Apple car tomorrow, I'm pretty sure that stock would go to the moon.
Not a new titanium casing for the latest iPhone? Come on.
What are they going to put, like a 6 camera on that thing? You take a look, but pull up that board once again, though, because it is interesting here. You got the S&P camped out around 4,500, but we know a lot of this has to do with the correlation that we're seeing with the dollar, and this is like one of the weakest days that we've seen for the dollar in quite some time.
Yeah, the dollar has had this incredible run here of 8 straight weeks of gains. I think the longest is going back to something like 2005 on this idea that the Fed will stay higher for longer, and beyond that, big question mark. We don't know.
Yeah, well, the good news is overall, I mean, you're seeing most of the individual stocks in the S&P 500 up on the day, but look at Charter Communications up 3%. I know you're going to watch Monday Night Football tonight because you weren't going to be able to watch it prior to today, but now learning that Charter and Disney have somehow settled their differences. Surprise, surprise, right before one of the big marquee games here in the New York area. Flip up the board real quick, Scarlett, because there's been a lot of talk today about consumer spending, personal consumption, if you will. We've been talking a lot about the impact of the student loan payment resumption and what that's going to mean for consumer spending. What you're looking at right now are the remittances coming into the Treasury Department. They're basically people repaying their student loans. And you can see on the far right end of the screen there, the big spike higher here. And that's the fear. If all that money is going back to pay down debt, that's money, in theory, that's not going to buy new goods or services.
Pay for restaurants and everything else. It's a good point. That, by the way, is federal loans. Of course, private loans have always been, there was no relief on that for a long time and continues not to be. All right, let's get to some individual movers. You mentioned Charter. I wanted to take a look at Hostess. The ticker there is TWNK for Twinkies.
I like that.
Yeah.
I hope they keep that.
I hope they keep it too. It's M&A Monday, right? Because J.M. Smucker agreed to buy Hostess for about $5.6 billion in stock and cash.
That's SJM as their ticker.
Yes,
I think
SJM.
Twink is better, TWNK.
I like TWNK better too. Remember in June when Smucker's CEO came on?
Like JAM or JAM or something?
That would be better.
I mean, I would appreciate that.
Yeah, Jam and Twink.
They can have that one for free if they're listening. What else you got on that board?
All right, what else we have Qualcomm, because I mentioned Apple earlier. Turns out Qualcomm will not be losing its biggest customer at year-end because Apple extending its partnership to buy modem semiconductors from Qualcomm for another 3 years. So Apple's in-house chips not quite ready yet, not quite ready for showtime.
And then I also saw you had RTX on the board, of stock that we don't talk a whole lot about, but they're one of the biggest decliners in the S&P.
Yeah, the company formerly known as Raytheon, the defense contractor, falling as much as 7.9%, actually now 8.5%, cutting its full-year sales forecast, and will take a $33 billion charge this quarter to fix one of its aircraft engines.
Interesting. Two of the stocks you had on there. RTX, worst performer in the S&P on a percentage basis. JM Smucker, second worst performer here, as we are less than 1 hour away from the closing bell. Our cross-platform coverage, counting you down to the close, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Scarlett Fu. We're joined right now by our colleagues Tim Stenovic, Jess Menton in today for Carol Master. Welcome to our audiences across all of our Bloomberg platforms, television, radio, originals, and of course our partnership with YouTube, where you can stream all of our wonderful content. Tim Stenovic, including what is, I'm told, the most read story on the Bloomberg terminal today. It's not about stocks, it's not about bonds, it's about a chicken sandwich.
Oh, I'm so glad this is the most read on the Bloomberg terminal. Did you know we're still in the chicken wars? Did you know that?
I did know that.
I thought this was a thing of 2019.
Littered with chicken bones.
I remember this when Popeyes launched its chicken sandwich back in 2019. You had to wait like 2 hours in line. I actually have still never had one.
You would wait in 2 hours?
No, I didn't wait. That's why I still never had one. I walk by a Popeyes on my way to and from the subway each and every day, and the line was just so long. And then recently I noticed the Popeyes is closed, and I'm wondering, Jess, I know this is like top of mind content for top of the hour right here. I'm wondering, Jess, if they're redoing the kitchens to try to, get in on the chicken wars.
Well, apparently the guests were complaining that orders were taking too long and often were wrong. So that's been a big player of this. But I have to honestly say, usually when I go there, I like more of the seasoned flies.
Well, I'm glad you bring that up, though, because, I mean, this is a good point, right? I mean, part of the story that's on the Bloomberg terminal today is how they're really trying to sort of revamp their kitchens for, I guess, whatever the next era of selling chicken is going to be. But it was a specific acknowledgement, too, of just how unprepared their kitchens were for people like Tim who were lining up for 2 hours for,
Well, they were supposed to get, they thought they would do 60 chicken sandwiches in a day.
And how many do they do? Like
1,000 in some locations.
That's a pretty big miscalculation.
It's a huge miscalculation.
Forgot to carry the 5.
I mean, the people didn't know how good they were going to be, I guess.
Does anyone like it better than a Chick-fil-A sandwich?
Well, that's what the franchisees are looking for right now, Scarlett. They want to be, accurate, quick, and get that order to you right away, right when you order it. And that's what Chick-fil-A is known for.
Yeah, I think they need the sauce too. The sauce is the key for Chick-fil-A, right?
It is.
What's in the sauce, Scarlett?
I don't know. That's
Secret
the question.
Sauce for me.
There you go.
It's a mystery. All right, well, what's not a mystery is that if there is a UAW strike, we've been talking about this summer of strikes and this threat of a strike.
Pivot, Scarlett.
I know, I had to make a pivot somehow. If it would start on Thursday, and if it does take place, it would be crippling. Crippling not just for the state of Michigan, which according to the Anderson Economic Group could tip into recession, but a 10-day work stoppage could reduce U.S. GDP by $5.6 billion. Now, keep in mind that Anderson Economic Group counts GM and Ford as clients, so they're kind of getting paid to make sure that you realize what the cost is.
Yeah, and it's already on the radar of the White House. The president actually saying he's confident a deal can get done. Remember, Gene Sperling now is sort of acting as the liaison between the two, and I guess Biden thinks that maybe he can work some magic in the similar way that they did when we were dealing with the earlier, first the rail strike, and then, of course, the other strike as well. But I don't know. They seem really far apart, guys.
They certainly do, but Biden and the Biden administration walk a tricky tightrope here, because President Biden, just as recently as Labor Day, in a press release said he's the most pro-union president in American history.
In American history?
That's what he said.
Okay.
And he wants to be it. He said he's sticking to that promise. This came from the White House, but he said that he wants to. So the question is, how does he support the union in a way that prevents these economies from going into recession if there were some sort of prolonged strike? Because that would be terrible politically. I mean, think about the states that would be affected by this, right? Michigan, Wisconsin, Ohio, incredibly important states for the next Democrat or for President Biden to win in 2024 if he wants to stay in the White House.
Yeah, and you looking at what's happening with UAW, just threatening that strike against General Motors, Ford, Stellantis, and potentially potentially beginning Thursday if no agreement is actually reached.
Chrysler.
Oh,
the new Chrysler.
Oh, Chrysler. I know that name, Chrysler. They decided not to.
They're now one of the big three.
They decided not to do Chrysler or Dodge or
Stellantis.
Just
they went with something more neutral.
Stellantis. It's like a space station.
They got Jeep. They got a lot, Roman. You can find it on the Bloomberg terminal too.
Of course,
everything that they have.
I have one.
I'm gonna go get a chicken sandwich. I'm gonna go wait in line.
Surprised.
Okay. And then hopefully by the time I get the snack, I'll be back here. Okay. And we'll be meeting once again for our Beyond the Bell coverage right here at 4 p.m. We're gonna take you through the U.S. market close. It's available on TV, radio, YouTube, also on Bloomberg Quick Take. We're gonna take you through the market close in just a few. We'll see you guys a little later.
Continuing our coverage here on Bloomberg Television, the close, counting you down to the close here. A little more than 50 minutes to go. Interesting note out, the weekly note out by Morgan Stanley's Mike Wilson. This time he's saying, well, stay defensive. It's a reiteration, of course, of his view that stock markets are not yet reflecting the risk of a recession. He recommends investors focus on a, quote, late cycle portfolio of defensive stocks, industrials, and energy. Doug Ramsey joining us right now for his take. He's the chief investment officer over at the Luthold Group. And I am curious about this idea of the late cycle nature of where we are here and whether you buy into, I guess, that time frame.
I agree with that. In fact, this expansion, this weird expansion off the COVID lows, got to late cycle within a year of those lows. If you're looking at the unemployment rate and sort of the production gap, that sort of thing, and obviously the inflationary pressures, market leadership, all of it. So I do agree with that. The issue is one of timing.
Yeah, absolutely here. And I mean, anytime you sort of see these discussions about where we are in the business cycle, economic cycle, I'm always reminded of this fact of, remember we had that sort of, I guess, attempted breakout in cyclical stocks. The Russell was outperforming the broader market for quite some time, a few days, few weeks here. And then that just kind of just disappeared. It was like poof. All of a sudden it was just, everybody was back to big cap tech and defensives.
That's troubling. I would say out of anything, I mean, in terms of market action, there are troubling things in terms of monetary policy and the yield curve inversion. But just looking at market action, it's the weakness in financials and especially the bank stocks. And then the Russell 2000 measured off of last fall's bear market lows. And now the Russell bottomed a little bit earlier than the S&P, but if you measure it from the S&P's bear market lows 11 months ago on October 12th, the Russell 2000 is only up 10%. The average gain off of a major market low in the Russell 11 months later has been 60%.
Wow.
And I do think the action in both the Russell and the financial stocks, and both the banks and brokers in particular, is an economic tell that these more cyclical high beta names are sniffing out economic trouble in the months ahead.
So when it comes to leadership, you had the big tech, the Magnificent Seven, getting a bit of a revival, but they've kind of faded a little bit today, notwithstanding. Yeah. Where do we stand in terms of the sectors that are likely to help support the market going into year end?
I wouldn't be surprised if there's a continued rotation into tech, and I am speaking our own book here because we're about 35% in technology stocks and another 10% in communication services. I mean, that's where our quantitative work is leading us, and it's more growth and momentum factors that are dictating that, I should say. I would make the case that they're great values. They are not, but currently it's not a value-driven market. So I wouldn't be surprised if that bid stays intact, because I do think in a way they are perceived as economically defensive sectors.
Yeah. I'm curious, Doug, what is your overall allocation to equities right now?
It's 50%. We can range between 30 and 70% in our tactical strategies. Just last week, we trimmed about 4% of equities. We didn't actually sell equities outright, but we increased our equity hedge. So we're right in the middle. Our disciplines are neutral. We'd argue you should already have some chips off the table because of monetary policy and where valuations are. And then if we finally start to see those signs that the economy is tipping over, and obviously we'd like to be in front of that, but there'll be some more chips we'll take off the table in those tactical funds.
I thought what you said was interesting, that you're heavily concentrated in tech, even though that's not where the value lies. Yeah. Where does the value lie right now then?
do think energy stocks are a good value. They've lagged here in light of the big move that we've had in crude. We also look for, I guess, what I'd call underspending in the face of good fundamental conditions. And I think that's certainly been the case in the energy sector, that, in a way, they've taken a nod from the administration and not invested as they normally would, given the rebound in the sector over the last couple of years. So I think that's probably a longer term play, but I do see pretty good value there. They just don't happen to rate attractively yet on our quantitative screens. But I wouldn't be surprised to see that change in the months ahead.
I am curious, when you look at, I guess, some of the other cross-asset metrics out there, whether it's the recent increase in yields or really the run-up that we started to see in energy prices, how much does that fold into your forecast right now, Doug?
I certainly think that when you look back to the peak in early 2022, that bonds have repriced much more than equities have. And we wrote a piece last week about the old Fed model, which was all the rage in the 90s and even during the aughts. But the market today is more expensive on the Fed model. Let me just step back. We're looking at the forward PE on the S&P 500 and then flipping that over to make it an earnings yield and then comparing that to the 10-year bond yield. The market, the S&P 500 on that metric is more expensive than at any time in the last 21 years. So more expensive than at every other major high and major low of the last 21 years. So, that is sort of debunking the old TINA acronym. There is an alternative out there. I don't know if it's going to be a great moneymaker, but I do think bonds have corrected valuations a lot more than equities have, since both of them really peaked almost 2 years ago.
All right, Doug, really appreciate your joining us and giving us your perspective. Doug Ramsey is Chief Investment Officer over at the Leuthold Group. Now, coming up on the close, we've got Charter and Disney reaching a deal. They're ending their blackout of ESPN and ABC, and as Romaine mentioned, it's just in time for Monday Night Football.
Absolutely here. Plus, before you get to Monday Night Football, the big event will be Oracle earnings coming up after the bell. Investors looking closely for any numbers on cloud growth and AI. Full coverage as soon as those numbers hit.
And one firm is looking at a potential 37,000% return in its $16 billion battle with Argentina. We'll be speaking with Burford Capital's CIO. All that and more coming up. This is Bloomberg. What do you like most about your job?
I think the people. Ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I try and play that role.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Meta, Microsoft, Amazon, Apple all moving higher here on the day. Tesla up about 10%. A big part of the reason why you're seeing the S&P and the NASDAQ moving higher as well. The NASDAQ up more than 1% on the day. The S&P up by about 0.7%. There is a lot of red on the screen as well, to be sure, but a lot of that confined right now to the semiconductor space and into the energy space here. The Philadelphia Semiconductor Index only down fractionally on the day, but there might be a little bit of profit taking and, more importantly, a little bit of a wait and see, as a lot of people want to get a little bit more clarity here on the buying cycle when it comes to a lot of big tech gadgets. Full coverage tomorrow coming up, of course, of that big Apple iPhone event, where it's expected to announce the latest iteration of its main device. The VIX still subdued below 14, and yields right now still kind of camped out where they've been right now. 4.3 on a 10-year, and you're right around 5 on your 2-year yield here, as we're about a week removed from the next big Fed decision. Of course, today has also been a big day for, well, a lot of discussions among companies. We talked a little bit earlier about the deal between J.M. Smucker and Hostess. J.M. Smucker, of course, down on that news, while Hostess gets a nice big boost, and a big boost for Disney and Charter ahead of a big Monday night football game here in New York, a football game that maybe drove both of these companies to the negotiating table, finally ending that dispute over some of the cable fees and the rights. All right, let's bring Abigail Doolittle into this conversation, as we do every day at this time, for our Options Insight segment. And Abigail, tell us what you've been looking at today here on what is still a pretty good day for equities all around.
It is a pretty good day for equities, and you really nailed it earlier with the VIX, saying that it's subdued before below a 14 handle. What makes it sort of interesting is the fact that we have CPI this week, we have retail sales, we have PPI. Next week we have the Fed. Investors right now don't seem all that nervous. Scott Bauer, founder of Prosper Trading Academy, you're really one of our experts on the VIX in terms of how it works mathematically, mechanically. And I'm going to pose the question to you that we often pose to our guests, which is the VIX broken?
Is it broken? No, I don't think so. And so many people talk about that because of the zero DTE options that are out there in the S&P that has kind of taken over for the VIX. But no, I don't believe it's broken. In fact, Abigail, if you look mathematically, as you're talking about, if you see a VIX right around the 16 handle, that represents about a 1% daily move in the S&P. Well, we're below 16 right now, and our average moves are below 1% per day. So no, I don't think it is broken.
Okay, I love that explanation, and it's a really good education to many of us, including myself, on the idea of volatility and what the VIX actually represents. You know, though, Scott, there is one investor out there. This is really incredible. I think that the VIX charts incredibly well, and I would say that it does appear to be setting up for some sort of big super spike, similar to what we saw back in 2020 and then 2015, 2016, both of which charted pretty well. There's an investor out there saying that the VIX is going to be at 180 by February of 2024. I didn't even know the VIX could go to 180. I think its last high or only high, record high, is 90. Is that possible?
So it actually could. The likelihood is probably well less than 1%. But this particular customer, this particular investor, if you will, and I've heard from the brokers and the traders down in the VIX pit that it's actually a big bank. They are more than likely buying those upside calls, and they did it in December and February expiration as well, as a hedge against the portfolio, basically to cover or meet margin requirements. I'm not really sure that they expect a 180 handle on the VIX. Again, they can buy, if they wanted to, they could buy 100 calls, 90 calls, 70 calls for literally just pennies more than what they spent on this. So yes, it's one of those, dots that you see out there. It's this big trade everybody's looking at. I wouldn't make too much of it in terms of anyone's expectation of a 180 handle.
Okay, so the VIX is known as the fear index, even though I know you and Kevin Kelly at Kelly ETF tell me that that's incorrect, that it should be the uncertainty index. But there's also the panic index, the skew index, and it over the last 5 years or so, even longer, going back to the crash back in 2011, it tends to spike pretty high a month to 2 months, 3 months ahead of a big sell-off. Do you see any sign of that happening, and what do you think about the skew index?
Right now, I think the skew index is probably fairly priced. The difference between SKU and VIX, VIX is looking at the money options going out 30 days in the S&P. The SKU index looks at those tail options, those out of the money options, both on the upside and downside. So looking for a big black swan event. I don't necessarily think that it is really showing that right now, but always have to watch out for that.
Yeah, for sure, especially given the fact that it's retreating from a recent high, not the record high, but a spike this year. You just have to wonder if some selling of some sort of it could be ahead. Scott Bauer, founder of Prosper Trading Academy, thanks so much for joining us for Options Insight today. Great observations as always. And from New York, this is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
But the population growth that is boosting those local economies is also putting a strain on communities. You've got resentment starting to spark in counties that have seen the biggest population increases, surging more than 40% over the past 3 years in the wake of the pandemic. And of course, it all comes back from Maine to housing. Housing is increasingly unaffordable for many of the locals who are there dealing with the many people who came over from the coast, more expensive coastal cities.
Yeah, it was interesting to see some of the numbers, particularly in 2020, 2021, and even into 2022. We should point out some of that is moderated, but I thought it was interesting you had areas, certain rural areas in North Carolina and Idaho still showing strong price growth, at least in terms of actual home prices. And of course, that then feeds into rental prices as well.
Yes, absolutely. You can't get a place to live. You're being priced out in many other ways. You can't get a doctor's appointment either because there's a strain on infrastructure. The demand for all those things that normally the community could provide has proven too much.
Yeah, it's interesting though. I mean, I know there are a lot of people looking at the strains this is placing on some of those communities, but there's been some good as well in terms of raising income levels, or at least on an overall basis, and obviously some of the services and things that tend to follow some of those types of people and their money. So there are some potential long-term
more cafes.
If you can do it. It's more than just cafes. It's also golf courses, Scarlett.
Okay. Yes, there is that as well. I mean, I think there's a good and the bad. And what fascinated me about that map that we were showing earlier was how much of California and New York was losing ground.
But doesn't everybody complain? I mean, New Yorkers complain about when, folks from middle America come here and we say, why are these people here?
We like to complain.
Yeah, we depend on tourism. We need them here.
We like to complain. That's what
everyone likes to complain. Not me.
politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. JetBlue has traveled a long way from its startup days, but CFO Ursula Hurley says growth won't change the airline's quirky attitude.
At the end of the day, we view ourselves as a disruptor and a maverick in the aviation industry, and I'm really excited to play a meaningful role in that growth journey.
Watch Chief Future Officer, Wednesday on Bloomberg.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is the countdown to the close. 30 minutes left to go here, Scarlett, in the trading day.
And right now we're looking at a second day of gains for the major equity indexes, especially the S&P and the NASDAQ. A lot more green on the screen than red. Consumer discretionary and communication services leading the way. Of course, a lot of those big tech names live inside those groups. Specifically, we're talking about Tesla and Amazon leading the advance. And so that group, consumer discretionary, is up by more than 2.5%, almost 3%. The laggard of the day here is energy, which is interesting given that they are the outperformers over the past 3 months on the persistent rise in oil prices, but it looks like for today a little bit of relief for investors or for those who had been betting against energy. In the meantime, Romain, I know you've got the individual names.
Yeah, let's take a look at Tesla. Actually up more than 10% here on the day, setting up for what's going to be its best day since at least January. And if it gets above that 11% mark, it could be the best day of the year. Quite remarkable for a company that, of course, is pretty used to these types of big gains and losses here on a day-to-day basis. Qualcomm shares up about 4%. That's one of the only bright spots in the chip space. In fact, a lot of the chip makers are moving lower on the day, including AMD, only down fractionally, but keep an eye on that space. Keep an eye on Qualcomm, particularly headed into that big Apple event tomorrow. We're going to have full coverage of that event when they announce their latest slate of iPhones. And Oracle, they're set to report earnings after the bell. Expectations are pretty high for a stock that has been on a phenomenal run, up almost 60% on a year-to-date basis. 126.62, that's going to be a record high should it close at that level. Meanwhile, let's go back to what's going on in the FX space, because that actually had a big impact on what we saw in the equity market today. You're taking a look at the yen, which continues, well, that long-term streak that we've seen versus the dollar this year as far as its weakness finally sort of flipping in its favor. But a lot of that had to do with that interview that Kazuo Ueda, the governor of the Bank of Japan, gave, hinting at the possibility that Bank of Japan may finally be ready to move on from that negative yield policy environment. If that is the case here, we could see more days like we're seeing today where the Japanese yen has the upper hand on the dollar.
Yeah, and again, that's all reflected in the weakness that we're seeing in the dollar today. Meantime, one of the more widely read stories on the Bloomberg is the possibility here of a 37,000% return. A U.S. judge ordered Argentina to pay at least $8.4 billion in damages and $7.6 billion in interest in a lawsuit over Argentina's 2012 renationalization of state oil company YPF. Burford Capital stands to collect the largest share of the award, around $6.2 billion. I'm pleased to say Jonathan Malot, the firm's co-founder and chief investment officer, is joining us now. So as we mentioned, Jonathan, a 37,000% return on your initial investment. Can you first take a step back and explain the business model of your firm, which is described as a litigation funder?
Thanks very much. Happy to be here. Sure. So basically, we operate at the intersection of law and finance, that for basically forever, the practice of law and the market for legal services has been completely divorced from the capital markets. That most law firms have been financed like a food truck. You know, you cash in, cash comes out. There's no permanent equity, no permanent debt, no project finance. And we think that's a problem. And a case like this is a perfect example of it. A bankruptcy trustee in Spain was representing the 25% shareholder of YPF that had lost its entire value because Argentina had breached the bylaws. When Argentina had privatized YPF and done an IPO on the New York Stock Exchange, it had promised investors if it ever changed course and if the government ever retook control, it would make a tender offer for all the remaining shares at a formulaic price. But then in 2012, 20 years in, it changed policy and it didn't make the tender offer. And Peterson was left insolvent, and the receiver recognized he didn't have the resources to fight a big fight like this. And he came to us, and we provided the financing and the management. It's been a long fight. It's been 8 years to this point, and there'll still be appeals. And we're gratified that the court saw the merits of the case and that we're able to get the contract rights of the shareholders vindicated through the legal process, just as it should happen.
You said it's been a long time, it's been a long case, and it could be longer still. The $16 million that Argentina has been ordered to pay, it basically has to write a check out. You mentioned appeal. What are some of the other things that could drag that out, that could make this an even longer process?
Well, so up to this point, to some extent, Argentina having financed this obligation, right? Argentina would have known back in 2012 when it took control, it had an obligation under the bylaws to conduct the tender offer. And essentially, this was a form of financing for the country to delay this through the litigation process. Once you have a final judgment, though, the calculus changes, and it makes sense for Argentina in returning to the capital markets and righting its economy to come up with a solution. So I think it will have to be part of a broader discussion.
I mean, do you think that's going to happen, John? I mean, I'm sure you know more than anybody. I mean, we've been here before with Argentina. I mean, the royal we in that sense of folks trying to sort of collect on, I guess, debts, if you will, with mixed success here. It's one thing to win a case. It's another thing to actually get a check.
So I hear you on that front, but I do think that there is a difference between having a potential liability and having a federal court judgment against you. That it's very difficult for a sovereign nation that deals with the rest of the world to have a U.S. court judgment that's final and enforceable. That will be something that's quite different. And I think there are... Oh, go ahead.
Oh, I'm sorry to interrupt you, John. But I do want to ask. I mean, are you prepared? I mean, to take additional measures to make sure that you do actually collect what you were granted in the court ruling?
So you may know Burford does have an asset recovery business that I don't think we approach every case the same way. When we've been up against recalcitrant defendants, you know, oligarchs haven't paid, we've seized yachts and we've done stuff like that.
Right.
When you're up against a sovereign nation and there are well-meaning government officials, I don't think that the goal is necessarily to embarrass. I think that we come with a reasonable appreciation of the challenges that Argentina faces. But I do think that we can be part of a productive solution to Argentina's problems. You know, it's going to be very hard for Argentina to re-access Western capital without taken care of the prior investors.
Well, it's interesting you bring up that, but the Capital Recovery Group and, of course, the seizing the yachts of the oligarchs, which, of course, Bloomberg talked about. When anyone thinks about Argentina and trying to recoup what you've basically rightfully won in court, everyone thinks back to Paul Singer and when they detained that Navy ship, I think it was in Ghana, about a decade ago. But at the end of the day, Argentina still got his ship back, and as far as I know, at least at that time, at that moment in time, Paul Singer didn't get his money.
Yeah, I'm not sure that seizing ships is the best strategy. That's not. It is true in the end, Paul Singer did get paid. I would not equate Burford with Elliott, and I think it's going to have to be. We're going to have to see how the political climate in Argentina develops. And as I say, we're reasonable commercial actors here. We exist at the intersection of finance and law, and we think we can be part of the solution rather than being a continued problem.
Jonathan, really appreciate your joining us to give us your perspective. Jonathan Malot, co-founder and chief investment officer of Burford Capital.
Do you remember that, Scarlett? Remember it was like, I don't know, I felt like it was like back in like 2012 or somewhere when Paul Singer.
Yeah.
It was like that. It was a Navy ship.
Yeah.
I mean, you just take a Navy ship?
I know.
And it was like in the port in Ghana, and then I don't know how long they kept it there. It was like
an ongoing thing. It'll feel like, I wonder whether the court victory was the easy part, and now comes the hard part, right?
Yeah, but isn't that always the case? I mean, even in the U.S. courts, I mean, you get a judgment against somebody.
And you're like, okay, done deal. No, not even. All right, coming up, you know what day it is today?
Tuesday? It's Monday.
It's green for the Jets. How about that?
And I'm told it's football or for the Bills, depending on, I guess, who you're rooting for.
Well, I don't see any blue on that screen.
Oh, okay. All right. I don't know. I don't have a stake in this fight. I hate both teams.
Do you like the Bears?
Unfortunately, yes.
All right, ESPN's buzzer beater.
They're not on Monday Night Football.
No, yeah. They've reached an agreement ending an ESPN blackout hours before the Monday Night Football season debut. We've got more coming up in our Stock of the Hour. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Time now for our stock of the hour. Shares of Disney and Charter moving higher here, trying to recoup some of the losses over the past few days amid that dispute that basically, well, effectively took ESPN off your TV screen. Pleased to say that ESPN will be back now that they have reached a deal just ahead of a big Monday night football game here in New York. Geeta Raghunathan over at Bloomberg Intelligence joining us right now to talk a little bit more about not just the dispute, but I guess why these two companies had to settle it.
Yeah, absolutely. Football has always kind of been the core of these carriage disputes, and we always kind of see them kind of come down to the 11th hour or down to the wire just as football season begins. So obviously this was a huge point of leverage, this big Monday night football game with the Bills and the Jets, both core charter markets, New York City as well as Buffalo. So it was really a huge point of leverage for both sides to kind of get a deal done.
So they got a deal done, and Jets fans and Bills fans can watch the game, but it's created a lot of ill will, I would imagine, for consumers who it's difficult for them to figure out where they can watch what when they want to.
Oh, absolutely. I mean, the past, 10 days, and of course, whenever these kind of carriage disputes come out, it's a huge, the consumer always kind of loses out. But again, this game was really big. Everybody was kind of waiting a little bit. They said, we'll wait and see if we can get to see the game. If not, obviously we would have seen consumers leave in droves, I would imagine. So it was really important for them to get this done, which they did as anticipated.
Well, Aaron Rodgers remained and all.
Yeah, I'm told he's pretty good, right? Or at least
just a bit.
Or at least he's supposed to be. If he's not, he's definitely going to hear it tonight out there in the New Jersey Meadowlands, even though they're named the New York Jets. Geeta, I am curious, though, is there anything to extrapolate longer term? I guess kind of about Charter's business as a cable company, that core business as a cable company, and how it holds up. I mean, this dispute really sort of exposed, I think, a lot of issues that have persisted now for years.
Yeah, this was not your typical dispute, Romaine, absolutely, because Charter very, very clearly said, and they were not bluffing when they said that they are willing to walk away from the video business. And it really kind of shows the shift in the whole business model. All of these companies, cable companies, which were typically video providers, have now become broadband providers. And really, if you just kind of take a look at the business model, it's really the economics of the business. Video doesn't give them very high margins. It actually is less than 10%. Broadband, on the other hand, or internet connectivity, gives them more than 60% margins. So they are perfectly fine walking away from video TV distribution, going to broadband, going to streaming. And that was one of the sticking points in this Disney negotiation for, Charter to be able to provide free access or available access to some of those Disney subs for their linear TV subscribers. And I think they got that.
I'm really disappointed, Geeta, that you're not wearing green or blue today, but we'll forgive you. Geeta Raghunathan, the best of Bloomberg Intelligence, a breakdown of that deal between Charter and Disney.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis,
analysis. We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City, from London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is the countdown to the close. Romaine Bostic here alongside Scarlett Fu. As we're counting you down to the close, it's just about 10 minutes until we get to those bells, Scarlett. Interesting price action today.
Yeah.
And maybe that's because the market's kind of been left to its own devices. There's no real Fed speak.
Nope.
We're going to get some economic data, but that's still a couple days away. No earnings. Oracle.
Feels like summer,
that's
right?
it. So do what you want, right? when the cat's away, let the mice play.
Is this a defensive rally? I mean, the NASDAQ 100 is up 1.2%. You've got Tesla up 10%, Amazon, Apple, Meta, all leading gains. The dollar is down. Bonds are kind of mixed. We're looking for a catalyst, and we're waiting for CPI.
But this is where you kind of get these weird head fakes, right? Because you ask, is this broad-based, right? That's effectively what you're asking. If you look on a sector basis, you would say, of course. But when you look on an individual stock basis,
hardly.
Not so much.
Yeah. Energy stocks are, definitively lower by 1.4%. But after that, everything's kind of,
Yeah. Is that a technical term?
Yes, absolutely.
All right. Let's get some insights out of our next guest. Steve Chiavarone joining us right now to help us count down to the close. Senior Portfolio Manager and Head of Multi-Asset Solutions over at Federated Hermes. Steve, great to have you here in studio too. Let's talk about market sentiment right now. Because there is a kind of this sense that the market is kind of left to its own devices. Everybody's sort of having this debate. Are we headed for some economic soft landing, or are we in some sort of late economic cycle, and this is sort of the last gasp of whatever bull market we may or may not be in?
Yeah, we're still in the choose your own adventure stage here. Where, if you think about an economy that was hot, that is either normalizing to a kind of equilibrium, a softer landing, or one that's going to continue to decelerate into something that's less positive. That's the same road through this stage, right? And so what you've seen so far is economic data has moderated, but it's done so at a pace that hasn't really scared anyone. And I think you continue there for some time, and days like today, you're right. It's an idiosyncratic Monday. There's stock-specific news. It's driving the market. I think the next several days, there will be much more macro-centric. CPI, you've got some Treasury auctions, leading up to a Fed meeting.
Speaking, I guess, of the macro side of this, and this idea that there's a soft landing, or at least the belief in a soft landing. There's also sort of this discussion now about a Goldilocks scenario, not so much for the economy, but for the Fed. The idea that the Fed has pushed all these rate hikes through. You have not seen any major economic data sort of fall off a cliff. I would think that puts them in a relatively good position to sort of wait and see themselves.
I think wait and see is the right word. I don't know if I'd declare Goldilocks just yet. If you look historically, unemployment doesn't rise until after the Fed pause is completed. Fed pauses on average about 9 months. Same thing with CPI. It generally doesn't break definitively to the downside until after they've hiked and then paused for some time. It has this time. But the question is that normalization in CPI really about COVID normalization with more disinflation down the pike? So, look, I think they've certainly gotten the Fed funds rate above the CPI level. That's a good place to maybe take a pause. And then we have to see what the next kind of 6, 9, 12 months brings in terms of the economic data.
So as you wait and see this period through, and as we wait for the Fed to figure out what it wants to do, how are you managing your portfolio? Are you more active than you normally would be, or are you kind of sitting back and you've already positioned out everything and you're just waiting to see how it all shapes out?
Some combination of the both. I mean, it's a kind of barbelled strategy. I'd say, first off, we're slightly overweight equities. We're about 3% overweight equities on a scale of 0 to 10, so 30% of our max overweight. Markets rally when Fed pauses. On average, the max rally after a Fed pause is something in the 15 to 20% neighborhood, and so we're positioned for that. We're overweight everything other than large cap growth on the idea that we're going to see some broadening out here, and some of the names that were priced for recession earlier in the year start to catch a bid. And then on the fixed income side, it's more a story of reaching out on duration. So a little bit in that 1 to 3 year space, a little bit in the intermediate space, but still quite cautious on the credit side. So it's a close to neutral portfolio, but one that's tilted for, I'd say a positive equity market in the short run.
Why are you cautious on the credit side? Because spreads are where they are?
Spreads are tight, especially if you look at high yield spreads being as tight as they are. There's not a ton of value. You have seen a little bit of pickup in things like default activity, which can lead spreads. And so we just don't think that we're compensated, particularly in the high yield spot, for the valuations. Now, if those spreads were 500, 600, 700 basis points, I think we might feel differently about that. Whereas on the equity side, even if you do have some concerns, in the medium term, the idea that you could be sitting, we've got a 5,000 forecast for the S&P before all is said and done, and that's still 10% greater than here, and we'll play that.
So 5,000, that would basically be a fresh record high should it actually hit that level, right?
Yeah, and what's interesting is if you go back over the last 40 years, Romaine, the S&P has achieved an all-time high every time the Fed has been on pause. So that wouldn't be inconsistent with history, and that includes both recessions and soft landings.
But I am curious. I mean, there are some people that look at the run-up that we've already had in equities, what was it, 15% or so on the S&P, more than that on the NASDAQ. And then the big question is, how do you end up getting that type of rally when you've already had those types of gains? Is there a fundamental case to be made for that?
Well, I think that's why you see that we're overweight things that are not large cap growth, because large cap growth has certainly driven that, and that has been a story of rates falling and then their balance sheets being so strong. But if you look at parts of the market like industrials, materials, banks, some of the energy names, those were priced for recession in the beginning of the year, and if recession comes or it doesn't, the fact that we're pricing in a soft landing right now means that those names could revalue higher.
It sounds like you're prepared for anything to come your way. What worries you the most? Because just a couple of weeks ago, all the bad data out of China sent everyone running for cover.
Yeah, I'd say, we've got a close eye on a couple of things. One is what's going on with the 10-year yield. So we're up here at 4.3.
Yep.
Rumors that Japan could move further away from yield curve controls. You've got some Treasury auctions this week. Deficits are large. Dot plots come out that could take away some hikes for next year. So do you get another sell-off in the Treasury, and does that pressure valuations? If it did, on the large cap growth side, we'd probably be a buyer of that weakness, but that's one thing. And then,
you like the dot plot?
What's that?
You like the dot plot? I find it valuable.
I miss the days when we had to guess the size of Alan Greenspan's briefcase. I felt like it was simpler. It was an easier, simpler job.
For you.
Yeah, I mean, it's one of those things where I think the level of communication is helpful at times, but it also can cause unnecessary angst.
I'm still waiting for Winning Rights to Tell All book, and we find out it was just like the sandwich that he had.
I'm sure that's exactly what it was.
There were no papers or anything in it whatsoever.
Yeah, you make it sound like it's a Saturday Night Live skit at the end of the day. So when you look ahead to what could be unexpectedly a piece of bad news, what's the shoe to drop that people aren't ready for right now?
So we're calling it 4 games of chicken, right? So can the Fed get inflation down and rates rates down before corporates need to refinance the bulk of their debt, in time for small businesses to not be under too much interest expense pressure? Can the consumer get real incomes positive long enough to pay down some of that credit card debt, refill savings, and continue to spend? And do banks hold in? We think the answer to those things are yes, but if any one of those breaks, it can filter through the other three.
All right, Steve, we're going to have to leave it there. Great to catch up with you. Hopefully you're going to get Monday Night Football back on your cable network tonight. You can
Are you
watch
green or blue?
The Bill. Yeah.
I'm a 49ers fan. Go Niners.
He's red and gold.
Steve, we still love you. Steve Chivarone there over at Federated Hermes helping us count you down to the close. We're moving closer to those bells. Stick with us as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with our friends Tim Senovic and Jess Menton, who's filling in today for Carol Masser. Welcome to our audiences across all of our Bloomberg platforms. Tim, we have to start off with really the most consequential question of the day. Did you get your Popeyes chicken sandwich?
I didn't. I was actually not able to leave the desk.
Okay.
Yeah, I haven't gotten up since I saw you.
All right. Well, last time we talked to you, the markets were higher. They are still higher on this day. In fact, setting up for what's going to be a pretty strong day, at least if you're in the NASDAQ.
I guess my question is, how much of this is just about Tesla up 10% thanks to that Morgan Stanley upgrade, Jess? I mean, look at this. It's pretty mind-boggling to see. It's accounts for 8 points in the S&P 500 right now.
Right. So sixth biggest weighting there when you are looking at Tesla and that upgrade from Morgan Stanley. So it is going to sway some things there, and especially when you are looking more broadly at what the discretionary sector is doing, up more than 2.5%.
I'm sorry. Can I just punch back at Tim for a second?
Of course.
Amazon's up 3.5%. Meta's up 3%. Microsoft's doing well, up 1% on the day. Qualcomm up 4%. You got some other heavyweights out there. It's not all just Tesla.
That's true.
Qualcomm's weighting though in the S&P 500 is much smaller. It's only about 3/10 of a percent.
Those are some familiar names that we see moving the market.
You've heard of Amazon, right?
I've heard of Amazon.
Okay.
Apple's got this event tomorrow, and I guess Qualcomm chips are now going to be in the phones.
Now, are you going to line up for the iPhone? What is it? Apple 15?
iPhone
15, yeah.
If I can get a chicken sandwich also.
For 2 hours? What's the line for the Apple iPhone?
Do people still line up for them?
I don't know. No one.
I don't think so.
I don't know if that's still a thing.
I was going to make a disparaging comment, but no, hopefully not. No disrespect to anyone who would stand out in line for a telephone. All right, let's get the closing bells here. Your numbers here on the Dow Jones Industrial Average. Green across the screen with the Dow Jones Industrial Average up more than 80 points, or about 0.25% on the day. The S&P 500 higher by 30 points, or 0.7%. The NASDAQ.